to this session of Advanced Excel Formulas. In this session, we are going to cover formulas that are related to the if statements. If statements are advanced formulas that are normally used when you want to analyze your data and come up with formulas that will give you certain criteria. And with me here, I have created a workbook that will enable us to go through a variety of if statement formulas that are in use here. The first one that we are going to tackle will be the if statement formula. Now, if statement is a formula in Excel that helps in analyzing the contents of a single cell, and it analyzes the contents of a single cell and compares it against a condition that you've specified or a condition that you stipulated. If the contents of the cell that you are analyzing surpasses the condition that you've set, then the formula will give you a true value, a true statement, or a true formula. But if the contents that you are analyzing don't meet or don't surpass the condition that you stipulated, then the formula will give you a false value or statement. So let us go straight to how the if statement is applied so that we can be able to see what happens if we use the if statement formula. So with me, I have come up with data that we are going to use. This is the student's grade sheet. It has column A through to column E. There is student name, there is the age of students, the exam score, there is age status, and there is grade. So we have a grade here. And first, we are going to look at the age status. And you can see the age status, we've stipulated a condition. There are conditions that have been stipulated here. Now, for age, if the content or the cell that we are analyzing surpasses 20 as the condition, then the formula will give back youth. But if it is less than 20, the formula will give us teen. So if it is greater than, we can use greater than or equal to 20, the formula will return youth. But if it is less than 20, the formula will return teen. So let us see how that is to be done using the if statement formula. First, we are going to precede every formula with an equal sign. So every formula is preceded with an equal sign. Then we type if. Then double click on, you can see if checks whether a condition is met and returns one value if true and another value if false. So I'll double click on the if. Then you click on the value that you are testing, the logical test, the value that you are testing here, which is 34. So B4, where there is age, so 34. We are analyzing 34. We are analyzing 34. So if that cell, which is B4, and it represents 34, is greater than, so we are going to look at a condition that you've stipulated. If that is greater than or equal, now the condition is 20, we type 20. Now if B4 is greater than or equal to 20, comma, then the formula should give you youth. So the youth is going to be put in bracket in quotations. So full quotation, youth. Then you close the quotation. But if that is not met, then the formula should return teen. So the formula should return teen, and we are going to have the teen there. So if before the cell that you are analyzing is greater than or equal to 20, the formula will return youth. Otherwise, if that condition is not met, the formula will return teen. So teen is going to be there. You close the bracket, and after closing the bracket, you hit enter, and returns that this person is a youth. You can see the person is a youth because the age is 34. 34 is greater than 20, and therefore the formula returns youth. Once that has been done, you copy your formula down up to where Tonet Meg is, and the rest will be pre-filled. Now, Lewis is a youth. David Jack is a youth. Cheryl is a teen. Of course, the age is 18. Gary Hall is 15 years. That one is a teen. We have another youth here. Of course, everything has been brought by your formula or the formula that we entered. So if the age is greater than 20, the formula returns youth. But if the age is less than 20, the formula returns teen, as it has been seen in the if statement formula. Now again, we also have exam score, and we are going to analyze the exam score using the condition that have been stipulated here. Now, the condition is that if somebody scores greater than or equal to 60, the formula will return pass. But if somebody scores less than, this one should be less than. If somebody scores less than 60, the formula should return fail. So how is that particular formula applicable? So equal sign, then if, then you double click on the if. You click on the cell that you're analyzing, in this case you're analyzing 80. 80 is C4, C4. So instead of typing, instead of clicking, you can just write C4. That is if you know the cell that you're analyzing, comma. If C4 is greater than, or equal to 60, the condition is 60 here, 60, comma, then the formula will return pass. So pass should be in quotation. The formula should return pass. You close the quotation. Otherwise, the formula should return fail. So if the condition above on the left is not met, the formula should return fail. And fail should also be in quotation. So fail should also be in quotation like that. So after that, you hit enter, and the formula, of course, has some error. So we see where the error is. So if C4 is greater than or equal to 60, comma, the formula should return a pass. Otherwise, the formula should return fail. So let us see where the error in the formula is. And okay, so the formula is going to be redone. So if C4 is greater than or equal to 60, comma, then the formula should return pass. You close that, comma. If that is not the case, the formula should return fail. So the formula should return fail. Then we close the bracket and we punch enter. Let us see where the error is. C4 greater than or equal to, okay, so the comma was there after C4, then enter. Now it comes back. So we were putting the formula in just after C4, which was wrong. So if you miss a quotation, if you miss a comma, or if you miss where to place anything, the formula will give you errors, which is what we've encountered in our just concluded errors that happened there. So if you punch enter, then pass. That means if you score 80, the formula will return pass. Let us copy the formula down using the autofill here. So you click on the bottom right side of the formula, then drag it down all the way to Tonet Meg. So the rest, everybody who scored above 60, the formula returns pass. Anybody above 60, the formula returns pass. Anything below that, fail. Like a Cheryl failed, got 50. Gary 40, that one failed, all the way to 72 here. That is Vim, who scored 72, and that is a pass. So that is how the if statement is applicable in analyzing whatever data that you have in terms of what we've seen here. So the formula can be applied in a variety of ways. You can use it to be able to determine whether your sales were high or they were low sales, or whichever any other analysis that you want to come up with. So that is the if statement. We now want to move to the second analysis, which is nested if. So on our other sheet, we have nested if, which we want to go to and analyze how different things can be done now using the nested if statement. Now, nested if statement, just like the if statement, it analyzes the contents of a single cell. It analyzes the contents of a single cell and compares it against a given condition, and compares it against given conditions. So it analyzes the contents of a single cell, but compares it against given conditions, compares it against given set of conditions, and it returns a true value or statement if the tested condition is met. Otherwise, it will be returning a false value or statement if the tested conditions are not met. So the nested if statement, it analyzes the contents of a single cell and compares the contents against several given conditions, so that it returns a single value statement or formula if one of the condition is met. Otherwise, if no condition is met, then it returns a single false value statement or formula. That is the nested statement here. So in this case, we want to analyze the grades of students on this student's grade sheet. And with me here, I have the students' names. There is Cat 1, there is Cat 2, there is Assignment 1, there is Assignment 2, there is presentation that was done, there is an exam that was also done, then there is total, then there is analysis for grade 1, and also analysis for grade 2 in that particular order. So first, we want to get the total. Remember, for you to get the total, it has to be the summation all the way from Cat 1 to exam. And the best formula that we can use here is AutoSum. You can see AutoSum. So you just click on sum and it predicts that indeed you want to sum everything on the left. So that is AutoSum. Then you punch enter. Or you can say sum. Then you double click on the sum. Then you just highlight what you want to sum up to exam. Then you close your bracket. Then you punch enter. That is the same thing. Anyway, I want to drag the formula down so that the rest of the answers can be pre-filled. Then I want to reduce this to 1 decimal place. 1 decimal place, which means I'll decrease the decimals here. You decrease the decimal so that it's 1 decimal place. Then there is grade 1, there is grade 2, and there is the conditions that we want to follow here. So you can either come up with A, B, C, D, E, or from distinction through fail. If a student scores above 75 or equals to 75, the formula should return grade A or distinction. If a student scores 60 or above, the formula should return either B or credit. If a student scores 40 or above, the student should return C or pass. If a student scores 30 or above, the formula should return D or refer. If a student scores 30, less than 30, if a student scores now less than 30, if a student scores less than 30, that one is to be changed, then that should be an E or fail. So we'll start A through E for grade 1, then distinction through fail for grade 2 here, using the nested if statement. The only difference between nested if statement and the if statement is that for if statement, there is only one condition. But for nested if statement, you'll be comparing the contents of your cell against several given conditions. So straight to the formula, you precede your formula with an equal sign. Then if double click on the if. So if the cell that you are analyzing is where the totals are, if that is 23 here, H4, which is 23, is greater than or equal, the condition is 75, so greater than or equal to 75. If H4 is greater than or equal to 75, then comma, this formula should give you A. So you type A, then close it in the quotation marks, then comma. Again, if, again double click on the if, the same H4, which is 23, is greater than or equal to, the other condition was 60, greater than or equal to 60, comma, then the formula should give you credit. So the next one there was credit. Then that one is also enclosed in the closing bracket, then comma. If the same cell, H4, formula is missing an opening here. So if, then you double click on the if H4, the same cell, is greater than or equal to 40, greater than or equal to 40, then the formula should give us C. So we're going to type C in quotation. So that will be C. Then you close the C like that. I missed here. So this ought to have been D. So I'm going to correct this to D. There is A, not B, but B. A, B, C. Then now we move. Again, if H4 is greater than or equal to 30, comma, the formula should return or give us a D. So that one is a D there. We close. But now we are on the last one. We have A, we have B, we have C, we have D. Now for the last one, there is no need of starting with if again. You just come up with the comma, then you bring the quotation. Of course, it assumes that whatever has been said already is not met. Then whatever follows will be E. That is what, if what is on the left is not met, then the formula should just give you E straight away. So if you don't meet to be in the category of A, B, C, or D, then you'd be in the category of E. Then you close the brackets depending on the number of brackets that are open. So how many brackets are open? 1, 2, 3, 4 brackets are open. You're going to close ours with, again, 4 brackets. So 1, 2, 3, 4. After that, you hit enter and it will give you that the first person indeed scored an E. So you can see our formula here, the way it has been typed on the formula bar, and that is what is expected of us to do. So you copy it down and the rest will just appear. A few people have gotten E's, others have gotten A, like 8 is an A, 43 is a C, 62 is a B, 39 is a D, all the way to 24 being an E, 85 is a A, we have C's, and we also have other D's there. So this is the score after analyzing these particular grades using the if statement formula. Again, we want to analyze the same thing, but now where there was an A or E or D or C, you are going to replace with distinction, credit, pass, refer, and fail in that order. This was 75. This was 75. Let me see if that was 75. It is correctly put. So again, we want to now replace with the distinction through to fail using the same formula. So equal sign, if, then you double click on the if. If the cell that you're analyzing is this 23 where there is total, that is E4, if that is greater than or equal to 75, comma, then the formula should give us distinction. the formula should give us distinction. The formula should give us distinction. Comma. If, again double click on the if, the same cell is greater than or equal to 60, comma, then the formula should give us credit. The formula should give us credit. So you enclose, comma, then again, if the same cell is greater than or equal to 40, then the formula should give us that was if it's greater than, that was pass, comma, then again, if the same cell is greater than or equal to 30, comma, the formula should give us refer. The formula should give us refer. You close the bracket, then the last one automatically, comma, then you bring in, the other one is fail. The other one is fail. Then you close with the number of brackets that are open. 1, 2, 3, 1, 2, 3, 4. That is 1, 2, 3, 4. So you're going to close with the 4 brackets. 1, 2, 3, 4. I hope all the brackets have been presented, and that one is a fail for that particular student. So this one had everything. There was 30, there was 40, yeah. So once that is pre-filled, you copy your formula down again, and let us see if it is corresponding to the way we needed. So you can see E is fail, A is distinction, C is pass, B is credit, C is pass, B is credit, D is refer, E is fail, A is distinction again. So this is how you analyze your data using if statement and also using nested if statement. So that is if statement and nested if statement.
Hi there, my name is Patrick Kamau Kamure, and I welcome you today to our lesson where we continue looking at the tax planning. You can see it's a continuation from our previous lesson where we started looking at the tax planning for the individuals and especially those in employment. And by the end of that lesson, after looking at various opportunities available to a person under the employment, we say that this lesson we are going to look at a question. So I'll read the question, then we see how we can solve the question. So here I read. Peter Samoei is an employee of Zawadi Limited and earns a salary of 140,000 per month, while his wife Sabina Wanga works in Lindi Limited, a firm in which Mr. Samoei controls 18% of the share capital. Her salary is shilling 60,000 per month. Sabina Wanga owns the house which is occupied by the family, for which the market rental value is shillings 45,000 per month. The house was constructed in the year 2017 at a cost of 6 million, borrowed from Masako at an interest rate of 12% per annum. Sabina Wanga has insured the house and paid insurance premium of 4,800 per month and city county rates of 6,900 per annum. Mr. Samoei paid insurance premium for his family of 4,600 with an insurance company incorporated in Uganda but operating in Kenya. Zawadi Limited paid school fees of 8,000 for the couple's children, which was expensed in the firm's income statement. Required, suggests 4 tax planning scheme that could minimize the tax liability of the family. So we are supposed to suggest 4 tax planning scheme that the family can use to legally reduce the tax they are supposed to pay, because that is what tax planning is about. So if you look at the question, let's go item by item. We spot an opportunity, then we indicate how it can be utilized. Peter Samoei is an employee of Zawadi Limited, earning a salary of 140,000 per month. There is no opportunity there. While his wife, Sabina Wanga, works in Lindi Limited, a firm in which Samoei controls 18% of the share capital. There we have an opportunity. We said if the wife work in a company where the husband control 12.5% or more of the shares, the wife income is added to the husband income to be taxed together. But when it is less than 12.5%, it will be taxed separately, and in which case both of them would claim personal relief, and also the wife income would be taxed at graduated scale rates. So we put that down. So we had reached up to the second sentence. Now we continue. Her salary, now the wife, is 60,000 per month. Sabina Wanga owns a house which is occupied by the family, for which the market rental value is 45,000 per month. The house was constructed in the year 2017 at the cost of 6 million borrowed from Masako at an interest rate of 12% per annum. Sabina Wanga has insured the house and paid insurance of 4,800 per month and county rates of 6,900 per annum. So there is another opportunity from that point of the wife owning a house which she constructed through a SACCO loan. Now, in this case, remember, SACCO loan do not qualify for mortgage interest relief. Remember, we say that an opportunity available to an employed person is to use the mortgage interest relief to reduce the taxable income and eventually the tax to be paid. So what should she do because it's not a mortgage? She should take a mortgage loan and use it to pay the SACCO loan. And now she will remain with the mortgage loan, in which case now she can claim the mortgage interest relief to be used to reduce the taxable income and eventually the tax payable. And we are going to show the amount, which we said is the lower of interest on the loan and the 25,000 per month or 300,000 per annum, whichever is lower. So what we are saying is that the wife, Sabina Wanga, should take a mortgage loan and use it to pay the SACCO loan so that she can qualify for mortgage interest relief to be used to reduce the taxable income and eventually the tax payable. With the lower of 12% per annum of the mortgage, that is now the interest, which is 720 for the whole year, and the limit, which is 25,000 per month times 12 for the whole year, 300,000. In which case we get the ROA to be 300,000. Now we continue. The second paragraph, Mr. Samoi paid insurance premium for his family of 4,600 with an insurance company incorporated in Uganda, but operating in Kenya. So there is another opportunity, family insurance cover, that is life insurance cover. So if it is outside Kenya, a company outside Kenya, one cannot qualify for the insurance relief. So he should shift it to a Kenyan company so that now he can be able to claim the insurance relief to be used to reduce the tax payable. With the ROA of 15% of the premium he is paying, and we compare with 5,000 per month or 60,000 per annum, whichever is ROA. So number 3. So that's what we are saying. Mr. Samoei should transfer the family insurance cover from a company incorporated in Uganda to a company incorporated in Kenya so that he can claim insurance, insurance relief to be used to reduce tax payable with the lower of the interest, 15% of the premium, of which case, since we are not told whether it's per month or per year, we assume it's per month so that we multiply by 12 to get for the whole year. And we compare with the limit, which is 5,000 times 12, 60,000 per year. The rest is that one. So we look at the last part of the question. The last part which we are told, Zawadi Limited paid school fees of shillings 80,000 for the couple's children, which was expense in the firm's income statement. Now, we had said that if the company expends the school fees in the income statement, it is a taxable benefit on the employee. And since now we are advising the employee how he can reduce the tax liability, is we advise him to request the company not to expense the school fees in the income statement so that it will become a tax exempt benefit on him. So number 4. So if you look at the required, we were supposed to suggest 4 schemes, and the 4 schemes we have provided. So that is how you are supposed to answer that question. That is one question. I'd like us to look at another question to see how we can answer it. This is what the question says. Albert Kimeri is an employee of Ruaka Limited. He has provided the following information relating to his income. Number 1, he earned basic salary of shilling 60,000 per month. He is paid house rent allowance of shilling 30,000 per month. His wife Ravena Kimeri is employed at a salary of 54,000 per month with Tops Limited, where Kimeri hold 20% of the shares. Now, number 4, they both live in a house which is owned by the wife. The house was constructed through borrowed funds at an interest rate of 15% per annum. The employer paid school fees for the children of Albert Kimeri. He was a member of an unregistered pension scheme where the employer made contribution towards the scheme on his behalf. The wife ran a farming business where she earned 400,000 from the sale of farm produce. He is contemplating securing a bank loan for his children, education, or an education insurance policy that will equally cater for their children's education. We are required to suggest a tax planning that will minimize the tax liability of the family of Mr. and Mrs. Kimeri for the year of income and the subsequent years. So in this case, we go through the question one by one, analyzing for any available opportunity. We start with number 1. He earned a salary of 60,000 per month. There is no benefit or opportunity that can be utilized there. Number 2, he is paid house rent allowance of 30,000 per month. Again, there is no opportunity that can be utilized there. His wife, Ravena Kimeri, is also employed at a salary of 54,000 per month with Tops, where Kimeri holds 20% shares. Like we said in our previous question, reducing the shareholding to less than 12.5% so that the wife is tax separated from the husband, so that both can enjoy 2 personal relief and the wife income can be taxed at graduated scale rate. So solution. So what we are saying is that Albert Kimeri should reduce shareholding at Tops Limited, where the wife worked to less than 12.5% from 20%, so that they are tax separatory in order to enjoy 2 personal relief and for the wife income to be taxed at graduated scale rates. So we were in point number 3. So we now go to point number 4. They both live in a house which is owned by the wife. The house was constructed through borrowed funds at an interest rate of 15% per annum. Now, we are not told that the borrowed funds is mortgage loan. So, borrowed funds does not mean mortgage loan. So, we should advise, like the other one, that the wife should take a mortgage loan and pay the borrowed funds so that she can claim the mortgage interest relief to be used to reduce the taxable income and eventually the tax to be paid. So, number 2. Now, since we haven't been told how much the fund was, we just state, yeah? So, the wife Ravena Kimeri should take a mortgage loan and use it to pay the borrowed funds in order to qualify for mortgage interest relief, to be used to reduce taxable income with the lower of mortgage interests and also 25,000 per month or 300, whichever is lower, to be used. We continue. That was point number 4. We go to point number 5. The employer paid school fees for the children of Albert Kimeri. There is another opportunity there that Kimeri should request the company not to expense the school fees in the income statement so that it will become a tax-exempt benefit on him. So number 3. So Albert Kimeri should request the company not to expense the school fees in the income statement so that it will become a tax-exempt benefit on him so that he's not charged tax. So that was point number 5. We go to number 6. He was a member of unregistered pension scheme where the employer made contribution towards the scheme on his behalf. Now, there's another opportunity there. Employer contributing to an registered pension scheme, it will become a taxable benefit on him. So he should join a registered pension scheme so that when the employer contributes for him, it will become a tax-exempt benefit. So you put it down. So Albert should join a registered pension scheme so that when employer contribute for him, it will become a tax-exempt benefit. As at the stand now, it is a taxable because it's unregistered. We continue. Number 7, the wife runs a farming business where she earns 400,000 from the sale of farm produce. For that one, there is no benefit one can derive out of that. So that one we ignore. 8, he is contemplating securing a bank loan for his children education or education insurance policy that will equally cater for the children's education. So the best opportunity is to take an education insurance policy so that he can claim the insurance relief to be used to reduce the actual tax payable instead of a loan. And we say that with the lower of 15% of the premium or 5,000 per month or 60,000 per annum, whichever is lower. So we are saying that Albert should take an education insurance cover instead of a loan for the children education so that he can claim insurance relief to be used to reduce tax payable with the lower of the 15% of the premiums or 5,000 per month or 60,000 per annum, whichever is lower. So that one, or that's how you answer the question involving the tax planning for the individuals. So there are some questions that you are going to do given after this video, so you can use them and test yourself. For today, we are going to stop there until I see you in the next lesson, where we look at the tax planning for the limited company. Thank you very much.
Hi Rana, welcome to another session of Manifested Online Classes. In this session, I want us to continue with the subtopic number 1 of topic 2, that is revenue recognition under IFRS 15. Remember, in our previous class, we looked on how revenue should be recognized under IFRS 15 and also the various steps to be followed by an entity in terms of recognizing revenue. And then we went further and looked on how IFRS 15 should be applied in various contracts with customers. We have looked on how IFRS 15 is applied in hire purchase contract and also what we refer as a consignment sale. So in this particular session here, I want us to look on how revenue is recognized under what we refer as a construction contract, and we are going to see on what is the rules, the principles laid down under IFRS 15 regarding recognition of revenue under what we refer as a construction contract. First of all, when talk about a construction contract, is a contract which is entered into by an entity with a customer, whereby the entity is expected to undertake some construction work which will take substantial period of time for it to be completed, e.g. 2 years, 3 years, 4 years. And once the construction work is completed, the entity will be paid something called a construction or will be paid something called the contract price. So meaning that a company, for example, can secure a construction contract which will take maybe 3 years, and the company will be paid a contract price of a certain amount of money, maybe 100 million. So a question here arises, when should the company recognize that 100 million as a revenue? So IFRS 15 now comes in here to provide some rules regarding how that particular revenue should be recognized. But even before you look on that, maybe we can define what is a construction contract, and then we see how the revenue should be recognized as far as these particular contracts are concerned. So we can say this is a contract where an entity is expected to undertake construction work which is expected or which will take substantial period of time to be completed. So mean that if an entity or basically a company secure a construction contract, and that construction work will take substantial period of time. When talk about substantial period of time, we are talking of a period beyond one financial year. That construction work will take a substantial period of time for it now to be completed. That is known as a construction a contract. Now, what you have said is that IFRS 15 set out some rules regarding how the revenue should be recognized under such a contract, of which, according to that standard, revenue here should be recognized based on the progress of work. Based on what? The progress of work, or basically revenue should be recognized based on the work which has already been completed. And because in this case we are saying that construction contract will take maybe 2 years, 3 years, what the entity which is undertaking that particular construction work should do, so that it can be able to determine the amount of revenue to be recognized in each financial year, is to estimate the percentage of completion. To estimate the percentage of of completion, of which in this case we are going to look on the various methods which may be used by an entity in terms of determining the percentage of of completion. But even before we look on those particular methods, we can say that here revenue will be recognized. We can say revenue from construction contract will be recognized or is recognized based on the progress toward completion, completion, i.e. revenue is recognized based on percentage of completion, of completion. So the revenue to be recognized in any financial year, in this case we are saying, will always be based on the percentage of what? Completion. The percentage of completion. Basically, what that means is that if, for example, the company has secured a contract, a construction contract, and maybe at the end of the first year, the contract, for example, is 30% complete. Is 30% complete? We're going to look on how this percentage of completion is determined. We have various methods. Assuming at the end of the first year, the construction cost contract is 30% complete, and then the contract price, which the company is to be paid by the customer, is something like 500 million, then the amount to be recognized as revenue in the first year, here we are saying should always be based on what? The percentage of completion. Take the percentage of completion, multiply that with what we refer as the contract price. So that will give us now 150. So that is now the revenue which is supposed to be what? To be recognized. That's why we are saying that according to IFRS 15, the revenue here should always be recognized based on the progress toward what? Completion, or in very simple terms, revenue will be recognized based on the percentage of what? Of completion. Now, how do we determine this particular percentage of completion, which then is used by the entity in terms of determining the revenue to be recognized in a certain what? Financial year. So let's look on methods. Methods of determining percentage of completion. Methods of determining percentage of completion. So we have a number of methods, around 5 methods. So the first method is known as the cost to cost method. A cost to cost method. So under this particular method here, the percentage of completion of a construction contract is computed, or basically is determined based on the cost which has been incurred to date in proportion to the total estimated contract cost. So mean that to determine now the percentage of completion, under this particular method here, what do? We take cost incurred to date, all over total estimated cost, all over total estimated what? Cost, and then we multiply that with 100. So that's how we determine the percentage of what? Of completion. And basically this is the common method. This is a common method which is used in terms of estimating the percentage of completion. So the other method number two, we refer to it as the output method. So this particular method here, or under the output method, the percentage of completion is determined based on the output achieved so far. So if, for example, the company has secured maybe a construction contract, and that company is expected to construct maybe some residential houses like 100 units, and maybe at the end of the year, the company has been able to construct like 10 units. So in that case, what we do here to determine the percentage of completion, take the units which have been completed 10, divide that with what? The total units which are expected to be completed times 100. Times what? Times 100. So mean that here, to determine the percentage of completion, what we do is that we take the output achieved to date, and then we divide that with the total expected output. Times what? Times 100. So that is the other method which is used in terms of estimating now the percentage of what? Completion. So the other method, we refer to it as the survey of work performed. Survey of work performed. Now, when talk about the survey of work performed, survey of work performed method, what generally happen here is that an entity or the company which is undertaking the construction work will engage a third party. Will engage a third party or even an expert to be able now to visit the site whereby the construction work is being undertaken and be able to assess the percentage of what? Of completion. So therefore here, the percentage of completion is determined by a third party or an expert by assessing, going to the field and basically checking the work which has already been done, and maybe from his experience he can be able to advise the entity that work is complete up to which percentage, and the entity now will use that particular percentage in terms of determining the revenue to be what? To be recognized. So therefore here we can say a survey is conducted by a third party, or an expert to determine percentage of completion. To determine the percentage of what? Of completion. So here we don't have any computation which is done, but we are saying that the entity here will engage who? An expert or even a third party to do what? To go to the site and be able to use his experience and advise the entity the percentage of completion of that particular what? Work. Then from there, we have the other method which is called technical estimates. Technical what? Estimates. So when talk about the technical estimate method, so here the entity will use, for example, the engineer to do what? To estimate now the percentage of what? Of completion, or in other terms, to advise the entity on the percentage of what? Of completion. So therefore, we can say that this entails use of an engineer, entails use of what? Of an engineer, use of an engineer to do what? To estimate percentage of completion, of a construction contract. And once now the engineer is able to do that, he has estimated the percentage of completion. He will go ahead and do what? Advise the company on the same. Advise the company on the same. So then we have the last method which is used in terms of doing the same, estimating the percentage of completion, which is called the time-based method. The time-based method. So when talk about the time-based method, so here the revenue will be recognized, or in other terms, the percentage of completion will be estimated or will be determined based on passage of time. Meaning that if, for example, a company has secured a contract and the company expect that that contract or that construction contract will be completed in the next 3 years. So mean that once the first year is over, then the company can say that that contract is 30% complete, and therefore the revenue now to be recognized in the first year will be a third or maybe 30% of the contract price. So therefore here we can say that revenue here will be recognized. Revenue is recognized based on the passage of time, time, or in other terms, we can just say that the percentage of completion here is determined based on the passage of what? Based on the passage of time. So there was a question which was there in the past papers and which was requiring you to explain some of these particular methods which are used by the entity in terms of estimating now the percentage of completion of a construction contract. So I also give that as an assignment at this point. Assignment, this is a question for May 2019, which is question number 4B. So that question was requiring you just discuss two methods used in terms of determining the percentage of completion, of which, remember, you have said that these are like the two common what method, output, and also what the cost to cost method. The cost to cost what method. Make sure you check on that particular question and you attempt it. You also what attempt it. Then from there, I want us now we proceed and look on the accounting treatment of this particular construction contract. So the revenue which is recognized, the cost which is recognized in a certain financial year, and also how the profit is arrived at as far as the construction contract is recognized, is concerned, that is, and how an entity determines something called a contract asset and also a contract what? A contract liability. So let's look on the accounting treatment. Accounting treatment of a construction contract. Construction contract. So once a company has secured a construction contract, at the end of each year, the company should determine the profit or the loss to be recognized as far as that particular construction contract is concerned. So an entity should do what? Determine the profit or what? The loss to be what? To be recognized. We are going to look on how this profit or loss to be recognized in a certain financial year is determined. And two, an entity should be able to determine something called the contract asset or liability to be recognized in the statement of financial position. Remember, this is a profit or loss. This one should be recognized in the income what? In the income statement. So let's start by looking on how we determine the profit or the loss to be recognized in a certain financial year. A profit or loss to be recognized. Profit or loss to be recognized. So how do we determine this? So number one, we take the revenue. We take the revenue to be recognized in that year, and the revenue to be recognized in a certain financial year as far as the construction contract is concerned. This one we have said is always based on the percentage of what? Completion. Percentage of completion. The first thing you need to do as far as the construction contract is concerned, you determine the percentage of completion, because we are saying according to IFRS 5, the revenue to be recognized in a certain financial year always is based on the percentage of what? Completion. So determine the percentage of completion, and basically I've said these are the two main methods. Actually, this is the common one. This is a common one whereby you take the cost incurred to date all over the total estimated cost. So take the percentage of completion, then multiply that with the contract price. Multiply that with the contract what? Price. So you'll get now the revenue to be recognized during that financial year, and then to this you lay something called the cost of sales. So how do we determine the cost of sales? The cost of sales equally, this one is equal to percentage of completion, a percentage of completion of a construction contract, and then we multiply that with now the total estimated cost. The total estimated cost. The total cost to be incurred for that contract to be what? To be completed. So what you get here, if a positive figure is a profit, if a negative figure is a loss, to be recognized. To be recognized during that year as far as this contract is what? Is concerned. So that's how the profit or the loss to be recognized in a certain financial year as far as the construction contract are what? Are concerned. So let's look on how we determine then the contract asset stroke liability. Number two, contract asset stroke liability. And we are saying that this is recognized as an asset or liability in the statement of financial position. So in terms of how we determine this, one, we take the cost which has been incurred to date, the cost incurred to date, the cost incurred to date, and then to this we add or less the profit or the loss recognized during that year. So the profit is added, whereas now the loss is what? Is deducted. And basically this particular profit or loss recognized, this is now what you will have computed here, the profit or loss recognized during that year. And then to this you less the amount what? Invoiced and received. Amount invoiced and what? And received. The amount which has been invoiced and what? And received. That one should be deducted. And once you do that, you can get a positive figure here or a negative figure. So if you get a positive figure, we refer to that as a contract asset. A contract asset is like what? Is like amount which the client has not yet paid. This is basically an asset, contract asset. Whereas now a contract liability, this whereby a company which is undertaking the construction work maybe has received some amount in advance. There is some prepayment by the client. So that is basically what? A liability. So this one we have said will be recognized as an asset or liability in the statement of financial position. So therefore, these are the two items which, if you come across a question maybe from this particular topic, the examiner may require you to compute. You may be required to compute the profit or loss to be recognized during a 30-year and the contract asset or the contract what? The contract liability. So we also have a question as far as that is concerned. The same question there for for May 2019, and that is part C. So that is what I want us to do as an illustration of this subtopic of construction contract. So we have May 2019. Question 4C. So we go through the question, you see what we are told, and we are told Mijego Construction Limited carries out work on 4 construction contract during the year which ended 30th April 2019. So we are given the details of the contract. So we have the first contract A01, B02, C03, D04. Those are 4 construction contract. The figures are in million of shillings. We are given the contract price, the costs to date, the total estimated cost or the estimated total cost. We have the payment on account. When we talk about the payment on account, this is now the amount invoiced and what? Received. The amount invoiced and also what? Received. Basically, this is a payment on account. Amount invoiced and what? Received. And then we have the revenue recognized in the previous period, the cost incurred in the previous periods, the administrative cost for each construction contract, and then you're given the commencement date, the date when each construction contract commenced. And then we have some additional information. You're told the company does not recognize profit until a contract is at least 5% complete. 2, the company's policy is to calculate the percentage of completion on the cost basis, meaning that the company determine now the percentage of completion using which method? The cost to cost method. 3, we are told the company prepares separate trading account for each what? Contract. So what you're required to do in Roman 1 is we prepare the trading account for each contract, showing clearly the revenue to be recognized for the year which ended 30th of April 2019. Number 2, the income statement extract for the year which ended 30th April 2019, and then an extract of a statement of financial position showing the combined totals for all what? The contract. So what is we are required as far as Roman 3 is concerned is now we determine the contract what? Asset and what? Liability. Because this contract as a contract asset or liability, we have said we take it to the statement of financial position. So therefore, we start with Roman 1, whereby we require now to prepare now the trading account for each contract. Now, even before we do that, because in that case, we are required to prepare the trading account showing clearly the revenue to be recognized. We have said that in this particular construction contract, the revenue are recognized based on the percentage of what? Completion. So therefore, the first thing we need to do here, determine the percentage of completion. From there, you'll do what? We proceed, determine the revenue to be recognized during the current year, and also the cost to be what? To be recognized. So therefore, that is the first thing we need to do here to determine the percentage of what? Of completion, percentage of completion for each contract. Which method is being used by the company here? As per note number, additional information number 2, we are told the company policy is to calculate percentage of completion on cost basis, meaning that this one is determined using this formula, the cost incurred to date, all over total estimated what? A cost times what? Times 100. So we need to determine the percentage of completion as far as the 4 contracts are concerned. I hope you can see we have 4 construction contracts. We need to determine this for each contract. So which are those contracts? We have the first contract A01, we have B02, we have C03, and then we have D04. D04. So we need to determine the percentage of completion for each of these construction contract. Percentage of what? Completion. We're using this formula here. So we take the cost incurred to date for each construction contract. The cost to date for the first one is 180. This one is 480. This one is 963.6. This one is what? 33.6. So that is the cost incurred to date, because that is a formula we are applying there. We divide that with what? The total estimated cost. Are we given that? Yes, we are given the estimated total cost. For this one is 720. Definitely we multiply that with 100. For this one is 768 times what? Times 100. This one is 1069.2 times what? Times 100. And finally, we have this one, which is 840 times what? Times 100. So we need to determine now the percentage of completion, the percentage of completion for each contract here, for each contract. So the first one, we take 180 divided by 720. So this will give us 25%. 25%. The other one, we have 480 divided by 768 times 100, which is 62.5%. What about the other one? 963.6 divided by 1069.2 times 100. And this contract is 90.12% complete. What about the last one? We have 33.6 divided by 840. 840 times what? Times 100. So this will give us 4%. For what? Percent. Equally, there is some information which are given as far as that question is concerned, and we are told in additional information number what? Number 1, that the company do not recognize profit until a contract is 5% complete. So if you check on this particular percentage of completion which you have computed here, you'll be able to see whatever you have gotten for the last contract is less than 5%. Less than 5 what? Percent. If that is the case, a contract is less than 5% complete, it means that no revenue will be recognized. No revenue to be what? To be recognized. To be recognized. No revenue will be recognized. But for the other contract here, revenue will be what? Will be recognized. So what we also need to do before we proceed and prepare now the income statement, let's determine the revenue to be recognized. The revenue to be recognized. To be recognized. Remember, I've showed you how we compute this revenue to be recognized. We say the revenue to be recognized here, revenue to be recognized here is always based on what? On the percentage of completion times the times what? The contract price. So we take the percentage of completion times what? The contract price times the contract price. So that's what we need to do here. So for the first contract, we take 25% times the contract price. The contract price is 780. But if you take on the information which you are given in that question, or in that contract, this contract commenced back in 2017, and we are required to determine the revenue to be recognized in 2019, and that's why down there we are given the revenue which has been recognized in previous years. We are given the revenue, for example, recognized in 2017 and 2018. So therefore, up to this stage, the revenue now to be recognized should be 25% of this. But in this case, we have to exclude the amount now recognized in the previous what? Years. So the amount recognized in the revenue recognized in previous years here is 78. So that will give us now the amount to be what? The revenue to be recognized during the current year. The same case for the other contract, we take the percentage of completion, 62.5, times the contract price, which is 1200, equally minus the revenue recognized in previous period, 180. So we do the same here, 90.12% times the contract price, which is 1020, minus revenue recognized in previous periods, which is 504. And here we have said that no revenue will be recognized. That contract is less than 5% what? Complete. Less than 5% complete. So let's compute this. So we take 25% times 780 minus 78. So that will give us 117. So that is the revenue to be recognized during the current year. During the current year, you have to also remember that these figures are in million of shillings. Million of shillings. So what about the other construction contract? 62.5 percent times 1200 minus 180. So that will give us 570. 570. What about the other one? 90.12 times 1020 minus 504. So which will give us 415.2. So in that case, we have said no amount which will be recognized there. No amount which will be recognized as far as the last contract says what is concerned. Okay. Yes. So I think having that, we already have now the revenue to be recognized. So before we proceed equally and prepare now the trading account for each construction contract, we also need to determine the cost to be recognized during the current year. Cost to be recognized during the current year. Remember also from our format there, we have looked on how we determine the cost to be recognized. The cost to be recognized. We have said take the percentage of completion times the total estimated cost. The total estimated cost to be incurred in completing that contract. We do the same here. Take the percentage of completion times the total estimated cost. For the first contract here is 720. But equally here we are going to less the cost recognized in the previous periods. Cost recognized in previous period is 60 million. We do the same for the other construction contract, the percentage of completion times the total estimated cost, 768 minus the cost previously recognized, 72. Here we take the percentage of completion, 90.12 times what? Times the total estimated costs, which is 1069.2 minus the cost recognized in previous period, which is 480. Equally, no cost is to be recognized as far as the last contract is concerned. So let's compute this. So here we have 25% times 720 minus 60, which will give us 120. Then we have 62.5 times 768 minus 72, which will give us 408. And then finally here we have 0.9012 times 1069.2 minus 480, which will give us 483.6. So in our case now we have what? We have the revenue to be recognized and also the cost to be recognized. So having that now, we can proceed and prepare the trading account for each construction contract. Why are we preparing that trading account? Is for us now to determine the profit to be what? To be recognized, the profit or loss to be recognized. I've said to do that, we take the revenue to be recognized, we less now the cost. And actually we have been able to determine those two items there. So let's prepare now the trading account. And this particular trading account will be showing the profit or the revenue for each contract and also the profit to be recognized during the current year. So I think we can just ignore the last contract here because no revenue, no cost to be recognized during this year. So we just consider the three contract, A01, B02, C03, and also our figures here will be in million of shillings. So we start with the revenue to be recognized during that year. So we have computed that revenue here. So we have 117, we have 570, we have 415.2, and then to this we less cost. We can just refer to that as cost of sales. So here we have 120, here we have 408, and here we have 483.6. And then from there what we get here is the profit or loss to be to be recognized during that year as far as each contract is concerned. So let's compute this. So for the first contract here we have -3, which is a loss. What about the other one? We have a profit of 570 minus 408, which is giving us 162, a profit. And the last one we have 415.2 minus 483.6. So this will give us a loss of 68.4. A loss of 68.4. So therefore that is first of all what is required as far as that part is concerned. You are required to determine that particular revenue and the cost, and automatically now we compute the profit or loss now to be to be recognized. And then from there we require now to prepare the income statement extract. The income statement, this is now for the company which is Mijengo. Remember the trading account which I have prepared here. This is a trading account which has been prepared to determine the profit or loss for each contract, contract. But in this case, the income statement will be prepared to determine the profit or loss of this company during this year. So income statement, extract. This is not for individual construction contract, but now prepare to determine the performance of the company during the current year. During what? During the current year. So how do we determine this, or how do we prepare this? First of all, we start by recording the profit or the loss recognized as far as each construction contract is concerned. So remember, in our case here we have 3 construction contract, A01, B02, C0 what? 3. So from the first construction contract there was a loss. From the other one, B02, there was a profit of 162, and finally we have a loss of 68.4. So, and then we get now the net amount, which now will be an income to this company. So we have what? We have 162 minus 3 minus 68.4. So that will give us 90.6, which is now like the total income. And then now to this we less what? Expenses. We less what? Expenses. Now, which expenses do we less here? We are lessing expenses which are general, and basically the general expenses is now what you are given as the administrative expenses. So we are given the administrative expenses for the first contract, which is 1.5, the other one 15, the other one 2.5. So the total administrative cost, this will be 4 plus 15, which will be what? Which will be 19. So which will be 19. So, and then what we get is the profit for the year. The profit for the year for this company. So that is a profit now which our company made during that year. 90.6 minus 19, which will give us 71 point what? 0.6. Yes. So that is it. That what was required as far as the Roman 2 of that question was concerned. And these are obviously the items which were to give you now the 3 marks there. So finally, we are required to prepare an extract of a statement of financial position. And here I've said what the examiner was requiring is you determine something called the contract asset or the contract what? Liability. The contract asset or the contract what? Liability. So let's have that here. Roman 3, a statement of financial position extract, showing what? Contract asset stroke what? Stroke liability. Stroke liability, and we're going to do this as far as our 4 contracts are concerned. So we have the first contract, which is A01, B02, C03, and then we also have D04. Yes, so how do we determine the contract asset or liability? So in this case, one, we have said we take the cost incurred to date, cost incurred to date, and we have the cost incurred to date from the information we have there. So here we have 180, we have 480, we have 963.6, and here we have 33.6. So to this, then we have said we add or minus the profit or the loss recognized during that year. So when we have that information here, for this, the first contract, there was a loss which was recognized of 3 million. A loss, we less it, but a profit we add. Then here we have a profit of this one, we add. Then here we have a loss of 68.4. That is a loss. So as far as the last contract is concerned, there was no profit or loss which was recognized. And finally, to this I've said we less amount invoiced and received, amount invoiced and received. And we have said the amount invoiced and received is what is known in our question as payment on account. Payment on what? On account. The payment on account for the first contract here is 156. This one we less it. Then here we have 780. We less it. Then here we have what? We have 918. We less it. And here we have what? We have 24. We have 24. Yes. So what then we need to do is to determine now the contract asset, stroke what? Stroke liability. So a positive figure is a contract asset, a negative figure is a contract what? Liability. So let's start with the first contract. We have 180 minus 3 minus 156. That will give us 21, which is a contract asset. And then we have 480 plus 162 minus 780, which will give us negative 138, which is a contract liability. And then the other contract we have 963.6 plus 68.4 minus 918, which will give us positive 114. And finally here what do we have? We have 33.6 minus 24 minus 24, which will give us what? 96, which will give us 96. And I think equally we can determine the net amount here. So we add all this, we determine whether from this 4 contract, whether we have a contract asset or a contract what? Liability, by adding all this. So you have 9.6 plus 114 plus 21 minus 138. Yes, so in that case we get a positive figure of 6.6 million, which automatically is a contract what? Asset, and that will be taken to the statement of financial position of this company as what? As an asset. As what? As an asset. So that is it, that what was required as far as that particular question is concerned, and equally that what you need to know as far as the construction contract are what? Are concerned. So therefore that brings us to the end of our lesson.
We move to question 4. Question 4. I rub this, assuming we have taken it down. Okay, so we move to question 4 of the paper. Question 4 is all computation. Part A is testing taxation of insurance companies. Part B is testing VAT. So let's start with Part A. Riziki Insurance Company Limited was incorporated in the year 2019. The company deals with different classes of insurance. The following trial balance was extracted from the books of account as of 31st December 2021. So we have a trial balance balancing at 23,420,000 shillings. So it is a trial balance, meaning it has balances of assets and liabilities, it has revenues, it has expenses and all that. So it is upon us therefore to differentiate, separate the items that we need and only pick those that we shall use to answer the question. So we have a trial balance. Additional information 1 says, claims intimated and outstanding as of 31st December 2021 amounted to 750,000 for motor vehicle insurance and 480,000 shillings for fire insurance. So this is a question testing
taxation of general insurance. Remember, the activities of an insurance company could be in the form of general insurance and life insurance. So the rule is where an insurance company offers both general insurance and life insurance or life assurance, then the two are treated as separate businesses and they are taxed separately. So this is on general insurance. And general insurance again can have different classes. Like in this case, we have motor vehicle insurance and fire insurance. So let's analyze the additional information. One says claims intimated and outstanding as of 31st December 2021 amounted to 750,000 for motor vehicle insurance and 480,000 shillings for fire insurance. Now claims are almost the major expense of an insurance company. So just like in any other businesses, we can have claims outstanding at the beginning and at the end of the year. So here we have three figures that we shall have to adjust for each of these. We have claims outstanding, that is accrued claims brought down, that is at the beginning of the year. We have claims paid during the year and claims outstanding or accrued at the end of the year. So in short, we shall have to adjust the claims account so that we determine the figure to the income statement. 2, an earned premium is maintained at 80% and 50% of the net premiums received for motor vehicle and fire insurance respectively. An earned premium is maintained at 80% and 50% of the net premiums received for motor vehicles and fire insurance respectively. Now what do we do? In tax, the government taxes taxpayers on income earned, not necessarily what is received. So what we shall do here is simple. We shall work out the net premiums received. Net premiums received is simply total premiums received less premiums returned. In insurance business, as a company, you can receive premiums from your insured, but then because of certain reasons, you may have to return. So net premiums received is simply the difference between the two. So what we shall do is simple. Determine the net premiums received, then deduct the unearned premium so that we only tax that which has been earned. 3, investment allowances have been agreed with the commissioner at 1.2 million shillings for the year ended 31st December 2021. Investment allowances have been agreed with the commissioner at 1.2 million shillings for the year ended 31st December 2021. Now, this insurance company has non-current assets, like the first item in the trial balance is property, plant and equipment at 10.2 million shillings. We know this depreciates, but for tax purposes, depreciation is a disallowable expense. Instead of depreciation, we allow for what we call capital allowances or investment allowances, which are computed at a uniform rate for all businesses. 4, so we shall allow this as an expense instead of depreciation. 4, investment income analysis. So in the trial balance, we have an item they are calling investment income, a total of 4.15 million, sorry, 4,150,500. 4,150,500. So this is the analysis. 1, we have interest received from government securities, 2,040,000 shillings net. Net here means after withholding tax has been deducted. So interest received from government securities, 2,040,000 shillings net. Now, interest income is subjected to withholding tax at the rate of 15%. So net here means this figure is 85%. Now, the next thing is, how do we treat interest income received by a company? This is a company. Now, for companies, withholding tax of 15% on interest income is not final tax. So what we shall do is simply to gross the amount given, that is get 100% of it, tax the 100%, but when computing the tax liability, we shall deduct the withholding tax of 15% already paid. Next, we have interest received from local banks. Interest received from local banks, 760,500 shillings net. Net again means after withholding tax of 15% has been deducted, the treatment is the same. We shall gross the amount, tax the gross amount, deduct the withholding tax already paid when computing the tax liability. 3, we have dividend received from a Ugandan company. Dividends received from a Ugandan company. That reminds you to remember your treatment and classification of dividends. Now, this is dividend received from a Ugandan company, meaning it is a dividend income received from outside Kenya. The rule is that is an exempt dividend. So remember your classes of dividends. We have exempt dividends, qualifying and non-qualifying. So this being an exempt dividend of 450,000 shillings gross means without, or rather before any taxes, we shall leave it out as an untaxable income. We have dividend received from a local company of 900,000 shillings net. 900,000 shillings net again means after withholding tax has been deducted. For dividend income, withholding tax rate is 5%. So that means this is 95% of the figure earned. So this is dividend received from a local company. Now the correct classification is this is a qualifying dividend. So what we shall do is simple. Qualifying dividends are dividends whose withholding tax is final tax. So we shall not tax it again. We shall not tax this again because it is already net of withholding tax. 5. Fees paid to investment managers amounted to 750,000 shillings for the year ended 31st December 2021. Fees paid to investment managers. This is an allowable expense, and so we shall show it as one of such. Required: 1. Taxable income or loss for Riziki Insurance Company for the year ended 31st December 2021, and 2. Compute the tax payable, if any. So this is what we do. We say we are answering question 4A. So we show each class in a separate column. So we have motor vehicle insurance, motor vehicle insurance. We have fire insurance. Then we have total here. Then show the currency. Okay. So we start with the premiums. So if you look at the trial balance keenly, there are a number of items touching on premiums. So 1, we have gross premiums received from direct clients. So we can start with that. Gross premiums received from direct clients. So motor vehicle, we have 3 million. Fire is 2.5. The sum should be 5.5 million. Next, we have gross premiums received from agents. So gross premiums from agents. Motor vehicle is 2 million. Fire is 1.2 million. That should be 3.2 million. You can get, if you go to the trial balance again, down we have what they are calling premiums returned. That is payments that were received from clients but paid back again. So we have motor vehicle is 800. We deduct, this is 700, a total of 1.5 million. Another thing touching on premiums is whether here up to here we can get net premiums received. Net premiums received. So net premiums received is total premiums received less what was returned. So for fire we have, this is So motor vehicle, this is 5. 5 minus 8 is 4.2. So we write here 4.2 million. This is 37 minus that is 3 million, a total of 7.2 million. Then we use information 2 to work out unearned premiums. So we say less unearned premiums. That is 80 and 50% respectively. 80% for motor vehicle and 50% for fire. So we begin, we get 80% of 4.2 million. That is 3360. 3360. So up to there we can get earned premiums. So that will be 3360 from 4200. I get 840,000. We move here. 50% of 3 million is 1.5 million. Less that is 1.5 million. So total earned premium for the year will be the sum of the two. 840 plus 1.5. That should be 2340. This is 15 plus 3360. 4860. Good. Next, we add other taxable income. So we say add other taxable incomes. Add other taxable incomes. We only pick those that are taxable. So we make use of the trial balance and the additional information. One, we have what they are calling commission. Sorry, before we go to other taxable income, there's something else touching on premiums. We have what they are calling reinsurance premiums paid. That is, insurance premiums paid by this company to a reinsurance company. So we should deduct that so that we have what we call net premiums. So we say reinsurance premiums paid. So for motor vehicle it is 400. For fire it is 150. That is 550. So we get the difference again. We get net premiums. This is 440. This is 1340. 1350. 1350 plus 440 should be 1790. 1790. Up to there, we now bring in other taxable income. So say add other taxable income. So we separate the other incomes and only use those that are taxable. One, we have what they are calling in note 4 investment income. Investment income. One, we have interest from government securities. So we write here interest from government securities. So the amount is net, so we gross it. So we shall do 100 over 85 of 2040. We do that together. 100 over 85 times 4, 2040. That gives me 2400, 2.4 million. We add it here. Next, we have interest from local banks. Interest from local banks. The same process, 100 over 85 times 760.5. We do it together. I get 894. 894.7.71. Yes. Dividend from Ugandan company not taxable. Now, in exams, if you don't make use of any item provided in the question, please explain why under your notes and assumptions. So you can say under notes and assumptions, one, that dividends from a Ugandan company is an exempt dividend, hence not taxable on Riziki Insurance Company. Again, I repeat, dividends from a Ugandan company are exempt dividends, therefore not taxable on Riziki Insurance Company. Two, dividends received from a local company are qualifying dividends because withholding taxes have already been deducted. So you can say dividends received from a local company are qualifying dividends, hence not taxed beyond withholding tax. Dividends from local company are are qualifying dividends, hence not taxable beyond withholding tax. We go to other incomes, if they are there. We have what they are calling commission on reinsurance ceded. That is a taxable income, commission on reinsurance ceded. So that reminds you to be able to understand what we call commission on reinsurance ceded and commission on reinsurance accepted. So commission on reinsurance ceded is a taxable income. Commission on reinsurance accepted is an allowable expense. We bring it here. We say commission on reinsurance ceded. For motor vehicle, we have 700. This is 300, a total of 1 million. Any other income? We do not have any other, so we can get total income. Total income. So remember, we are asked to get total taxable income of the company. So we are basically interested in this column here. So we have 1790 plus 2400 plus 894.71 plus 1 million. That should be 6,084.71. That becomes the total income of the business. Because we are using the gross profit approach, we move to the next step and say less allowable expenses. We only use those that are allowable. So we go to the addition information 1, which is about claims. So we run claims as working 1. So I want to run working 1, which is about claims. So I can do it here, then we shall wrap. So working 1, claims. So we run claims account. Claims account. So we start with motor vehicle. We are carrying 3 zeros. So if you look at the trial balance keenly, we have what they are calling claims outstanding as at 1st January 2021. That is accrued claims brought down. So motor vehicle, we have 1.1 million. So we write here, balance brought down 1.1 million. Then have balance carried down, information 1. Claims outstanding as of 31st December 2021 amounted to 750,000 for motor vehicles. So we write here 750. Then we debit the account with the claims paid. So we write here bank. So claims paid for motor vehicle is 2770. 2770. Balance of the account. We do it together. 2770 plus 750 is 3520. 3520. Income statement, that is allowable claims, will be that minus 1100, which I get to be 2420. So that will be the allowable claims for motor vehicles. We do it for fire, claims account fire, insurance. The same procedure with the same rules. Balance brought down, that is accrued claims at the beginning of the year for fire is 840,000. Balance carried down, that is information 1 is 480. Claims paid, bank, fire is 2110. Balance of the account 2110 plus 480 is 2590. 2590. Income statement, that is allowable claims for fire insurance, index 840, 1750. And with that we have the allowable claims. So here we have 2420. Here we have 1750. Get the sum of the two. I get 4170. And with that we are done with the claims. We are done with this working, so we can grab it. We move to other allowable expenses. We have information 3, which is about investment allowance. So I said those are allowable instead of depreciation. So we write here investment allowances or capital allowances given at 1.2 million total for the year, that is. Information 4 we have talked about, that is the analysis of investment income. Information 5 is about investment managers fees paid. So investment managers fee, a total of 750,000 for both. And up to there we are done with the additional information. We go back to the trial balance and identify any other allowable expenses. So be very keen. 1, we have commission on reinsurance accepted. Commission on reinsurance accepted for motor vehicle is 600, fire 200, a total of 800. Next we have sundry receivables, that is a balance, not an expense. Bank balance is a balance, an asset, not an item, not an expense. We have directors fees. This is a company, so directors fees are allowable expenses. Directors fees is 495 in total. We bring it here, 495. Reinsurance premiums paid we have dealt with. Claims outstanding at the beginning of the year we have dealt with. Claims paid we have dealt with. Legal costs on claims are allowable expenses. Legal expenses on claims. Motor vehicle is 280. This is 130. 130 plus 280 should be 410. 410. Sundry expenses on motor vehicle claims are allowable expenses. Sundry expenses on motor vehicle claims, a total of 220. Nil for fire, so total is 220. Management expenses are allowable expenses. So management expenses. Motor vehicle 450, 380. That should be 830. Investment income we have dealt with. Premiums returned we have dealt with. Profit and loss account is a balance, not an income, not an expense. So up to there, we can now get taxable income. So taxable income will simply be total income less total allowable expenses. So there are two ways of doing it. You can either deduct each of these from the total income, so that would mean we bracket each of them, or we can get total allowable expenses, have it here, then we deduct it from our total income. So let's use the first method. Good. So this is what we are interested in. So we get total taxable income. Be very keen. So taxable income is total income less allowable expenses. So we have 84.71 less, we are here, 4170, 1200, 750, 800, 495, 410, 220, and 830. 830. I have 279, 2790, 2790.29, but negative. So in short, this company realized a loss during the year 2021. So that is part A, Roman 1. Part A, Roman 2 is asking, compute the tax payable, if any. Tax payable, if any. Now, tax is imposed on income. And for a business firm, income is basically profit. So because this particular firm made a loss or realized a loss in this particular year, it is not liable to any tax. So we simply give an explanation for that. So we say, part 2, you can write, Riziki Insurance Company Limited is not liable for taxation for the year 2021 because it realized a loss and not a profit. So the company is not liable for taxation in the year 2021 because it realized a loss and not a profit. Then you can go ahead and say tax is imposed on incomes or profit, that is for business purposes. Tax is imposed on income, in bracket profit, but not losses. Yes, so that explains why for this particular year, this company would not have to pay any corporation taxes. And that marks the end of part A of question 4. The topic being tested here is advanced taxation of business income, that is advanced aspects of taxation of business income. The topic is a must in the exam, and in each paper you'll meet at least 2 questions from that particular topic. So be very keen and make sure you understand every bit of it. With that, I want us to move to part B of question 4. Let me wrap this. Part B of question 4. Now, part B of question 4 is a mathematical question again, testing VAT. So that reminds you to have VAT at your fingertips. Know the theory around VAT, it's so much, and then know how to compute VAT and the applicable rules. So I read, be very keen. Zawadi Associates provides consultancy services to various clients whose terms of contract allow clients to pay for the services either before or after the provision of the service. The following information is provided regarding the firm's transactions for the months of October, November, and December in the year 2021. The following information is provided regarding the firm's transactions for the months of October, November, and December in the year 2021. So we have a table of 4 columns. The first column is the nature of the service or transaction. Second column is value of the transaction. The third column is service provision date, and then the last column is payment date. So we have a number of transactions and then all those details. Additional information 1. Siloc Investments was declared bankrupt on 30th November 2021. Now, Siloc Investment was one of the customers, one of the clients, and we are told it was declared bankrupt on 30th November 2021. Let's look at the table and understand what happened in that transaction. So, the transaction was management consultancy to Siloc Investment. The value of the service was 1,440,000. The service provision date was 13th November 2021. Payment date was 40% paid on 30th November 2021. 40% paid on 13th November, meaning 40% of the amount was paid on the service delivery date, and the rest was to be paid later. Then come to information 1. This client was declared bankrupt on 30th November. What does that mean? If a debtor is declared bankrupt, it means you cannot recover the debt from them. So it means you have to write it off. And that means you'll have to, it will reduce the amount of VAT you will collect from this debtor. So what we do is simple. We shall show this as a transaction, yes, but it will be a reduction under output tax. 2. On 5th November 2021, Zawadi Associates renewed its National Industrial Training License for 30,000 shillings and paid for legal fees of 360,000 shillings to follow up on clients who were not paying as per the agreed date. So it had two transactions. One was renewal of industrial training license fee at 30,000. Then 2, it incurred a legal fee of 360,000 to follow up on clients who are not complying with the terms of the contract. So we have to determine if these are vertible or non-vertible items. Now, renewal of industrial trading license fee is not, renewal of national industrial trading license is not a vertible item. So yes, this is an expense, but it will not attract VAT. Legal fees are professional services, and so they will attract VAT. 3. Electricity bill paid on 10th November 2021 was 270,000, out of which 100,000 shillings was payment for outstanding bill for October 2021, and 20,000 shillings was in respect of additional deposit as demanded by the power company. So let's get it keenly. Total amount paid was 270,000 on 10th November. 100,000 out of that was payment for October, and then 20,000 was a deposit for the following month. Now, what does that mean? It means, in short, not the entire 270,000 was relating to November. So what we shall do is simple. We are going to explain what we call tax point, and in this case, we shall have to split this 270,000 for 3 months. 100,000 for October, 20,000 for December or after November. Then the difference, that is 270,000 minus 100 minus 20, that should be 270 minus 120, which is 150, is the amount relating to November. Good. 4. Fuel consumed for partners' vehicles amounted to 90,000 during the month of November 2021. Fuel is a vertible expense, and so we shall charge VAT on that. So we are told it was 90,000, and we are told it was for partners' vehicles. So this means it was for business purposes. Remember, one of the rules in VAT is you can only claim input tax on business expenses or business items, but not private or personal expenses. Computers purchased for business use cost 240,000 in November 2021. Again, this is for business, and so it will attract VAT. Zawadi Associates paid rent for the month of November 2021 amounting to 180,000 on 5th November 2021. Zawadi Associates paid rent for the month of November 2021 amounting to 180,000 on 5th November 2021. Now, rent is not a vertible item, So we can show it, yes, under input tax, but the rate will be nil. It is an exempt item. 7. Transactions have been stated inclusive of VAT at the rate of 16% where applicable, unless otherwise stated. Now, when computing VAT, the figures given may be inclusive of VAT to mean the figures already have the VAT amounts within them. So that means if the VAT rate is 16%, then the figures are at 116%. So in that case, be very keen, the VAT rate applicable will be 16 out of 116. So this is where the figures are given inclusive. But where the figures given are exclusive of VAT, it means they do not have the VAT amounts within them. So the figures are around 100%. So it means the VAT rate will be 16%. So this is exclusive. Be very keen on that. Many students confuse the two and they end up with wrong figures, and that makes them fail. Required. 1. Compute the VAT payable by or refundable to Zawadi Associates for the month of November 2021. November 2021. So remember, we have transactions affecting, or rather touching on October, November, and December. So the question is, compute the VAT payable or refundable to Zawadi Associates for the month of November 2021. Now, this means we have to understand something called tax point. Now, tax point in simple terms is simply the date or the time when VAT is deemed due and payable. The date or time when VAT is deemed due and payable. Now, for local supply, that is for transactions within the country, tax point is the earliest of 4 dates. The earliest to mean that which comes first. 1, the date the services are supplied or the products are supplied or sold. 2, the date when the date when an invoice is issued or received. 3, the date payment is made for part or full settlement of the transaction. And 4, the date a certificate is received. That is in case of transactions requiring supervision, like in constructions where an architect certificate has to be issued and all that. So what we do is simple. Look at each and every transaction, locate the tax point, and if the tax point is November, then we shall capture that transaction in November. If it is not in November, we shall leave it out, because the question is, we compute the VAT payable, refundable for the month of November. So let me use the first transaction, for example. The first transaction was audit services to XL Supermarkets. Audit services to XL Supermarkets. Value of service was 700,000. Service provision date 25th October 2021. Payment date was 5th November 2021. So you can see the service was provided on 25th October, but then the payment was on 5th November. So what does that mean? This transaction should be captured for VAT purposes in the month of October, but not November. So what we do is simple. Analyze each transaction, then locate the tax point. If it is within November, capture it under November. We answer that. So this is question 4B. So we say Zawadi Associates value added tax computation for the month of November. For the month of November 2021. So we start with output tax. Output tax is the VAT on sales. Output tax. We arrange it like this. We have date, we have details, we have gross amount in shillings, VAT rate, then VAT amount in shillings. So remember, we have to determine the tax point. So transaction 1 was audit services to XZ supermarkets. The service provision date 25th October. Payment date is 5th November. So that was captured in October. We don't bring it under November. Next, we have training services to Kyle Securities, provided on 3rd November and not yet paid for. So that means the tax point is November. So we write here 2021 November. So the date was November 3rd. The customer was Kyle Securities. The value of the transaction was 240,000. And we are told this is inclusive of VAT. So that means the VAT rate is that 16 out of 116. So we do 16 out of 116 times 240,000. I get 33,103. Sorry, 33,000. Sorry, 16 out of 116 times 240,000. 33,103.45. Next, accountancy services to our total children's home on 5th December 2021, the service provision date. Payment date was 20th November. So November comes before December. So tax point is November 20th. Watoto Children's Home. Watoto Children's Home. Now, Watoto Children's Home is, the value is 600,000. This is a service provision to an NPO, a non-profit making organization. So, for such, it is nil. That is nil. Debt collection services to Zoella Computers. Service provision date 9th November. Payment date 30th November. So again, this is a November transaction. We take November 9th. That is Zoella Computers. Zoella Computers. Paid 20,000. 16 out of 116. 16 out of 116. 20,000. I get 113, 103.45 again. Next we have strategic plan development to Bazo, that is Rwanda Limited. So the company is in Rwanda. So what does that mean? This was an exported service. For exports, we know VAT rate is nil, 0%. So we write here, the service provision date was 10th November, not yet paid for. So it means it is a November transaction. So we say Bazo, in bracket Rwanda Limited. The amount is 2,150,000. The rate is 0%, meaning the amount is 0. We have management consultancy to Siloc Investment. Service provision date 13th November. 40% paid on 30th November. The rest not yet paid, meaning it is a November transaction. The tax point is in November, that is. So we write here Siloc Investments. 40,000. 16 out of 116. 16 out of 116 times 40,000. I get 198, 620.69. 620.69. Lastly, we have financial consultancy to W. Before that, we have internal controls reviewed of Lema Limited, value 960,000, service provision date 18th November, but then payment date was 7th October. So it means the payment came before the service provision date. So that means the tax point is in October. So we don't capture that in November. Lastly, we have financial consultancy to W Limited. Service provision date 20th November, payment date 1st December. So we pick 20th November. So we say W Limited, 1.2 million. 16 out of 116. 16 out of 116 times 1.2 million. 165,000 517.24. Then we have information 1, that is Siloc investment being declared bankrupt on 30th November. So that will reduce the VAT from that in client. So let's understand it. When the service was provided on 13th November, 40% of the amount was paid. That is 40% of 1440,000. Then the rest was not yet paid. And this is on 30th November. So we are not losing the entire amount. What we are losing is simply the VAT on 60% of 1.44 million. So that is what we need. So 60% of 144 million, I get to be 864,000. We should deduct times 16 out of 116. I get 119, 172.24. We deduct because it was a loss, a bankrupt issue. All the rest are transactions affecting input tax. So up to here we get what we call total input tax. Total output tax. That is total VAT on sales. We be very keen. 103.45, 113.103.45, 198.620.69, 165.517.24 less 119.172.24. I get 391.172.59. That gives me total output tax. That is step 1. Step 2 is to get out input tax. That is the VAT on purchases and expenses. The same arrangement. So, but we are getting input tax. So we are going to follow the same procedure. But now we are looking at expenses and purchases. Again, we must be keen on which expenses and purchases attract VAT, which ones do not. So I move to information 2, which is about renewal of National Industrial Training License at 30,000 and then legal fees of 60,000 paid on 5th November. So I come here, write 5th November. One, we have National Industrial Training License at 30,000. That does not attract VAT, so the VAT rate is nil. Still on the same date, there was legal fees incurred or paid of 360,000. Legal services are professional services attracting VAT, so that. So 16 after 116 times 360,000 should be 49,655.17. Information 3 is electricity paid on 10th November. So we write here electricity, but we have to break down the figure. Total amount paid was 270,000. 100,000 out of that was for October, then 20,000 was a prepayment for December, meaning the amount relating to November is only 150,000. So write that. Electricity is a variable expense, so we charge. So 16 after 116 times 150,000. I'm getting 20,689.66. 4, we have fuel for the partners' vehicles at 90,000 paid in November. So we can write here 10 fuel. That is at 90,000. Fuel is a petroleum product. Petroleum products attract VAT currently at 8%. So if this is inclusive of VAT, it means it will be 8 out of 108. So we shall have 8 out of 108 times 90,000. That is 6,666.67. Then we have computers purchased in November at 240,000 for business purposes. So computers 240,000 for business purposes. I am getting 33,103.45. Note 6. Zawadi Associates paid rent for the month of November amounting to 180,000 on 5th November. So rent is not a variable expense. The amount was 180,000. The rate is nil. The amount is nil. Transactions have been stated inclusive of VAT. So up to here we get total input tax. Total input tax. The sum of all that, 49,655.17 plus 2689.66 plus 666.67 plus 33,103.45. I get 114.95. That is total input tax. The next step now is to compute VAT payable or refundable. Now in this case, this trader had both taxable supplies and non-taxable supplies. So what we do therefore is to restrict the deductible input tax. So we say VAT payable or refundable is equals to output tax less deductible input tax. Deductible input tax is equals to taxable supplies divided by total supplies times input tax. Taxable supplies are simply those supplies attracting VAT, that is, sales at standard rate and sales at zero rate. Total supplies will be taxable supplies plus now the exempt sales or those sales attracting VAT at nil rate. So we go back to our output tax table output tax table. So if you are keen, we have supplies attracting VAT at standard rate, those at nil rate, and those at zero rate. So to get the numerator here, this figure here, we add all the transactions attracting VAT at nil rate, sorry, at zero rate and at standard rate. So look at the table keenly. We pick everything, that is the gross amount for every transaction, except those attracting VAT at nil rate. So if you are keen, if you are there, we have the list. There is one transaction attracting VAT at nil rate, that is the supply to Watoto Children's Home, which I said is an NPO. So it means we get the sum of everything except that 600,000. So do it with me. We have 240,000 plus 820,000 plus 2150,000 plus 1440,000 plus 1.2 million, then minus 864,000, that is the budget written off. So I get 4986,000. So we say this is equals to 4986,000. To get the numerator, simply add exempt transactions to that figure. And in our case, we only have one of 600,000. To that figure, we add 600,000. I get 86,000 times input tax. Input tax is here, 114.95. So we get it together. So we have 4986,000 divided by 5586,000 times 114.95. I get 98,287.35. Therefore, we say VAT payable. It is VAT payable where the total output tax, our total output tax we got to be 391,152, is more than the deductible input tax, which is 98,287. Where it is the other way around, it becomes VAT payable. So it's VAT refundable. So we say therefore VAT payable will be equal to 391,152 .12 minus 98,287.35. We do that. So 391,152.12 minus 98,287.35. I get 292,864.77, and that becomes the VAT payable for this particular month of November 2021 by this firm. And that marks the end of question B, part 1. We move to part B, Roman 2 of the question. It says, Zawadi Associates is planning to engage a firm of financial management consultants from South Africa to facilitate online training on financial management assignments. Zawadi Associates is planning to engage a firm of financial management consultants from South Africa to facilitate online training on financial management assignments. Advise Zawadi Associates on the tax point in respect of such services. Advise Zawadi Associates on the tax point in respect of such services. This is again touching on what we have been talking about. Now, in this case, this company is planning to engage a firm of consultants from South Africa. So what does that mean? It means, in short, it will be importing this particular service from South Africa. Now, the rule is that for imported products, that is for imported goods and services, tax point is the earliest of 3 dates. earliest of 3 days. Number one is the date when the service is provided. 2, the date when payment is made in full or part settlement for the contract. And 3 is the date when the invoice is issued. So in short, you can say tax point for imported services is the earliest of the following 3 dates. Tax point for imported services or products is the earliest of the following 3 days. 1, the date when the services are rendered or provided. 2, the date when an invoice is received. And 3, the date when payment is made in full or part settlement for the contract. So in short, for Zawadi Associates, the tax one, that is the date when they have to account for that particular transaction under VAT, will be earliest of those 3 particular days. And that earns you the 3 marks awarded there. And that marks the end of question 4. Yes. Again, that reminds you that VAT is a very common exam area. Be very familiar with it, know the theory part of it and the computation part of it. The rules as well around VAT computation. A very important part is to know the classification of supplies. We know not all supplies are VATable, so we should know which supplies are VATable at standard rate, which ones are VATable at 0 rate, and which ones are VATable at, which ones are exempt supplies. Yes, and that is it.
Welcome to Manifested Publishers. We pick it on question 2. We read the question. We say that with an aid of a well-labeled diagram, explain the concept of production possibility frontier. That is PPF. We put it on the board. We say with that's 2A, with the aid of well-labeled diagram, explain the concept of production possibility frontier. Production possibility frontier. With the aid of a well-labeled diagram, explain the concept of production possibility frontier. That is PPF. That is PPF. With the aid of a well-labeled diagram, explain the concept of production possibility frontier. The first thing that we need to understand is that what is a PPF? A PPF we need to understand is a locus or point joining together different combination of 2 goods that can be produce an economy when resources are fully and efficiently utilized. So we have the diagram. On this other end, we can call it consumer goods. We can have down here producer goods. So we have our PPF. So there's a point along the PPF curve. We can call it P. We have Q. We have R. We have S. And then finally we have T at this. Then we have points that are inside the PPF curve. And then we have points that are basically outside the PPF curve. So very important is to understand that this is the PPF curve. This is the PPF curve. And to the core, we need to understand what basically happens at each and every point of the PPF curve. The first point is the point on the PPF curve. So we say that P, Q, R, S, and T, we say represents, those ones basically represents attainable with the country, with the country level of resources, with the country's level of resources, with the country levels of resources and technology, assuming that the resources have been basically have been fully employed. That is attainable. So we can look at a point that is point N, that is into bracket outside. We call it outside the PPF curve point. That is outside the PPF curve, a point that is outside the PPF curve, a point that is N outside, cannot be attained. That one cannot be attained with the given, we say with the given level of resources, and technology. So that point that is outside the PPF curve, that is N, is unattainable. Then we have point M, that is inside. We call it inside the PPF curve. That is a point that is basically inside the PPF curve. So represent, this is basically represent, we say represents unemployment, represents unemployment. That point basically inside represent unemployment or inefficient or inefficient use of resources, or inefficient use of resources. Just to emphasize what we have done, we say that number one, that the PPF curve is a locus of point joining together two different combinations of goods that can be produced by a firm when resources are fully and efficiently utilized. So we have the points that are on PPF curve. Those points are attainable with the country levels of resources and technology, assuming that resources are being fully employed and no wastage. We need to and no wastage. Assuming that resources have been fully employed and there's no wastage. The second one is the M. That is the point that is outside the PPF curve. We say it cannot be attained with a given level of resource and technology. Then we know that the point that is inside the PPF curve, that basically represents unemployment or efficient use of the resources, inefficient use of resources. Some of the areas that as learners need to maybe be emphasized on is uses of the PPF curve. You know, as you look at that question, one of the things that needs to come into your mind is what are the uses of PPF curve? What are the uses of where do we apply the PPF curve? That is a good area that learners need to actually emphasize on, and that is how we tackle that question. That is question 2, Roman A. Question 2, Roman B. Argue 3 cases in favor of foreign direct investment, that is FDI, in least developed countries. We put it down. We say B, that is 2B. Argue 3 cases. 3 cases in favor in favor of foreign direct investment, foreign direct investment, into bracket FDI, into bracket FDI, in least developed countries, in least developed countries. On that particular question, one of the first things that needs to be understood is what is the FDI? That is a direct investment by a host country in the productive asset of a foreign country. So in this case, for example, you have countries investing in productive assets in the least developing countries. So what are arguments in favor? When you talk about arguments in favor, we are basically talking about advantages of the FDI in the least developing countries. One of the first advantage that we know that fill the gap in resources, fill the resource gap in least developed countries. Number one, fill the gap, fill the resource gap in the least developed countries, in the least developed countries, fill the resource gap in the least developed countries. The second advantage or in favor of FDI, we basically talk about promote creation of employment, promote creation, what we call creation of employment, promote creation of employment in the, we say, in the least developed countries. In the least developed countries. Number three, we can talk about promote investment, what we call promote investment in the least developed countries. We say number four, we can talk about promote transfer, promote transfer of technology, transfer of the technology through skill transfer, through the skills transfer, through the skills transfer. So promote what we call technology through the transfer of the skills. But apart from that very question that we've talked about, we can also look at, as learners, you can also look at areas, for example, factors that will promote FDIs in the developing countries. Again, an examiner could also ask on the next maybe exam that are to come in the future, arguments against now the disadvantages of FDI. So those are some of the areas that needs also to be assessed by learners, needs also to be looked at by the learners. That is how we tackle that question. That is question 2, Roman B. We pick it on the next question, that is question 2, Roman C. C, Roman 1, explain the term consumer equilibrium. So say we write the question, that is C, Roman 1, explain the term consumer equilibrium. Explain the term consumer equilibrium. When you talk about consumer equilibrium, we basically say that consumer equilibrium is a point where the budget line is basically tangent to the indifference curve. So consumer equilibrium is the point where the budget line, line is tangent to the indifference, curve, where the budget line is basically tangent to the indifference curve. We say that consumer equilibrium is a point where the budget line is basically tangent to the indifference curve. Key things that we are able to establish when we are defining, or when we draw, or when we look at consumer equilibrium, because we have two commodities, that is on the y-axis could have good y, on the x-axis we could have good x. So at that very point we are able to establish equilibrium quantity of good y, and at the same time we are also able to establish the equilibrium quantity of the good x. That is how we go about that question. We pick it again on question 2, Roman C, that is C Roman 2. Using a well-labeled diagram, using a well-labeled diagram of indifference curve, illustrate the consumer equilibrium position. Illustrate the consumer equilibrium position. So we draw that consumer equilibrium position. So we have it on this other end, consumer equilibrium position. We can have the budget line. First of all, the budget line, we call this A, and we call that B. We call that A, and we call that B. We have indifference curve 1, so that is IC1. We have indifference curve 2, that is IC2. We have indifference curve 3, that is IC3. We have indifference curve 4, that is the IC4. So where is the consumer equilibrium? It is basically established at indifference curve 2. Basically established at indifference curve 2. So this is good y on this end. I have good x on this. So I have xe on this, then I have basically ye at that very point. So we have established equilibrium position. So we know that IC1 to IC3, IC1 to IC3, IC1 to IC4, IC1 to IC4 is the indifference curve. Then you have here is E, indifference curve. We have that as the indifference curve. We know that point E is what you call consumer equilibrium. We call it consumer equilibrium point. That is E is what you call consumer equilibrium point. And then we are also able to have YE, equilibrium quantity of Y. Then XE, that is equilibrium quantity. We call it quantity of X. Equilibrium quantity of X. We know that that is equilibrium quantity of X. Equilibrium quantity of X, that is for XE. Something that we also need to establish, we need to understand that AB is basically the budget line. AB is basically what you call the budget line. So the explanation, we need to understand that a consumer will always want to be at high indifference curve. If you look at that, consumer will definitely would want to be a consumer will always want to be at higher indifference, what you call the higher indifference curve, because we know that because there is higher, what you call higher satisfaction. And the point that we know that E, the consumer equilibrium position, and we find it at IC2. E at IC2, consumer equilibrium position, where the budgeter line is tangent to indifference curve 2, where the budget line is basically tangent to the indifference curve 2. So when you look at that, this particular question, one of the things that we are able to establish, is that the first part is the diagram. Though the diagram indicate what each level means, so together we've drawn the diagram, we've indicated, and we've also shown the equilibrium position that the examiner requires, and we've also explained that point and what happens to the indifference curve and why a consumer would want to be at a high indifference curve. We know that the higher the indifference curve, the higher the level of satisfaction. That is how we approach that very question. We pick it on question 2, that is Roman D. Summarize 4 types of unemployment in least developed countries. So that is D. Summarize 4 types of unemployment in least developed countries. So the first thing that we need to understand is to understand the question, what is unemployment? And the second thing is least developed countries. So whenever we talk about unemployment, is a scenario where we have people who have the qualification to work and are willing to work, but there is not employment. Least developed countries, these are countries that are not yet there in terms of at higher level of development. That is what we call least development countries. So what are these type of unemployment that are there in least developed countries? One of it we can talk about open unemployment or naked. Open stroke naked unemployment. So whenever we talk about naked unemployment, we're basically saying that people are willing to work, but there's no work to do. People are willing to work, but basically there's no work to do. And that we experience in least developed country. That is to say, this is a condition in which people have no work to do. This is a conditions in which people have no work to do. They are willing and able to work, but there is no work. There is no work to do. There is no work basically to do. So we proceed to what we call the second one, what we call structural unemployment. We said that on the structural unemployment, these are what we call due to structural changes. What are these structural changes? Change in demand, change in taste, and change in fashion would cause unemployment. So we have it what we call structural unemployment. unemployment. We say this is due to the structural, this is due to the structural changes in the economy. Structural changes in the economy. We say, for example, changes in fashion, tastes, and demand. These are some of the factors that we find that in a least developed country would cause unemployment. That is a structural unemployment. We proceed to the next. The next we can call it, we can have what we call unproductive. Number 3, unproductive. We call it the unproductive unemployment. We call it the unproductive unemployment as one of the unemployment that occurs in least developing countries. So when you talk about unproductive, workers do not have necessary tools of work. As a type of unemployment, it occurs as a result of workers not having necessary tools to work. Occurs when workers do not have what you call necessary tools of work. When workers do not have necessary tools of work. We can have the 4. We can call it seasonal unemployment. Seasonal unemployment. So whenever we talk about seasonal unemployment, we are basically looking at temporary. When you talk about type of unemployment, we know that results from temporary. The word is temporary. Results from temporary work. For example, where do we get them? Construction. Where do we get them? I.e., when you talk about seasonal is common changes in season, not temporary, but that should be change in the season. Not temporary. Temporary should be casual. This we call it due to changes in the seasons. For example, we say tourism, where we have a peak and off-peak seasons, where we have peak season and then we have off-peak season. So where we know that, for example, the periods, when you talk about, for example, periods that are peak season, where we know that there's a lot of employment. Peak season and off season. Peak season, there is employment, especially the December. Peak season, there is employment, and off-peak season, off-peak seasons, there is unemployment. That in tourism sector, that is what we call seasonal unemployment, that we basically experience what we call off-peak season. We can have the last one. We just discussed the last one. Casual unemployment as one of unemployment. Casual unemployment as one of the type of unemployment that we basically experience, in the least developed countries. These are temporary. We call it temporary employment. For example, i.e., in the construction, we call it in the construction sector. So when you talk about constructions of road, this, remember, basically a casual employment where you have them for a particular time, they're very temporal. And after that time, the individuals that are basically engaged in such works will definitely lose their work, will definitely lose the work. And as we conclude on that, key areas that learners need to assess. You need to look at why is unemployment a major policy issue in the least developing countries. What causes unemployment? What causes unemployment? What is the relationship between unemployment and relationship? That is the Phillips curve. That's also a very good area that learners or those that are particularly preparing for exam need to look at. And that is how we assess that very question.
Dear learner, welcome to our continuing lessons in human resource management on the platform of Manifested Publishers e-platform. Today we are going to look at the subtopic of human resource administration. So the subject is human resource management, and the topic that we are going to look at today in human resource management is human resource administration. And this topic of human resource administration has several subtopics. We are going to get an opportunity to look at employee contracts, which are very crucial in human resource management. We are also going to look at human resource records management. We will also look at human resource management information systems, employee welfare services. Then we'll also look at health, safety, policies, and procedures. Then we will also look at basics of payroll management. And ultimately, we will be able to have a look at employee discipline. So our subtopic today is employee contracts. Employee contracts. So Lana, welcome to the lesson. So what we need to appreciate as students and those interested in human resource management is that employee contracts, like in any other engagement, are very critical and central in terms of the agreement between the employer and employee. And when it comes to employee contracts, these ones are agreements that may be entered into orally or in written between an employer and an employee in relation to terms of service. So employee contracts refer to agreements that are entered into between an employer and an employee regarding a service of employment. Employee contracts may be oral or in writing. So dear learner, it is important to appreciate that employee contracts refer to agreements that are entered into between an employer and an employee regarding service of employment, and employee contracts may be oral or may be in writing. Now, the burden of ensuring that the employee contract is in writing, according to the law, is placed on the employer. So as a human resource practitioner, you will be expected to ensure that regardless of where you are as an employee or an employer or representing an employer, employee contracts are entered into. So what are some of the basic information in contracts of employment? Basic information in contracts of employment. Basic information in contracts of employment. So it is important, learner, that a contract of employment captures some basic information, and this basic information is what can be used to enforce a contract of employment in cases of a dispute between an employer and an employee. So the first thing that should be there, names of employer and employee. Names of the employer and employee. This is very important so that this identifies that this contract is between employee A and organization B. That is very important, that must be captured. Then there is the element of the job title. Job title. So if, for example, the employee is being employed as an office administrator or as a company secretary, then that one should be indicated that this is the name of the employee, and the job title for which this employee is being employed is, for example, company secretary, is, for example, human resource manager, for that matter. Then duties and responsibilities. You may have location of work. Then you also have duties and responsibilities. Duties and responsibilities of that given employee. Then you may have terms and conditions of employment. Then you may also have number 6, the date when the contract is signed. The date when the contract is signed. 7, the commencement date. Date of the contract. You may also have an indication of the law that may prevail or be used in case of a dispute. Like, for example, if this is in the Kenyan situation, then the Employment Act 2007 may be used. Then 9, the working hours. Working hours of the employee. Then you have number 10, the privileges. Privileges and benefits. Then you have 11, leave entitlements. Then you have number 12, termination requirements. For example, notice, pay in lieu of notice. And then number 13, union representation. Now, dear learner, when it comes to the basic information, this will vary from position to position, but these are some of the aspects that need to be covered. And When you talk about the name of the employer and the employee, we have discussed that. The title, we have said, for example, the employee could be a company secretary, or human resource manager. So that has to be indicated. Then the location of work, maybe this particular person, the work, maybe the person is based in Nakuru or Nairobi. So that has to be indicated. Then duties and responsibilities that this particular individual may be doing. Then here there'll be specifics. Specifics, for example, if it's the company secretary in charge of the company secretarial duties in that particular organization, if it is a human resource manager, then it could be, for example, recruitment, training, reward management. Then when it comes to terms and conditions, now the terms and conditions will indicate, for example, is this particular individual entitled to, let's say, a car, or maybe a house, or reimbursement, or to authorize certain things and so on. Then the date when the contract is signed, that is very critical. Commencement date of the contract, the law that may be used, and we have said here, for example, in Kenya, for example, Employment Act 2007 could be the law, the main law that may be used if this particular, for example, contract is in the Kenyan situation. Then you have the working hours. Maybe this employee is supposed to have maybe a 40-week work, or maybe the employee is supposed to have 8 hours per day for 5 days. And this could, for example, be indicated that this is from Monday to Friday. So then that becomes very clear that these are the working hours of this particular employee and so on. Then you have privileges and benefits. For example, if this employee has to travel, maybe air travel, you may say the employee is entitled maybe to business class or economy class, for example. So that has to be indicated for purposes of administration of this particular contract. Then you have leave entitlements. So this particular person could, for example, have 30 days annual leave, for example, per year. Then you have termination requirements in terms of notice, maybe 1 month notice, 2 weeks notice, pay in lieu of notice if the person has to leave, union representation. And in the union representation, this is where applicable. Some of the employees may not be unionizable. So these are just some of the basic aspects that should be captured in a contract of employment. There are also other aspects that are also critical. For example, an employee may be in terms of maternity leave, or paternity leave, that is also important. Then you also have what you call public holidays. That is also important to be indicated. Then you also have allowances that may be specific to this particular job and so on. Then you also have confidentiality clauses. For example, in some organizations, an employee may be informed that the employee will not be able to participate in the kind of business the employer is doing until, say, after 2 years. So that then becomes a confidentiality clause that the employee is supposed to participate in and so on. So, dear learner, these are just some. We can go through them again. We have indicated that employee contracts refer to the agreements that are entered into between an employer and an employee regarding a service of employment, and these employment contracts can be oral or can be in writing. Now, what are some of the basic aspects that should be covered in a contract of employment. So one, we have indicated names of employer and employee is important. Then the job title, for example, company secretary or human resource manager. Then the location of work where the employee will be performing their work, for example, Nakuru, Nairobi, and so on should be specified. Then duties and responsibilities should be specified. Specifics should be provided. Then terms and conditions of employment under which that employee is operating must also be provided. Then the date when the contract is signed, that is important. Then the commencement date of the contract. Then the law that may be used or may prevail in cases of disputes. And we have said in Kenya, the employment contract is governed mainly under the Employment Act 2007. Then the working hours of the employee, for example, 40 hours per week or 8 hours per day for 5 days from Monday to Friday, that should also be indicated. Then privileges and benefits, for example, air travel. Will the employee travel business class or economy class? Leave entitlements. The contract must be very clear that this particular employee is entitled to 30 days, maybe in a calendar year. Then there is the element of termination requirements, for example, notice, pay in lieu of notice, that should also be provided. Union representation, where applicable, should be indicated. Maternity leave, if the employee is entitled, for example, to 90 days maternity leave and maybe 14 days, maybe paternity leave, that should also be indicated. The public holidays should be indicated that in any given one calendar year, this particular employee is able to enjoy the public holidays, then allowances due, then confidentiality clauses. And what we are saying, dear learner, these ones are just some of the aspects. There are others, for example. How will sickness be handled? And this one brings us to what is called sick leave. Sick leave. It is important that it is indicated if an employee falls sick, maybe the first, say, 30 days, the employee will be on sick leave, maybe with full pay. That is important. Maybe the next 30 days, employee will be on sick leave, maybe with half pay. So that should come out very clearly in the contract of employment. So confidentiality clauses, sickness, terms of sick leave, and also aspects like grievance handling procedure, and other aspects like now intellectual property. Intellectual property. So when it comes to aspects like intellectual property, some workers may come up with some inventions. So if an employee comes up with an invention, how will that be handled? It's very important. The grievance handling procedure should also be documented very well. So Lana, these are some of the aspects that should be brought out very clearly, and failure to bring out these aspects in the employment contract sometimes has created a lot of challenges. So we have come to the end of our lesson today, and before we finish, I need to give you an assignment which you need to work on. Assignment, and your assignment is assess the basic information that should be contained in a contract of employment. So dear learner, this is your assignment for today's lesson. Assess the basic information that should be contained in a contract of employment. So until we meet for the next lesson, I want to thank you for being active in our lesson today, which was employee contracts, a lesson on employee contracts, which is a subtopic in our human resource management administration unit under the human resource management subject of the certified secretaries. So thank you very much.
At this moment, we can look at a question on how to tax a sole proprietor. So here is the question. I'll read and then I'm going to show you how the tax is usually determined. This is what the question says. Lois Rubandi is a sole trader operating as Lloyd Traders. She did not maintain proper accounting records but has provided the following information relating to her income and expenditure for the year ending that 1st December 2015. We have the summary of cash transaction for the year ending that 1st December 2015. We have the receipts, balance brought down, trade receivable, cash sales, commission received, capital. We go to the side of the payments, trade payables, cash purchase, salaries and wages, rates and insurance, medical bill for self, transport, bank charges, general expenses, loan interest, new motor vehicle, drawings. Summary of assets and liability as at January 2015 and that 1st December 2015. We have as at January 2015, as at that 1st December 2015. We have furniture, written down value, motor vehicle, written down value, trade payable, inventory, trade receivable, salaries and wages, due, prepaid rates, commission received in advance, capital. Additional information: number 1, discount allowed and discount received during the year amounted to 5,600 and 151,200 respectively. During the year, she took goods for free from the business worth 100,000 for her own use. Depreciation was ascertained as follows: motor vehicle 25% per annum on book value, furniture 12.5% per annum on book value. Bad debts written off during the year amounted to 72,000. Required taxable income for Royce Rubandi for the year 2015 and the tax payable, if any, by Royce Rubandi. So we are supposed to, number 1, required, we get the taxable income of Royce Rubandi. So we said, whenever you are told to get the taxable income, first thing that you normally ask yourself, which approach am I supposed to use whenever you are taxing a business? Is it the gross profit? Is it the net profit method? From the question, we said net profit method is used when net accounting profit or loss or income is provided. From the question, there is nothing like that. And so if it is not there, so the first thing is to check if there is net accounting profit or loss or income provided. If it is not, then it is not provided, then automatically we use the gross profit method. Gross profit method, we said, we usually start with the sales. We less the cost of sales. We know, you can remember how we said you get cost of sales, opening stock plus purchases, less closing stock, minus any item that reduced the stock during the year. We get the cost of sales. Then sales minus cost of sales, we get gross profit. Then we add taxable operating income. We list them, and then we list the allowable expenses. We list them. Now, and then we compare, we take gross profit plus incomes minus allowable expenses. But we say that before you do any question on the gross profit, determine the first item that you are supposed to use, the sales. Have you been given the total sales? If not, then the first thing that you do, you have to determine the total sales. 2, have you been given the total purchases? If not, then you have to determine the total purchases so that you can prepare the statement. So in this case, we ask ourselves, have you been given the total sales? In the question, we are only given the cash sales. But just above the cashes in the summary of cash transaction, there is trade receivable, telling you that there was some evidence we sold on credit. So how much did we sell on credit? So that we add to the cash to get the total. We said if you are not given the credit sales, you have to open the debtors or receivable account to determine it. Then you add to the cash sales, then you get the total sales. 2, have you been given the total purchases? If you haven't been given, then you have to determine. In this case, have we been given? No. We are only given one part of these purchases, the cash purchase. So, but were there some evidence there were some credit purchase? Yes. Just above the cash purchase, there is the trade payable. What does that mean? We had purchase on credit. So we have to determine the credit purchase. We add the cash purchase so that we can get the total purchase so that we can use it. So this is how you go about it to determine the total sales and total purchases. We say total sales is equals to the credit sales plus cash sales. The best way to do, you see the cash sales we have been given. What we need to find is the credit sales. Now leave a space here. When you're doing it on your own, leave like 1 or 2 lines here, where now you'll be posting the figures. When you get the credit sales, where you post the cash sales, where you post, so that when you add the two, you get the total. Then for you to be able to get the credit sales, we said you open the debtors or receivables account. So you come here after the 2 lines or so, debtors or receivable account. What you do once you open that account, balance at the beginning of the period, write it there. This is the debtors at the beginning. But don't look for it, no. You are just preparing a structure to help you to get the credit sales. Then you jump. The best way is to jump like 5 lines here, 5 or 4, and then the balance at the end, as we had said when we introduced to the taxation of the business, balance carried down for the debtors, you'll post them here, debtors. You'll post them, but don't look for them. It's just a structure. Then these lines represent where we will post the totals, but now balance at the end we'll post here. And then we come to the purchases. We haven't been given the total purchases. How do we get it? So we say total purchases is equals to credit purchases plus cash purchases. Now, as we have seen, we have even been given the cash purchase. So what we need to find is the credit purchase. To get the credit purchase, we open the creditors or payables account. Same case, we jump like 2 or 1 line here. Then you open the creditors or payables account. Now, for the creditors, we start with balance at the beginning of the period here. Balance brought down. That is for the creditors. There. Then jump like 4 or 5 lines, as we said with the other one, and then have the balance carried down for the creditors here. Then at the end, you'll get the total. You'll get the total. In this case, what we normally do, we go through the whole question. If we come across a cash sales, we'll post here. If we come across something that affects the debtors or receivable here, if it increase the debtors as we had said initially on this side, if it reduce the debtors on this side, then we come to the creditors. If we come across something that affects the cash purchase here, if it affects the creditors, increase the creditors. Creditors being a liability, we post it on this side. Creditor, if there is any information that reduces the creditors, you put on this side, because as liability they reduce, you normally post them on this side. So let us go through the question and find out if there is any of such item. We start with the first paragraph. Don't ignore anything. We are told Lois Rubandi is a sole trader. She did not maintain proper accounting records, but has provided the following information relating to her income and expenditure for the year ending that 1st December 2015. There is no information that affects these items here, so ignore. Summary of the cash transaction for the year ending that 1st December 2015. We start with the debit. There is the receipt. On the side of the receipt, we have the balance brought down. Balance brought down at that point, it is the cash at the beginning. Cash at the beginning, we ignore. That doesn't affect. The next one is the trade receivable. So trade receivable, we have it here, and we can see it is on the receipt side, meaning we got money from the trade receivable. Trade receivables are debtors paid. When debtors pay, it reduces the debtors, so we post it on this side. So receipt, they have paid, and they paid 1226,200. 1226,200. After that, there is cash sales. Cash sales, just below the cash sales that we have here, 5620,000. Place it there. After that, commission received. That doesn't affect. The other one is capital. Capital doesn't affect. We go to the payment side. Trade payables. If you have trade payables on the payment side, that means that they paid their payables. So meaning payables reduced. When payables reduced, you post on the debit side. So you come here, payment, which we have 1005 200. Then we continue cash purchase. Cash purchase, just below the cash purchase where I told you to leave some space, 1620. 800. Then after that, salaries and wages, that doesn't affect. Rates and insurance doesn't. Medical bill for self doesn't. Transport doesn't. Bank charges, no. General expenses, no. Loan interest, no. New motor vehicle, no. Drawings, no. That's the drawings of cash. Then we go to the summary of assets and liability as at January 2015 and December 2015. We have furniture's return on value, no. Motor vehicle, no. Trade payables, yes. Here we have the balance at the beginning for trade payable, 985,000. 985,000. And the other one at the end is 1180,000. So 1180,000. After that, we have the inventory, no. Trade receivables, yes. At the beginning, 781 here. 781,000. Then at the end, 821,400 here. Now that is the time that you're supposed to post when you come across the figures or the items. Then salaries and wages due, prepaid rate, no. Commission received in advance, no. That doesn't affect. Capital, no. Additional information, number 1, discount allowed and discount received during the year amounted to 5,600 and 151,200 respectively. Now, discount allowed reduces the debtors. When you give debtors discount allowed, it reduces what they are supposed to pay you. So you come here, discount allowed. So discount allowed, which we have 5,600. And then we have discount received. Discount received, you receive from the creditors, people you owe money. So you'll have here discount received. Discount received, which we have 151,200. There. Then we continue. Number 2. During the year, she took goods for free from the business worth 100,000 for her own use. That does not affect any one of this. She just took goods from the business for her own use. Doesn't affect. Then number 3, depreciation was sustained as follows. Depreciation does not affect any one of this one. We go to number 4. Bad debt written off during the year amounted to 72,000. Bad debt does. So bad debt is usually from the debtors. That people, some people who have refused to pay and you have written them off. When you write them off, it means that it reduces what you are demanding from them. So you have it here. Bad debts written off. Bad debts written off, which you have 72,000. 72,000. Now you note that is the end of the question. Now what you do is to do the summation. Now we start with the debtors or receivable account. We want to know how much was the credit sales, which is supposed to be the balancing figure. The balancing figure. How do you do that? Take the totals on this side and write them here. We have 12,26,200, and then we add 5,600, and then we add 72,000, and then we add 821,400, which we get 21,7,200. Then this one should be the same as on this side, 21,7,200. Then the difference between this figure and what we have posted on this side, if we had like three, this one and the other two, the difference is the one that we post here as the balancing figure, but we only have one, so we minus 781,000, which gives us 1389,200. Now that we have the credit sales, we transfer here, so 1389,200, and then we now add the cash sales to get the total sales. So we add the cash sales, which is 5620,000, and then 5620,000, which give us 7,009,200. There. Now we come to the creditors. We want to get the credit purchase, which is supposed to be the balancing figure. We take the totals on this side, which is 1,005,200, and then we add 151,200, and then we add 1180,000, and then total, which is 23,36,400. Then we'll have the same here, 23,36,400. Then we minus the totals on this side. On this we only have one for now. If we had two figures, the three, we could have minused them. So 90,85,000, which gives us 13,51,400. There. We have the credit purchase. Now we can transfer the credit purchase here, 13,51,400, add the cash purchase. So we add cash purchase of 1620,800. 1620,800, which give us 29,72,200. There. Now we have our total purchases and our total sales. From there we can prepare the statement. So we come here, the name of the business, it is the Lloyd Traders. So you come here, Lloyd Traders, sole proprietor, taxable income, for the year ended 31st December 2015. So we'll have a column where we'll be posting the figures. And as we had said about the gross profit method, we start with sales, of which case now sales is the one that we have determined here, 7,009,200, and then we less cost of sales. For the cost of sales, we start with opening stock. Opening stock is in the summary of the assets and liabilities. Inventory at the beginning, 1241,600 plus the purchases. The purchases is the one that we determined here, the 2972. 2972,200. We minus the closing stock, Closing stock, which we have 14,600. And then remember to minus any item that reduced the stock during the year. And we say items that reduce the stock during the year are like damaged, stolen, withdrawn stock. For this question, we only had one price. Number 2, during the year she took goods for free for the business worth 100 for her own use. And they are goods. They must be goods, not cash or when silent. When silent, just ignore, because in that case you cannot assume they are goods. Only when they are goods or inventory that they do or we do come and deduct them here. So she withdrew 100,000. Now, having no other, we close the bracket and get the total. The total, that is the net, 1241 600, and then we add 2972, 2972 200, 2972 200, and then we minus 1480 600, and then we minus 100, which we get 33 200. And that will give us the gross profit. So gross profit, which would be, we take 7,200, and then we minus that figure, which give us 43,76,000. After that, we usually add other taxable operating incomes. Now, the best way to do it, instead now for you to go and look for the taxable operating income which you list here. Remember, we had looked at the topic on the on an area on taxation of operating income or taxable operating income. Now, instead of looking for them, it will be a waste of time. The best way is leave a space of like 3 or 4 lines here, and then now less. Remember, in the statement when you're using the gross profit, we said once you add the taxable operating income, you less allowable expenses. So you have left 3 or 4 lines, and then now you have less allowable expense. I want to underline, because these are headings of the figures that will be posting, or the items that will be posting, of the taxable operating income here and allowable expenses here. We need to go through the question, look for a taxable operating income which will be posting here, allowable expense here. We start from the summary of cash transaction, because up there in the first paragraph there's nothing. The first, under receipts, balance brought down, we say that's the cash at the beginning of the period. We ignore. It is not an income. It's just a cash we had when we were starting the period. Trade receivable, that we used it to get our debtors here, our sales here. The other one is cash sales. It was used to get the sales. Commission received. Commission is an operating income, not an investment, and it is a taxable operating income. Now, having gotten the commission, what you do is this: check around if there is any other place that commission has been mentioned. If you go to the summary of assets and liability, there is another commission received in advance. So what do you do? When you have it, somewhere else it has been mentioned, have commission income here. Then open a bracket. Of the information given, if something increases the item like commission add, it reduces the commission less. Like now, and also, if the commission is relating to this year, you add. If it is relating to another year, you minus. That's simple logic. Anything for this year, you add. Anything for another year, you minus. Like if we start with the commission received, you see it is that in the transaction for this year, commission received in the year, it is for this year. So we add. We add 124,000. Then, in the summary of assets and liability, commission received in advance, and we have at the beginning and at the end. Now, if you receive commission in advance when you are starting the year, ask yourself, you are receiving it in advance for which year? Don't look at when it was received. Look at it is relating to which year. When you receive it in advance at the beginning, it is for this year, the year we are taxing. Like in this case, it is the year 2015. Received in advance in January, it is for the current year. Yes, it was received last year, yeah, because it was received in advance by the beginning. It must have been received last year, but it is for the current year. Anything for this year, we add. That's what we have said. So we have 80,000. Then commission received in advance at the end of the year. When you receive commission at the end in December, it must have been for the following year. So not this year, for the other year. So in that case, we minus 136. So we need to compute the net. So we say plus 124,000 and then plus 80 and then minus 136, which give us 68,000. 68,000. Then we go back to where we found that commission. We found it in the summary of cash transaction for the year. Then continue from there. Don't jump anything. Consider everything provided. After commission, there is capital. Capital, yes, it is not even an income, because capital, it is what the owner introduced into the business to assist him to run the business, you know. So that's not an income, and it's not even an expense. We go to the payment side. Trade payables, we used that to get the purchases. Cash purchase, we used it here. Salaries and wages, that is an expense. And salaries and wages, we said is a allowable expense. Unless it is related to the owner, it is allowable. So we'll have here salaries and wages. But as we said, before you post it, check if it is mentioned somewhere else. It is mentioned in the summary of assets and liability. Almost in the middle, there is salaries and wages due. Higher, we have to adjust it the way we said. We start with the one that was paid in this year. If it was paid in this year, it must be for this year. We add 1660, 400. Then we go to the summary of assets and liability. Salaries and wages due at the beginning. Due at the beginning, it must have been for last year, because it is what the arrears that were supposed to be paid last year, but they were not paid. So which year are they relating to? It is last year. Yes, they will be paid this year. Actually, they are in this 1660,400, you know, because it's arrears for last year. They must have been paid here, but they are not relating to this year. The workers offered the service last year, only that they were not paid. So since it is not for this year, minus, and we minus the 184,000. And then we have salaries and wages due at the end of the current year. At the end of the current year, that is for this year now, because it is workers offered the service this year, only that we didn't have money to pay them by the end of the year, but they rendered the service this year. So the income was generated, the one they assisted to generate was for this year. That one we add. We add 150,000. Now, because there's nowhere else we have salary being mentioned, we can get the net. So 1660, 400, and then we minus 184,000, and then now we add 150,000. So in this case we get 1626, 400, which we minus. And it's also important for me to mention that this one we normally do it this way, instead of opening the salaries and wages account or even the commission account where you try to get for commission for this year, the one that you bring here, or this, it will give you the same, but that's a long process. It's a wastage of time. Just do it this way. Then we go back to where we found the salary. After the salaries and wages, there is rates and insurance in the cash transaction. Rates and insurance, that's allowable because they are for the business. They are allowable expenses. So we'll come here, rates and insurance. Now we check if it is mentioned somewhere else. Rebate rates and insurance. Yes. If you go to the summary of assets and liability, there is prepaid rates, that last item. So we have to open a bracket there. And we start with the rates and insurance in that year. The one that was paid, it is for that year. We add. And we add 320,800. 320,800. Now, when you come to the prepaid at the beginning, you see when you are starting the year, January, and you have a prepayment, that must have been for the current year. You are prepaying for the current year. That we add. We add 50,000. And when now you get to the end of the year and you have a prepayment, you are prepaying for the following year, which means whatever you paid this year, part of it was for next year, that one you minus. So we minus 72,000. Having no other place it has been mentioned, we get the net, which would be 320,800, and then we add 50,000, and then we minus 72,000, which give us 298,800. There. We go back to where we found that rate and insurance in the cash summary. After rates and insurance, medical bill. Medical bill is allowable, but the problem this time is for self. And we said here, when you are taxing a sole proprietor, any expense relating to the owner, private expense, we don't allow. This we even said when you are looking at the general allowable and non-allowable expense. And an unallowable, anything to the owner, we don't allow. Private expenses. So that is not allowable. We won't deduct. The other one is transport. Transport is allowable and it isn't mentioned anywhere else. So transport. Transport, which you have 56,400. After transport, bank charges. Bank charges are also allowable. They are for business and they are not mentioned anywhere else. Bank charges. Which we have 3,000. 3,000. After that, general expenses. General expenses are also allowable. There are small expenses that are put together for the business. General expenses. General expenses, which you have 145,400. The next one is loan interest. Loan interest, we said interest on money borrowed and invested in business is allowable. So loan interest, allowable. Amount, 120,000. After that, new motor vehicle. Fixed asset, we said we don't allow. We allow capital allowance. Of which case we said motor vehicle, capital allowance at the rate of 25%. Capital allowance, written in short as CA, motor vehicle, 25%. But check whether you have the balance at the beginning. We take the balance at the beginning. If you go to the summary of assets and liability, at the beginning we had a motor vehicle, 960, of which case will be 960. Then add the one that was purchased in that year, which was 600,000. With nothing more, get the amount. That will be 960,000 plus 600,000, giving us 1560,000 times 25%, which give us 390,000. We go back and continue. After the new motor vehicle, drawings. Drawings, we said they are private expense. They are for private use. We don't allow them. Then we go to the summary of assets and liability. Furniture. Furniture is a fixed asset. We claim capital allowance on it. So we'll have capital allowance on furniture and fitting, in short. So 10% off. We start the balance at the beginning, 120. And there was no addition of furniture. There is nowhere we are told about addition. So we just take 10% of 120, which gives us 12,000. After that, we go back. Summary of assets and liability for furniture. We have considered motor vehicle. We had considered already. It's there. Capital allowance. Trade payables. That's not an income, not an expense. Inventory, not an income, not an expense. Trade receivable, not an income, not an expense. Salaries and wages, we had considered. Prepaid rates, we had considered. Commission received in advance, we had considered because we had met them earlier. Capital, no, that's not an income or an expense. Additional information, number 1, discount allowed and discount received during the year were 5,600 and 151,200. Discount allowed is an expense and an allowable one. We'll have discount allowed. Which we have 5,600. Then discount received 151,200. That is an income and a taxable one. We had said that when we were looking at the general taxable and non-taxable income. Discount received, a taxable operating income, 151,200. Then additional information number 2. During the year, she took goods for free from the business worth 100,000 for her own use. That's an expense, yes, but it's not usually allowable, we said, because it's for private use. Number 3, depreciation was ascertained as follows. Remember, we said depreciation is not allowable. What we allow are the capital allowance in taxation, which we have considered. So ignore. Depreciation is not allowed. Number 4, bad debts written off during the year amounted to 72,000. Trade bad debt written off are allowable. Unless we are told they are not relating to the trade, to the business, they are allowable. Bad debt. And take note, don't confuse with provision. Provision are the one that we say specific provision we allow, general provision we don't. Bad debt are bad debt, and they are allowable as long as they are relating to the business. Bad debt written off, which we have 72,000. Bad debt is the last item provided. So what do you do now? We are done. We now have to get, we come now to the end here, we get net taxable operating income. So from operation, how much is the total taxable income? That means that we take the gross profit plus this income minus the expenses, allowable expenses. We start with 43,76,000. Then we add 68,000. And then we add 151,200. And then we minus 1626,400. And then we minus 298,800. And then we minus 56,400. We minus 3,000. We minus 145,400. We minus 120,000. We minus that 390,000. We minus 12,000. We minus 5,600. Then we minus 72,000. It gives us 18,260. So what we do is this. This being a sole proprietorship business, we had said earlier on, we tax the sole proprietor on his or her own income. So once you get the net taxable operating, add taxable investment income. So you add taxable investment income. If operating income is positive like this one, if the operating income is negative, you carry it forward to next year to be deducted against the profit of next year. Remember we said we carry forward a loss up to a maximum of 10 years. Now, if you look at the question that we have, there is nowhere we are told about investment income for now. But if you had non-qualifying dividend, remember those are dividends which withholding tax is not final. Non-qualifying interest, interest which withholding tax is not final. Royalty income for resident withholding tax is not final. Rental income for commercial buildings, for residential above 15 million per year, we should add them here. But for this question we don't have, so we would have a dash. And so meaning we can now get total taxable income, which would be the same because the investment is 0, 18, 20, 600. And required number 1 ends there. Now we have the taxable income. What we had said, the first thing is to determine the taxable income. The second one now is to determine the tax payable. Criteria of determining the tax payable. Now we have to tax that income on that individual, and which we said that sole proprietor do not have separate legal entity from the business. So the income of the business is taxed on the owner. So how do we tax? We had said at graduated scale rates in the same way as employment income. So we want to look at how we tax that income. We are going to use the scale rate that was used in the year 2022. But the concept is the same. What happened is that if the rule changes, and the reason why we are looking at year 2022 because we are looking at the exam of December 2023, if the rule change, you find that the table just changed, but the concept of getting what you are, the computation is or remain the same. So I'm going to delete this part here so that we can see how we can tax the 18,600 to get the tax that is payable by this sole trader. So to come here, tax payable. So we want to get the tax payable. So if you look at the income that we have, it is 18,600. Now there is a table that is given by the examiner in an exam, or the question, as long as you are doing the question about tax, you will be given first page. And as we have said, we are using the table that was used in the year 2022, but it is relating to the year of income of 2021. But that's the one that we are going to use. So if you look at the top there, there's somewhere with the rates of tax, including wife employment income, self-employment income, and professional income rates of tax. Year of income 2021. Assume that the following rates of tax were applied throughout the year of 2021. We have the monthly taxable pay, annual taxable pay, rates of tax. Because we are taxing an year income, not 1 month, it was for the year ending 2015, 1 year, we use the annual taxable pay, which starts between 1 shilling to 288,000. The percentage is 10%. Between 288,001 to 388,000, 25%. Excess over 388,000, 30%. So if you look at the income that we have there, 18,600, that means that we go to the excess of 388. So we have to tax up to the rate of 30%. How do you start? You start with the first. Now at the rate of 10%, pick the last amount appearing in that range. Between 1 shilling to 288, pick 288. So the last amount appearing there. So we say first 288,000 times 10%. It gives you shillings here 28,800. Then you come to the next. The next, you take between 288,001 to 388, 25%. Now we don't pick the last amount and we tax at 25 like we have done for the first one. No. You take the difference between the last amount appearing there, which is 388,000, minus the last amount appearing in the previous rate. In the previous rate, the last amount is 288,000. So 388,000 minus 288,000 give you 100,000. So to come here, 100,000 times 25%, which gives you 25,000. 25,000. After that, we go to the excess over 388,000, which we tax at the rate of 30%. Excess over 388 means what? It means that we have already taxed 388. If you take 288 plus 100, that will be 388. So whatever is above 388, you tax at the rate of 30%. How much is that? So this we call it last. The last, which is now the total taxable amount, 1820,600. You less what you have taxed. You have taxed 388. 288 plus 100, that will be 388. So this one, you multiply by 30%. The excess now. So let us get the excess first, which would be 1820, 600 minus 388,000 gives you 1432,600. Then times 30%, which gives you 429,780. Then, because that is the last one, you add those taxes to get something called gross tax. Gross tax, which would be the 429,780 plus 25,000 plus 28,800, which gives you 483,580. That we call it gross tax. Now, after you get the gross tax, there are 3 items you are supposed to deduct here, which are called set off. They are the same that we talked about when we were looking at the employment income, only that we don't have pay as you earn. Pay as you earn is usually for a person who is on salary. This is just a person in business is not on salary, so we ignore. But now, personal relief is one of the set-off we talked about, of which case personal relief is provided in the table. If you look at the table we have used to tax, just after the table there is personal relief per month 2,400. If you multiply by 12, you get per annum 28,800. The next one is called insurance relief, and we said this for a person who have education or life insurance cover or NHIF insurance cover, and I showed you how to compute. So if this individual had that, if this sole trader, that is a lorry trader, had the insurance life or education on NHIF, we could have claimed the insurance relief, but didn't have, she didn't have, so we ignore. The other one is withholding tax on investment income, which withholding tax is not final. That means that you have to look at the investment income you have added here. If you had added something like non-qualifying dividend, remember there is a withholding tax of 15%. You'll come and say investment income, withholding tax 15% of the gross to remove it. But we didn't have. So for now, the only set-off we have is the 28,800, and this will give us the net tax payable. The net tax payable, which will be the 483,580 you minus the 28,800. Which gives us 454,780. And that answers required number 2, where we were supposed to get the tax payable by Royce Lubandi, and it ends there. For now, that is how we usually tax the sole proprietorship business. We end our lesson there. Until next time, when we are going to look at the taxation of the partnership. Thank you very much. Yours here, Patrick Kamau Kamure.
Hello candidates, and welcome to the Manifested e-learning platform. Today we will continue with the subject Advanced Financial Management. The topic is Contemporary Issues and Emerging Trends. We are going to pick one emerging issue, which is crowdfunding. Crowdfunding, which is sometimes referred to as crowdsourcing. So candidates, in today's lesson, we have 2 objectives. The first objective is that by the end of this lesson, you should be able to define crowdfunding. Then objective number 2, you should be in a position to outline the benefits of crowdfunding. So let's begin by defining crowdfunding. What is a meaning? What is a crowdfunding or crowdsourcing? Now, candidates, crowdfunding can be defined as a practice of funding startups or small firms or projects by raising small amounts of money from a large number of people. Raising small amounts of money from a large number of people. Crowdfunding, as the name suggests, crowd means many, all right? So crowdfunding is a practice of raising or funding startups or small firms or funding projects by raising small amounts of money from a large number of people. Do you understand? That is the meaning. And this practice of raising small amounts of money from a large number of people can be done by utilizing online social platforms such as Facebook, Twitter, LinkedIn, and other specialized blogs. In other words, candidates, it is an organized collective effort of many non-professional people who are embedded in trust to finance a venture via the internet, where a large number of people are organized collectively to raise small amounts of money through the internet for the purposes of funding a project or funding a startup or funding a small firm. Then we say that's crowdfunding. It can also be referred to as crowdsourcing. The process of obtaining needed services, needed assets, knowledge, ideas by soliciting contributions from a large number of individuals. That is crowdsourcing. That's where we get the term crowdfunding, because crowdfunding is raising of money. It's not just money that can be raised from crowds or large number of people. You can also have what we call crowdsourcing, where a crowd of people solicit, ideas are solicited, assets are solicited, and so on. Crowdsourcing. That's the meaning of crowdsourcing. Now, candidates, in the case of crowdfunding, the same process is followed. I've just explained crowdsourcing. Crowdsourcing. I've said that crowdfunding is derived from crowdsourcing, that refers to the process of obtaining needed services, assets, knowledge, or ideas by soliciting contributions from a large number of individuals, especially from the what we call online community, rather than from the traditional employees or suppliers. In the case of crowdfunding, the same process is followed in procuring funds. And the objective of crowdfunding is to finance a project or an idea, or to help what we call philanthropic organization by soliciting funds in tiny units from a mass of people, from the crowd. That's the meaning of crowdfunding. Then, candidates, we need to outline the benefits of crowdfunding. Benefits of, what are the benefits? Benefits of crowdfunding. Having defined crowdfunding, then what are the benefits? Benefits of crowdfunding. Candidates, crowdfunding allows the fundraiser to tap into a broader investor pool and provides the investor with more flexible fundraising options. So we want to highlight some of the benefits. The first benefit of crowdfunding, number one, benefits. These are benefits. Benefits. Okay, the line has to be straight. So the first benefit, candidates will explain under the point reach. Reach. Now, a crowdfunding platform expands the fundraiser's reach by giving him or her access to thousands of investors who can see, interact, fundraiser can interact with and share particular fundraising campaign. So it gives the fundraiser a wide reach. Wide reach. Let me use the term wide. Wide reach. Because the fundraiser uses an online platform, it can reach many people across the borders and so on. Wider reach. It has wider access to thousands and millions of investors. The second benefit of crowdfunding is in relation to public relations. Public relations. And related to public relations is marketing and marketing. Public relations and marketing. Now, candidates, from the launch to its closure, the fundraiser can share and promote his campaign through social media, through email newsletters, and other online marketing channels. And as the fundraiser and other media outlets cover the progress of the fundraiser, then the fundraiser can further promote his business by steering traffic to his website and other social media platforms. So crowdfunding can help a company improve its image and also its presence in the market. That's the second benefit. The third benefit, we can discuss this third benefit in relation to validation of concept. Validation of concept. Validation of concept. How is validation of concept beneficial? Now, candidates, the presentation of the business, the presentation of the fundraiser's business to the masses, all right, provides an opportunity to the fundraiser to validate and refine his or her business proposition. And we will also find that questions and expressions of interest from potential investors can make the fundraiser re-examine his business proposition. Because when you launch your campaign to many people, millions of people, there are many people who will see your campaign at different perspectives, and they'll give you feedback. They'll ask you questions. They will enable you to see things from a perspective that you are not able to see. So by responding to queries, then the fundraiser can re-examine his business proposition, can make changes and improve. There are people who will criticize, those who will make jokes, others will provide positive criticism. And the fundraiser can use that to improve his business proposition, so that he can see whether he missed out on something important which would make his investors more likely to offer money for his project. Validation of concept. The fourth benefit of crowdfunding can be explained under the point efficiency. Efficiency. Now, candidate, crowdfunding is an efficient way to organize one's business. Why? Because in crowdfunding, an entrepreneur can centralize and streamline fundraising efforts by building a single comprehensive project profile to which he can direct all potential investors, and therefore eliminating the need to approach them individually. So instead of duplicating efforts by printing documents, compiling documents in booklets, and manually updating each one when there is an update, the fundraiser can present everything online in a much more accessible format, leaving him or her with more time to run his business instead of fundraising. So crowdfunding is an efficient way of organizing one's business. So these are four benefits of fundraising. We can add presentation. Now, candidates, by creating a crowdfunding platform, a fundraiser goes through the invaluable process of examining his business from every angle. All right? Right from the history of the business, the traction of the business, the offerings. These are the products, the services offered, the addressable market, the value proposition, and many other aspects of the business, thereby summarizing his business into a polished, attractive, and easily understandable proposition. Because you cannot do crowdfunding without going through the processes that I've mentioned. So that is one benefit that can accrue to a business or to an entrepreneur who decides to do crowdfunding. And with that, candidates, we effectively bring this lesson to a close. Remember, when I began, I mentioned that in this lesson, crowdfunding, under the topic Contemporary Issues and Emerging Trends, we had only two objectives. Number one is define crowdfunding, then explain the benefits of crowdfunding. That is the end of this lesson. That marks the end of the lesson. But before we take a break, I'll give you an assignment. Question number 1, explain the meaning of crowdfunding. Number 2, outline 7 benefits of crowdfunding. Thank you for attending this lesson and for being attentive. I hope to meet you in our next session where we continue to study more about contemporary issues and emerging trends in financial management. Bye-bye.
Dear learner, welcome in our continuing series of lectures on the manifested e-learning platform. We are continuing with our subject of human resource management. And today in our lesson, we are looking at human resource administration. And within that human resource administration subtopic of the lesson, we are now looking at health and safety policies and procedures. We are looking at health and safety policies and procedures. And dear learner, what needs to be emphasized is that the health of a worker and the health of those associated with an organization is very critical. And that's why a lot of emphasis must be put on the administrative aspects that help in preserving the safety and the health of workers and those who are associated with what the organization does. And that's why we are going to take a bit of time on the lesson for today to be able to emphasize so that you can come out very strongly with the competencies and skills of ensuring that you are able to maintain a health and safe working environment through the safety procedures that an organization is expected to put in place. Now, when we look at health and safety policy and procedures, health and safety policy and procedures are concerned with protecting employees and other people who may be affected by what the organization produces, does, against hazards arising from their employment or their links with the organization. So you have hazards, you have what is being produced or what is being done in an organization. So dear learner, as we have emphasized, the health and safety of employees and those associated with the workplace is very critical. And that's why we are going to take a bit of time and be very sequential in terms of how we are going to look at health and safety policies and procedures. So just to emphasize again, health, safety policies and procedures are concerned with protecting employees and other people affected by what the organization produces and does against hazards arising from their employment or their links with the organization. And any lapses in the area of health and safety can actually lead to death. And that's why it is important to avoid the deaths accruing in the work environment or injuries or damage. This has to be taken very seriously. So in our lesson today, for us to realize the objectives of this lesson, we are going to look at activities in managing health and safety at work. We will look at hazards at work. We will look at action following risk assessment. We will also look at control of occupational health and hygiene problems, and also look at accident prevention. How can accidents be prevented within a working environment? So we are going to start with activities in managing health and safety at work. Activities in managing health and safety at work. So, Lana, you might be asking yourself, as a human resource person, or maybe as a company secretary or somebody associated with a work environment, what are some of the activities that you may be involved in when it comes to managing health and safety at work? So there are several activities that you may be involved in, because when it comes to the law that regulates health and safety policies and procedures, the Occupational Safety and Health Act of 2007, it is a requirement that teams are created within a work environment. So you may find yourself as a team member participating in these particular processes. So what are some of the areas in which employees may have to participate? So one of them is formulation of health and safety policies. Health and safety policies. So in a work environment, nowadays, employees are increasingly being involved in management. And that's why for these policies to be highly acceptable or highly, say, transcended down the organization, then an organization may have to involve employees. So as an employee, you may be involved. As a manager, you may also be involved in the formulation of health and safety policies. You may also find that another activity is conducting risk assessments. There may also be implementation. Number 3, implementation of health and safety policies. There might also be review of health and safety procedures. So activities in managing health and safety. There is also the issue of number 5, participation in health and safety committee work. There might also be the issue of sensitization of employees on health and safety. There is also the issue of investigation of work-related accidents. So basically, the activities in managing health and safety are wide, and they vary from organization to organization. But what we are saying, some of them may include formulation of health and safety policies, conducting risk assessments, implementation of health and safety policies, reviewing of health and safety procedures, participation in health and safety committee work, sensitization of employees on health and safety investigation, and investigation of work-related accidents. Accidents may take place within a work environment, and there could also be other areas, like, for example, managing stress in the workplace. Now, this stress may be brought about by employees who have been given, for example, certain targets. Employees have certain targets to meet, and they will be stressed if the time is reaching and these employees have not met those targets. So that again becomes an issue that has to do with employees' health, employee work well-being, and so on, among other places and so on. Is it? Then there might also be other issues like health and safety, health and safety equipment, So the list is long, but these are just some of the things that you are saying that within a working environment, some of the activities may include but are not limited to what we have listed here. So that is the first part of our lesson, which is now dealing with activities in managing health and safety at work. Now, how about hazards, dear learner? How about hazards at work? What are some of the hazards at work? And what you might have noticed, dear learner, in any work environment, whether it is in the office, whether it is operating machines, whether it is at the farm, there could be some hazards that we need to be aware of, so that when we are aware of those hazards, then it is possible for us to be able to bring in corrective measures. So what are some of the activities that may be associated with hazards within a work environment? So one, receiving of raw materials. Receiving of raw materials. Now, when raw materials are being received, there could be elements where now you need to carry this, for example, need to be carried, need to be moved from one place to the other, and so on. So that again could create a hazard. Then there is the issue of movement in the workplace. Movement in the workplace. So when there are movements in the workplace, there could be collisions, for example. Then operating machines, that could also create a hazard. Then you could, for example, be having issues like working at heights. You have seen, for example, say Kenya Power, you have power lines and employees are supposed to climb up there on masts, for example, for Safaricom, maybe other mobile phone companies and so on. So that working at a height could also create a hazard for employees. There is also working with hand tools. And then number 6, operating electric equipment. So when employees are working with hand tools, that hand tool could, for example, snap. And if it snaps, then that could also create a hazard. Then there is the element of operating electric machines or equipment where electricity is being used. Workers need to be very keen. Then there is also the element of sitting for long durations. So employees who sit for long durations may, for example, suffer what you call lower back pain. So that again becomes a hazard within a working environment, is it? Then you also have processing of materials. Now, these materials could lead to what you call toxic substances. When materials are being mixed, those materials could create some toxic substances. Then there is also cleaning of gutters. So employees in cleaning of gutters in confined spaces. So that again could be a hazard. Then there is also the issue of workload. Work overload. So when employees have too much work, sometimes you have seen in some workplaces, an employee has to carry work home. So that carrying that work home sometimes could also create challenges. So when these employees at the workplace for 8 hours, they are working, they go home, instead of resting, they continue working and so on. And if this workload continues, this one could lead to maybe high stress levels, as we have observed, and that one can be a hazard at maybe the work environment and so on. So these could just be some of the hazards that workers may be exposed to within a given working environment. And when this happens, or within a work environment, then employers are supposed to do what is called a risk assessment. So what are some of the action following risk assessment? So we want now to have a look at action following risk assessment. Action following risk assessment. Risk assessment. So as we have indicated, dear learner, employers are expected to carry out a risk assessment in accordance to various legal provisions. So there is a procedure for carrying out a risk assessment, and once that risk assessment is carried out, action is envisaged. That particular action must be taken as informed by the risk that has been assessed. And this risk assessment is supposed to be done internally and also externally. So what are some of the things that an organization may institute in relation to the risk assessment process? So one, hazard elimination. So one of the things that may be done, hazard elimination. And now we will give an example here, Lana. So supposing you are working in an environment and you have gone to a section, and that particular section you have noted there is some hazard. So maybe if it is a hazard in terms of the process, there could maybe what you call a process alteration. Process alteration. So if this process is altered, can it be able to eliminate the risk maybe workers are exposed to or other people? Then there's the element of substitution. Substitution. Now, supposing you are using a particular detergent. You are using a particular detergent or maybe a raw material. And you notice that this detergent is corrosive, right? This detergent is corrosive, for example. Then you can substitute that particular detergent with another one, but still achieve what you are expected to achieve. So this detergent or that raw material can be, for example, be substituted. So substitution of maybe a detergent or a raw material that is hazardous can be able to minimize that particular risk in that particular setting. Then there is also what you call the use of barriers. The use of barriers. So what happens here, dear learner, you may go to a machine room and you realize that the machine must, for example, have a particular belt that is rotating. So that belt could be the risk that you have observed could injure an employee. So the use of barriers may involve, for example, using fabrication, or maybe using some wire mesh that is, for example, put between the belt and maybe where the workers are, and that way you have actually put a barrier such that no employee can go to that particular side of the machine, and that one helps in reducing the risk. Then there is also the issue of use of procedures, use of standard operating procedures. Standard operating procedures, or what you call SOPs, standard operating procedures. So, dear learner, what this means is that in areas where a risk has been assessed and it has been realized that if workers are left just to operate, for example, machines, there could be some danger. Then an organization may come up with a manual that says before this machine is started, you must ensure that the barrier, for example, is in place. You must ensure that the loading of the machine is in place. You must ensure that other features have been taken into consideration to minimize that particular danger and so on. So then the use of standard operating procedures can also be instituted in that particular arrangement. Then number 5, use of working systems. Use of working systems. Now, what do we mean by this now? Use of working systems, supposing you have a line operation. Then you must ensure that, for example, you have a shift supervisor, and this shift supervisor is well versed with safety in relation to the work that is being done. So in terms of a working system, in terms of that line, it means before you start any process, then the whole system has to be checked from the beginning to the end, and this supervisor may give what you call a work permit, or maybe what you're calling a permit to work. permit to work. So this permit to work is signed and everything is in order before workers can start working and so on. And this working system can also have what you call the warning systems also. So that in some of the Japanese organizations, there could be a siren. In case there is a problem on the line, then what happens? There is a siren that goes on and that whole system now, for example, stops. So that working system or warning system can be able to assist in terms of that process. Then the last aspect in relation to action is the use of, the last aspect here is the use of personal protective equipment. Personal protective equipment, or what you call PPEs. So dear learner, you should note that personal protective equipment or PPEs like gloves and other issues should be used as the last resort. When all these other processes cannot work, then you now use personal protective equipment which are appropriate to that particular work operation or work activity. So those are some of the things, those are the 6 things that may follow, action that may follow risk assessment. So it means if you look at the first one, hazard elimination, a hazard has been detected, maybe in the process, it is altered. Maybe an item that is being used is risky, it is substituted. Maybe an operation that is open can also have a barrier. So based on the risk assessment that has been done, an organization can come up with intervention measures in that order. And as we have indicated, use of personal protective equipment is normally the last consideration in relation to safety at the work environment. So that is our third aspect in our lesson today. And the fourth one is control of occupational health. Control of occupational health. The fourth one is control of occupational health and hygiene problems. Control of occupational health and hygiene problems. Control of occupational health and hygiene problems. Now, when it comes to housekeeping issues within an operational environment, you have what you call housekeeping issues. Now, when it comes to housekeeping issues, what are some of the things that should be done to control the hazards or occupational health problems that workers may be exposed to? So one of the things that is supposed to be done is to eliminate the hazard at source. So one, elimination of hazard at source. So what this means is that you don't have to wait. If you are, for example, constructing a warehouse and you need, for example, a floor that is rough for that warehouse, then at the construction and design stage, then you must ensure that you eliminate the risk or you eliminate the hazard at that particular point when you are constructing the building. So that elimination of the hazard at source becomes one of the things that you need to do. Then two, you have what you call process engineering. Process engineering. So basically, the kind of processes that you are now supposed to use, you ensure that you build safety into that particular process. So through process engineering, you can be able to eliminate or control occupational health and safety and hygiene problems that may arise within the working context. Then you have what you call isolation of hazardous processes. Isolation of hazardous processes. You might, for example, dear learner, go to maybe to a hospital, and what they do, if let's say the X-ray and imaging areas are risky areas, so it means you must isolate those wards that deal with issues to do with imaging and X-ray in environments where employees or patients cannot come into contact. So isolation of hazardous processes, they are put in an area where it is difficult to access or is only left out of bounds for people who are not supposed to work in those areas or are not authorized to be there. So that isolation of hazardous processes can also be one of the ways through which you can be able to control health and hygiene problems within a working environment. Then there is also the element of training workers. Training workers on safe practices, safe work practices. So workers can be trained in relation to how they can make their work maybe environment safe. So when workers are trained, then those workers can now be able to assist in ensuring that there is a safety within that particular environment. Then you also have what you call good housekeeping practices. Good housekeeping practices. So what do we mean by this? What we mean by this, dear learner, is that in terms of spillages within the work environment, those ones should be cleaned as the work continues to ensure that the work environment is clean at all times. There are no spillages to be able to create problems. Then you also have proper maintenance of plant and equipment. So if you have a routine, for example, to maintain machines maybe after every, say, 5 days, so that proper maintenance schedule is very important to be able to control occupational health and hygiene problems, so that now within a week or within 2 weeks, proper arrangements are made to ensure that that work environment is proper and so on. Then you also have what you call regular risk assessments. So these regular risk assessments can be impromptu. So you just decide you are going to check a particular section, and that section you are going to check, you don't inform the people who are there, you just go there, check whether now they are conforming to what has been put in place in terms of the operating standards and so on, then take intervention measures. So that regular process of risk assessments within a work environment can also be able to assist an organization solve the hygiene problems that may be associated with a working environment. And then you have what you call proper ergonomic considerations. Proper ergonomic considerations. So when you talk about ergonomic considerations, you are talking about the interface between the worker and the machine. So if you have proper work machine interface, proper ergonomic consideration. So if you have a proper proper interface between a machine and the person, or a workstation and the worker. Take an example. If you have, let's say, a computer operator. So you ensure that the computer has got the shield that is supposed to shield that worker from the rays, and then the seat which the computer operator is using is also appropriate and well, for example, adjusted. Then that particular person can work with minimum strain. So you can be able to reduce the strain of that particular worker and ensure that that worker works very well and so on. So that again becomes one of the things that needs to be done. Then you have also what you call continuous medical checks. Continuous medical checks among the employees within the work environment. So continuous medical checks can ensure that anything that is detected within the work environment or within the work environment and so on can be addressed appropriately to ensure that occupational problems are basically minimized and so on. Then you also have what you call preventive medicine. So, dear learner, as we have indicated, there is the element of continuous medical checks where employees are subjected to continuing medical checks in the work environment, and where maybe challenges are found, intervention measures are taken. And number 10, preventive medicine. For example, in the era of COVID-19, workers can be sensitized in terms of washing hands, social distance, issues of, say, avoiding crowds and so on. So these ones are preventive medicine intervention measures that can be able to help workers avoid chances of getting COVID-19 through washing hands, maintaining social distance, also putting on masks properly. So that helps in ensuring that workers within the work environment can have an exposure, or maybe can control occupational health and hygiene problems to minimize exposure to risks that may arise within the work environment. Then the other aspect we need to look at, dear learner, is accidents we have said are prevalent within the work environment. So how can we prevent accidents? Accident prevention. Accident prevention. So when it comes to accident prevention, there are various measures that could be considered. For example, identification of causes of accidents. Identification of causes of accidents. So if accidents, because accidents are inherent in our work environment, so measures must be put in place to try and identify what are some of the probable causes of accidents, and then once that is put into consideration, intervention measures can be constituted. Then there's the element of consideration of safety, consideration of safety at the design stage. Design stage. So let us take an example. An organization is constructing maybe a building where they are going to have offices. So this building is a staircase. So the staircase that is being constructed to go to first floor or second floor or third floor, you can ensure that those particular staircases are constructed to particular standards which can be able to avoid workers, for example, being injured. So that consideration at the design stage for maybe building and equipment can also be one way of anticipating accidents and preventing them from occurring. Then there's the element of provision, provision of personal protective equipment. We have mentioned PPEs. There is also the issue of number 4, using standard operating procedures. These ones are SOPs. There are also processes of having what you call warning systems. For example, fire warnings. So basically, this is a system that can be triggered off if there is a fire in a section or a room. Then this warning systems comes on, then it can be able to alert other employees. Then there is also the issue of training workers on safe operations, so that workers have the knowledge and skills to ensure that they can be able to operate the machines and equipment safely and so on. And then you also have the continuing maintenance, maintenance. So an organization does not have to wait for machines to break down or injure people for them to maintain them. So continuing maintenance routines are also important to ensure that an organization is able to meet its obligations. Then you also have fire extinguishing systems, fire extinguishing systems. Now, for example, you may have what you call sprinklers. Sprinklers. Now, these sprinklers in most cases are put in environments where, like if you have a basement parking, then the sprinkling, the fire extinguishing system is automatic. If there is that fire siren, then the sprinklers automatically bring out water. You don't have to wait for people to come. And by the time people are coming, that extinguishing process could have now, for example, prevented that accident within that work environment. So, dear learner, you can see the issue of the health of workers, as we've said, is very central. And as an employee or as a worker in a work environment or as a stakeholder in ensuring health and safety, you have to take this topic very, very seriously, because you can be able to assist an organization to save lives, save workers from being injured, save damage to property, save stoppage of processes, and ensure a work environment is safe. So we can very quickly again run through what we have done today. So in our lesson today, which was health and safety policies and procedures, we have looked at what is meant by health and safety policies and procedures, and we have said, dear learner, that health and safety policies and procedures are concerned with protecting employees and other people affected by what the organization produces and does against the hazards arising from their employment or their links with the organization. And we said we were going to look at these 1, 2, 3, 4, 5 things, which are activities in managing health and safety at work. We said we will look at hazards at work. We also indicated we will be looking at action following risk assessment. And we also indicated that we will be looking at control of occupational health and hygiene problems. And also we said we would look at accident prevention. So what did we look at when we looked at the activities in managing health and safety at work? So number 1, formulation of health and safety policies. Number 2, conducting risk assessments. Number 3, implementation of health and safety policies. Number 4, review of health and safety procedures. And then we looked at number 5, participation in health and safety committee work. Number 6, sensitization of employees on health and safety. Number 7, investigation of work-related accidents. Number 8, managing stress in the workplace. Number 9, health and safety equipment. So those are the activities we have looked at and discussed them and indicated that these are some of the activities in managing health and safety at work. Then, dear learner, we moved on and looked at some of the hazards or activities that may be associated with hazards at work. And we have indicated that some of the hazards at work may occur at the point of receiving, number 1, point of receiving of raw materials. And then number 2, movement in the workplace, when there are movements from one section, from one department, from one activity to another one, workers could collide or they could occur a challenge there. Then when machines are being operated, number 3, machines are inherently hazardous. A machine could snap. So operating of machines can also pose a hazard. Number 4, working at heights. When individuals are working at a height, that could also pose a hazard if they are working on a ladder or working on a scaffold. Number 5, working with hand tools. Hand tools, sometimes they could, for example, be shaking, or maybe you need to position them. So that again can create a hazard and maybe injure an employee or cause an accident. Number 6, operating electric equipment. And if you're operating electric equipment and it's being supplied by a power source, that could also be a hazard, maybe a source of a hazard. Then number 7, sitting. Now, What action can be taken when a risk assessment has been conducted? And we have indicated that number one, elimination of the hazard. If it is a process, it could be altered. Number two, substitution. If you have, say, a detergent and it is corrosive, it could be substituted with maybe another less corrosive detergent. Number three, use of barriers. For example, fabrications can be made to maybe block employees from coming into contact with a moving machine. Number four, use of standard operating procedures or having procedure manuals. That can also be useful. Number five, use of working systems or warning systems where there could be a warning if there is a danger, the machine stops or process stops. Then use of personal protective equipment, which we have said is the last line of protection when all the others have now not succeeded. Then we have also looked at the control of occupational health and hygiene problems. So how can organizations maybe sort out that issue of health and hygiene problems? So one, elimination of hazard at source. At the design stage, ensure you design the machine or the process well. Then process engineering, the way the processes are carried out, that can also be maybe corrected. Isolation of hazardous processes, and we say like in a hospital setting, the dangerous, like let's say X-ray related activities are isolated where patients cannot easily access. Then number four, training workers on safe work practices. That can also help in controlling occupational health and hygiene problems. Good housekeeping practices to ensure the work environment is safe. Proper maintenance of plant and equipment. Number seven, regular risk assessments. Number eight, proper ergonomic considerations. The machine worker interface should be scientifically studied to ensure that they minimize on strain. Number nine, continuous medical checks and surveillance. Number 10, preventive medical medicine. For example, in the COVID-19 situation, workers should be exposed to preventive measures like washing of hands, social distance, proper use of masks, among other preventive approaches. Then ultimately we looked at accident preventions. So what are some of the intervention measures that may be put in place to help prevent accidents? So one, identification of causes of accidents and then mitigating on that. Two, consideration of safety at the design stage. When a design is being done, safety must be central. Then three, provision of personal protective equipment, PPEs. Four, using standard operating procedures, SOPs. And then number five, using warning systems. For example, fire warning systems can be able to be triggered on automatically through remote sensing. Number six, training workers on safe work operations. Number seven, continuing maintenance so that it's routine and continuous. And number eight, using fire extinguishing services, for example, facilities or systems like now automatic fire extinguishers that come into effect in case of a fire. So these are the things we have looked at in our lesson today. And before we finish our lesson, dear learner, you have an assignment. Discuss hazards. Your assignment, discuss hazards that might be inherent in a workplace. Discuss hazards that might be inherent in a workplace. So dear learner, as we have noted, health and safety is very key. So take this particular content very seriously, because your own health, the health of other workers, the health of other people, the property of the employer, and anybody who comes into contact with what you do as an organization could suffer. So to minimize and mitigate in those areas, your administrative approach will be very crucial and will be very central to ensure we have a safe work environment for everybody. So thank you very much for being attentive in our lesson. We hope to see you in our subsequent lessons. Thank you.
Hi students, welcome to another session of Manifested Online Classes. So in this session, I want us we continue with the topic number 3, subtopic number 5, financial statement of cooperative societies. And specifically on this session, I want us we look on an illustration question regarding presentation of financial statement of a cooperative society. So I want us we go through the illustration and then we see what was required. So we are told Marura Farmers Cooperative Society deals in marketing of two brands of coffee, Safi and Mzuri, on behalf of the members. As per the society's bylaws, the society is allowed to retain 20% of the sales for Safi and Mzuri for operation and pay the balance to the members. The following trial balance was extracted from the books of the society as at 31st of December 2021. We have a trial balance there. We have expenses relating to Safi, which include marketing expenses, processing materials, processing wages, and then we have expenses relating to Mzuri, which include marketing expenses, processing materials, processing wages. Then we have loans to members. We have dividends from investment, accrued lends, salary provision, appropriation account, revaluation reserve, statutory reserve fund, entrance fee, share capital, members deposit, salary creditors, bank overdraft, interest on loans to members, and then we have traveling expenses for staff, for committee members, bank charges, bank interest, salaries and wages, committee education, committee seating allowance, printing and stationery, general meeting expenses, members education, entertainment, legal fee, cash in hand, Wakulima Bank Limited savings, investment in Wakulima Bank Limited, receivables from members, receivables from non-members, and then finally we have equipment. Then we have some additional information. Number 1, we are told Bora Limited market Safi and Mzuri brand for Marura Limited. On 31st of December 2021, Bora Limited sold Safi and Mzuri brands for $175,000 and $115,300 respectively. Bora Limited remitted the above amount to Marura Farmers Wakulima Bank on 15th of January 2022. Marura Farmers Cooperative Society does not maintain a US dollars account in Wakulima Bank. So as far as that information is concerned, it is important to note that this company, which is called Bora Limited, which you are told market Safi and Mzuri brands on behalf of the cooperative society, this is like an agency. This is just like KTDA, which is responsible for marketing and selling tea on behalf of various tea factories. So once KTDA sell tea, it remit now money to the bank account of various tea factories, and then which will be able now to pay their farmers. The same case with this particular Bora Limited is an agency of Marura a cooperative society. It market and do what? Sell those two coffee brand on behalf of that cooperative society. So therefore, once it sell, definitely it remit the money to the bank account of the cooperative society. But because you're given the sales in US dollars and the other figures are given in shillings, we have to translate those particular sales into Kenyan shillings, and automatically we're going to translate them using the exchange rate which was existing at the date the money was sent. I hope you can see we are told the money was sent or was remitted on the bank to the bank account of Marura Farmers Cooperative Society on 15th. So that is the exchange rate we are going to use. So in number 2, we are given the exchange rate for the two currencies, as shown below. So we're given the exchange rate on 31st of December 2021, which was 105 shillings, which was equal to $1. And then on 15th of January 2022, $1 was equal to 100 Kenya shillings. Automatically, in this case, I've said when translating the sales for the two coffee brand given in the information number 1, we are going to use the exchange rate on the date the money was remitted to the bank account. That is on 15th of January 2022. Number 3, we are told audit fee of 6 million is to be provided for. Number 4, salaries and wages amounting to 3.2 million had not been paid. These accrued salaries and wages. 5, interest on members' deposit is to be provided at shillings 6.08 million. And then finally, we are told, as per the relevant ministry's regulation, cooperative societies are required to transfer 20% of their net earnings to statutory reserve fund. This is something I mentioned in the first topic or in the first lesson of this particular topic, that cooperative societies are required to 20% of their net profit to a statutory reserve fund. So what are we required as far as that question is concerned? We are required to prepare the following financial statement for Marura Cooperative Society for the year which ended 31st of December 2021. Number 1, Safi Brad marketing account showing the profit and loss. Number 2, Mzuri Brad marketing account showing the profit or loss. And part C, statement of profit or loss for the year which ended 31st of December 2021. And finally, statement of financial position. So as far as the first two accounts are required, part A and part B, whereby you're required to prepare the marketing account of the two coffee brands, we're required to prepare those two accounts basically to show the profit or the loss which was realized from selling these two coffee brands. And what we are going to do, we are going to take now the sales, the sales of the two coffee brand which is given in the additional information number 1, and then there is some information which is given in paragraph 1 that this cooperative society is required to retain 20% of the sales and automatically remit the rest, which is 80% now to the members. So once we take the sales given in number 1 and we determine the amount to be retained, which is 20%, the amount to be paid to the members, which is 80%, then we are going to less now the expenses specifically relating to those two coffee brands. So we start with part A of that particular question. We are required to prepare a Safi brand marketing account, which is for the year which ended 31st of December 2021. 31st of December 2021. So in this case, we need to have just a single column here, and our figures are in thousands of shillings. So what do we start with here? We start with the sales from this coffee brand, and we are given that information in additional information number 1. We are told the sales from this coffee brand, that is a Safi, it was $175,000 US dollars. 175,000 US dollars, because these sales are in US dollars. So what we need to do, 0.5 million, take into account our figures are in thousands of shillings, so that will be recorded there 17,500. Then what you are told is that out of these particular sales from these two coffee brand, now the cooperative society has to retain 20% to cater for the expenses associated with marketing and selling this particular coffee brand, and then 80% of these sales will have to be paid to the members, or basically to be distributed to who? To the members. So therefore, the first thing we need to do, even before we list now the expenses. So first of all, we have now to deduct amount due to members. Amount due to members, and basically in this case, we have said the amount due to members is 80%. Amount due to members. That amount due to members, in our case, we have said is 80% of these sales, because we are told the cooperative society is supposed to retain what? Supposed to retain 20%. 20%. So what is 80% of 80% of this? 80% of 17 500, which will give us 14,000. So this is the amount now to be paid to the members, meaning that the amount retained by the cooperative society, and which is now 20%, is how much? Is 35. So basically what that means is that this particular amount should be equal to, this amount should be equal to 20% of this. Maybe you can just confirm 20% of 17 500. That should give us 35. That is the amount to be retained by the cooperative society to cater for the expenses associated with marketing and selling this coffee brand. So then what we need to do is basically to go ahead and list now the expenses. We list the expenses. So we are given the expenses, or we're given specific expenses relating to marketing and selling this coffee brand. And those particular expenses are given in the trial balance. I think the first item is the trial balance. We have the expenses associated with marketing and selling a Safi. So we have marketing expenses, which is an amount of 640. We also have processing materials, an amount of 860, and then we have processing wages, which is an amount of 900. Yes, an amount of 900. So wherever you get down there is basically now the profit which this particular cooperative society was able to get from selling this coffee brand. So 35 minus 640 minus 860 minus 900. So this will give us 1100, and basically this is now the profit for the year from selling and marketing this particular coffee brand. So basically that's what the examiner was requiring there, and you can see how many marks were allocated there. The marks allocated were 3. So for recording basically these particular items here, the sales and these particular expenses here, then you had to get those 3 marks. So let's move to part B of that particular question, part B of that question, and we are required to prepare now a marketing account for the other coffee brand, which is Mzuri brand marketing account, which is equally for the year which ended 31st of December 2021. So our figures are in thousands of shillings, and we're following the same format. We start with the sales of this particular coffee brand, and that is given in the additional information number 1, which was 115,300. But this take into account our US dollars. We have to translate that to Kenyan shillings using the exchange rate which existed on the date this money was remitted to the bank account of the cooperative society, and this will give us 11,530,000. So just like what we have done here to this, we need to less the amount due to members, the amount which was supposed to be paid to the members from this particular sales. So we less amount due to members. In this case, we have said the amount due to members is 80% of the sales. 80% of the sales. And then what we get here is the amount retained by the cooperative society to cater for the expenses associated with marketing and selling this particular coffee brand. So 80% of 11,530, 11,530. Okay, we can take that again. 80% of 11,530. Yes, that will give us 92.24. That is the amount which was due to members. And then how much amount was retained here? We deduct that from 11,530, which will give us 23.06. So this is the amount which was retained by the cooperative society and which was supposed then to cater for the expenses associated with marketing and selling this coffee brand. And we are also given those particular expenses. Those expenses are given in our trial balance there. So what we just need to do is to record them here. So we have marketing expenses. Marketing expenses, an amount of 150. And then we have processing materials. Processing materials, an amount of 320. And then we have processing wages. Processing wages, which is an amount of 30. Yes. And then from there, what we do, we get the profit for the year. The profit for the year from this coffee brand. So what do we have here? We have an amount of 2306 minus 150 minus 320 minus 30. That gives us 1806, which is now the profit for the year. Equally, that is what was required as far as part B of that question was concerned. And these are some of the items which were marked as far as that part is concerned. And by doing that, you get now your three marks. So let's move to the other part of that particular question, that is part C. But even before we do that, there is something we need to note here, which is very, very important. One, when the year was coming to an end, this particular agency, remember we have said that this cooperative society has an agency, which is called what? Bora Limited. As per the information given in note 1, this agency had not limited this amount of money to the bank account of the cooperative society as at the end of the year. So therefore, this amount here, 17,500, and also this one, 11,530, it was an amount which the agency owed to the cooperative society. So therefore, in preparing our statement of financial position, this particular amount plus that one, because it is the amount which the cooperative society was expecting, it will be recorded there as an asset. So basically, we refer to that as the amount now to be received, or the amount receivable by the cooperative society from that agency. On the other hand, this particular amount which was due to the members, 80%, this amount was not yet paid to the members of the cooperative society when the year was coming to an end. And therefore, in preparing our statement of financial position, this one will be recorded there as a liability, because this is what the cooperative society was supposed to pay to the members. It had not paid that amount. So therefore, it is important to note that. Let's move to part C of that question. In part C, we are required to prepare now a statement of profit or loss for the year which ended 31st of December 2022. Now, this one is prepared to determine the profit or loss for the entire cooperative society. Remember, what you have prepared in part A, part B is prepared to determine the profit from marketing and selling the 2 coffee brand. So part C, we are required to prepare a statement of profit or loss, statement of profit or loss, which is for the year which ended 31st of December 2021. 31st of December 2021. So in this case, we need to have 2 columns. And we prepare these by comparing the incomes of a cooperative society with the expenses. With the expenses, automatically we start with the incomes and then we less the expenses. So which are some of the incomes of this particular cooperative society? So even before we go back to the trial balance, because we know our cooperative society is responsible for marketing 2 coffee brands on behalf of the members, we know that from marketing of the 2 coffee brands, there was a profit of 1100 from marketing and selling of Safi, and 1806 from marketing and selling of what? Muzuri. So that is the first source of income to this cooperative society, and that is what we bring here. So profit from the 2 coffee brand Safi, which is a figure of what? Of 1100, and then we also have the profit from the other coffee brand, which is Mzuri, a figure of 1806. Then what we need to do, we go back to the trial balance, we check the other incomes of this cooperative society. It's important for you to remember all incomes have a credit balance. So when checking for incomes from the trial balance, you check the items on the credit side of the trial balance. So the items on the credit side, I think the first item, we have dividends from investment, dividends from investment. Dividends from investment is a figure of 470. Below that, we have accrued rent. Accrued rent, these are liability. Sundry creditors is a liability. Appropriation account, these are like the retained profit at the start of the year, which is not an income. Revaluation reserve is a component of equity. Statutory reserve fund is a component of equity. And then below that, we have entrance fees. This is still an income to a cooperative society, and these entrance fees is a figure of what? Is a figure of 300. Below that, we have share capital, members deposit. None of those is an income. Sundry creditors, bank overdraft, all those are items of liabilities. And I think finally we have interest on members' loans. Interest on members' loans, members, or interest on loans to members. Remember what you have said is that once a cooperative society give loans to the members, a cooperative society definitely will have to charge some interest. That interest charged by the cooperative society is basically what? Is an income. Yes, so I think those are the only incomes which we have. So then what we need to do is to get the total incomes. So let's add all those figures so that we get the total incomes. We have 1100 plus 1806 plus 470 plus 300 plus 35 890 35 890. Okay, yes, that will give us the total incomes of 39 566. Yes, after getting the total incomes, what do we do next? We proceed and we less now the expenditures. The expenditures of these cooperative societies, expenditures of the cooperative society. So here we have a number of expenses, and before taking the expenses in the addition in the trial balance, it is always advisable first of all deal with the expenses affected by the additional information. Let's go to the additional information. In the additional information, number one, I think we had information about sales of the 2 coffee brands. That has nothing to do with the expenses. Number two, the exchange rate that do not affect expenses. And then number three, we are told audit fees to be provided for. Audit fee to be provided for, that is an expense. But equally, because we are told this audit fee was provided for, it means that when the year was coming to an end, this audit fee had not been paid. Meaning that in our statement of financial position, there is a liability. So we have audit fee of 6 million, but remember all our figures are in thousands of shillings. And then number four, we are told staff salaries and wages amounting to 3.2 million had not been paid. So we have staff salaries and wages. So what we do, we take the amount which was not yet paid at the end of the year, which is 32, and then we add to this, we add the amount which had already been paid, and this is the amount appearing in the trial balance. So the amount appearing in the trial balance as the staff salaries and wages is a figure of what? Yes, is a figure of 2290. 2290. So we add the two figures, so that now we get the total staff salaries and wages for that year. So we have a figure of 3200 plus 2290. So the total staff wages and salaries for that year is a 5490. So let's go to note number 5. Interest on members' deposit is to be provided for. Remember, in this case, we have said that interest paid to members based on their deposit, this is an expense. This is an expense. And equally, it is also important to note that this amount are not being paid. It's just provided for. So therefore, still in preparing our statement of financial position, this will be a liability. So I think we are done with that point. And then number 5 is all about the amount to be transferred to the statutory reserve fund. That is not an expense. So what that means is that we go back to the trial balance which you are given, and we pick now all the other expenses. It's also important to note that all expenses in the trial balance, they have a debit balance. So we check the items on the debit balance, on the debit column of the trial balance, that is. And I think we can start from where we have traveling expenses. That, I think, where we have the first expense. It is important for you to note that we have some expenses which relate to these 2 coffee brand, Safi and Mzuri, and because we capture those particular expenses here in preparing this particular account, we don't take into account those particular expenses. Those expenses specifically relate to Safi and Mzuri. What we are recording here are the general expenses relating to the cooperative society. So we have traveling expenses for staff and committee members, a figure of 80 and 100. And then we have bank charges. Bank charges, an amount of how much? An amount of 200. We have bank interest. Bank interest, which is a figure of 890. Then below that we have salaries and wages. We have already dealt with that here. And then we have committee education. That is the other expenditure. Committee education, which is an amount of 1,000. Below that we have committee seating allowances. This is committee allowance. We have committee okay, this is a committee's education. Committee's education, which is 1,000. Then we have committee seating allowances, which is a figure of 1110. And then we have printing and stationery. Printing and stationery. So printing and stationery, we have a figure of 2050. And then we have general meeting expenses. General meeting expenses, an amount of 500. Below that, we have members education. Members education. Members education is a figure of 1,500. And then below that, we have entertainment. Entertainment. Entertainment is a figure of 50. And then next, and finally, we have the legal fees. The legal fees, which is a figure of what? Of 400. So those are, I think, the various expenses which relate to this cooperative society. I hope we have not skipped any. Yes. So what then we need to do, we need to add all those particular expenses of this particular cooperative society so that we can be able to determine the profit or what? The loss for the year. So let's add all these particular expenses, starting from where we have audit fee, 6,000 plus 5490 plus 6086 plus 80 plus 100 plus 200 plus 810 plus 1,000 plus 1110 plus 2050 plus 500 plus 15 plus 50 plus 400. Yes, so that is giving us a total of 376. So what we need to do, we need to less that now from the total incomes which we have here. We deduct that from 39,566. So that will give us the profit for the year. The profit for the year of 14,190. 14,190. So basically that is it, that what is required as far as that part was concerned. Preparation of the statement of profit or loss, and in that case now the examiner had given how many marks? The marks were allocated to that were 6. So by recording those particular items of incomes and the expenses, you had to get now 6 what? 6 marks. So finally, let's prepare now the statement of financial position as required in part D of that particular question there. So you prepare statement of financial position. Statement of financial position. That is part D. You can just refer to it as abbreviated as SOFP, as at 31st of December 2021. 31st of December 2021. So remember, you say that it is a statement of assets, liabilities, and equity. So we just need to have a single column here. And we start by recording assets. And remember what we said in our first session. As far as this is concerned, we don't need to classify the asset into non-current and current. We just record asset starting from the most liquid to the long term, and I think we are given the asset starting from where we had our last expense, the legal fee. Below that we have cash in hand, cash in hand. The cash in hand is a figure of 540. Then below that we have Wakulima Bank. Wakulima Bank Limited savings, which is an amount of 6780. And then we have still investment in Wakulima Bank Limited. Wakulima Bank Limited, which is a figure of 6550. Then below that we have receivables. We have receivables from members, which is a figure of 2960. We also have receivables from non-members, a figure of 22,500. And then we also have office equipment. Office equipment is a figure of what? Is a figure of 900. Yes, so I think those are some of the items which we have in the trial balance. But I think also below the various expenses relating to Safi and also Mzuri, we have now the loans to the members. Remember, we have said that once a cooperative society has given loans to the members, advanced loans to the members, these particular loans to the members to a SACCO or even to a cooperative society is an asset. The cooperative society expects now the members to repay back that amount of money. So basically that is an asset. Then what else do we have maybe from the additional information? From the additional information, number one, we have now the amount which this cooperative society was yet to receive from the marketing agency, which is Bora Limited. So we can just refer to that as the amount due. This is the amount which was not yet remitted to the bank account of the cooperative society by the marketing agency, which is known as what? Bora Limited. And this amount, because it is given in terms of US dollars, we have now to convert that now to Kenyan shillings. So we take the sales from Safi, 175,000 US dollars. We can just take it as 175. And then from the other coffee brand, 115.3. And then we get the total. We translate that now to the Kenyan shillings by multiplying that with the exchange rate on the date the money was remitted. So we have 175 plus 115.3 times what? Times 100. So this is the amount of money which now Bora Limited was yet to remit to the bank account of the cooperative society. So therefore to the cooperative society, this is basically an asset. So that's what we have in note number 1. Additional information, note 1. Note 2 has nothing to do with the sales. Note 3 is that is a liability. Note 4, that is still a liability. And then number 5 is still a liability. And then number 6, this one will affect now the appropriation account. I'll be able to show you now the necessary what? Adjustment we are going to make as far as that is concerned. Yes, so what we need to do here is to get now the total assets. So let's add all these assets starting from where we have 540 plus 6780 plus 26 550 plus 2690 plus 22,500 plus 900 plus 972 340 plus 29,030 030. Yes, that will give us a total figure here of 1,061,330. So those are the total assets. Next, we record now equity. Equity, this one comprises of a share capital, members deposit, plus the various items of what? Of reserves, of which all these items, they have a credit balance. So let's start by recording the share capital of this cooperative society that is given in the trial balance. Share capital is given as a figure of 900. So then below that we have members deposit, which is a figure of 64, 650. Yes, and then from there we have various items of reserves, starting with the just above the share capital entrance fee, we have statutory reserve fund. This one will need to be adjusted because whatever you given there as a statutory reserve fund, this is a statutory reserve fund at the start of the year, and then what you're told as per note number 6 is that 20% will 20% of the net earnings is the same with the profit for the year, will be transferred to statutory reserve fund. So this should be 20% of what? 20% of this profit for the year. 20% of that what? Profit for the year. So it should be 20% of 14,190. So that we get the statutory reserve fund at the end of what? Of the year. So then below that, or basically above that, we have revaluation reserve. Revaluation reserve that remain the same, which is a figure of 750. We are going to compute that figure. And still we have appropriation account. Appropriation account, these accounts still, or these figures still need to be adjusted because what you're given there is the appropriation account at the start, which is what? Which is 6050. To this, we should add the profit for the year. The profit for the year, remember, is 14,190, but equally we are going to less the amount which was transferred to the statutory reserve fund, which is 20% of 14,190. 14,190, and we get now the appropriation account balance at the end of the year. So I think we have picked all the items of equity. We have picked all items of what? Of equity. So I think what we just need to do here is to get now these final figures, starting with the statutory reserve fund. So let's first of all get 20% of this, 20% of 14,190 plus 13,740. That will give us 16,578. What about the appropriation account balance? So we have we have what? We have 6050 plus 14,190, and then to that we less what? We less 20% of 14,190, and that will give us 17,402. Yes. So those are the items of equity. So what we then need to do is now to get the total equity. Let's get the total equity by adding all these items, actually starting from there. We have 17,402 plus 750 plus 16,578 plus 64,650 plus 900,000. 650 plus 900,000 plus 64,650 plus 64,650 plus 900,000. 650 plus 900,000 plus 64,650 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 plus 9 900,000, which will give us 999,380. So that is the total equity. So what we need to do next, or actually finally, we need to record now the liabilities. We need to record now the liabilities. We need to record the liabilities. The liabilities. So we have various items of liabilities. Let's start with what we have in the additional information. In the additional information, number one, there is something, first of all, you need to remember that there was amount due to members. There was some amount which was this cooperative society was supposed to pay to the members, which was 80% of this amount, which was from the sales of the 2 coffee bread. So we can just compute that as 80% of this, 80% of 29,030. Although if you go back to what we prepared in Roman 1 and also all part A and part B, you can be able to see the amount due to the members as far as the sales of the 2 coffee bread is concerned. If you add those, the amount from Safi brand marketing account, Mzuri a brand marketing account, should be able to get the same figure here as 80% of the total sales of the 2 coffee bread. So we have 80% of 29,030. That will give us 23,224. This amount which this cooperative society was yet to pay to the members. So that's what we have in note 1. Number 2 is about exchange rate. Number 3, we have provision for audit fee. For audit fees, this amount was not yet paid. It was just provided for. So therefore, it is a liability, 6,000. And then number 4, we have accrued salaries and wages. Accrued salaries and wages is 3.2. And then below that, number 5, we have provision for interest on members' deposit. Members' deposit. Still, this amount are not being paid. It was purely provided for. That's why we are accounting for it as a liability there. I think that's what we have. Yes. So let's then go back to the trial balance and we pick now the other items of liabilities. Remember, all our liabilities, they have a credit balance. So starting from where we have dividends from members, below that we have accrued rent. Accrued rent, which is 470. Below that we have salary provision. Salary provision 4950. 4950. And then down there we have salary creditors. Salary creditors, which is a figure of 3410. And then we also have a bank OD, bank overdraft, of 6150. Yes. So I think we have recorded all items of liabilities. None of the item which you have not recorded. None of the item which you have not recorded. Yes. So what we just need to do here is now we get the total. We get the total equity and liabilities. So for the total equity and liabilities, we take the total equity there and then we add all these items of liabilities. But let first of all we add these items of liabilities. We have 23,224 plus 6,000 plus 3,200 plus 6086 plus 470 plus 4950 plus 3410 plus 6150. Yes, plus what we have there is 999 380. Okay, let me take that again. Okay, so we have what? We have 999, 380, and then we have 23,224 plus 6,000 plus 32 plus 6086 plus 470 plus 4950 plus 3410 plus 6150. Yes, so that is giving us the same figure there as 1061 330. 1061 330. So basically that is what was required in that part D of that question. These are the items now which were to be marked. The items to be marked, but definitely that particular statement of financial position, as you can see, there are so many entries, so many what entries, and basically by doing that, you are allocated 8 marks as far as that question is concerned. So that brings us now to the end of that particular illustration as far as the preparation of financial statements by cooperative societies are concerned. And I think that is the most recent question on cooperative societies. There is another question which was tested back in the year 2010. So if you can be able to access the past papers for 2010, you can be able to check a question which was tested. So I think was question number 4 from that particular sitting. So therefore, we stop at that particular point. See you in the next session as we move to a different topic.
Hello, welcome back to this revision session. We are still on the August 2022 setting of advanced taxation. So in this session, we shall answer question 2 of the paper. Question 2A is a mathematical question. So have your calculator and other materials ready, and let's go through the question together. It says, Bell Limited, a small-scale retailer, operates 2 sales outlets, one at the head office and the other at the branch. For the year ended 31st December 2021, the following results for the head office and the branch were presented to you. So we have an income statement for the head office. We also have an income statement for the branch. So the income statement starts from gross profits. They have other incomes for the year, they have expenses, and then the net profit reported for the year. Now the topic being tested here is advanced aspects of taxation of business income. Advanced aspects of taxation of business income. So under that we have several subtopics. We have taxation of companies, we have taxation of specialized institutions like banks, like contractors, like insurance companies, and all that. So that reminds you to have a look at that topic keenly and be able to answer the questions correctly. So I want us to go through the additional information one by one and be able to understand the effect of each on our computation. So additional information 1 says, goods worth 600,000 shillings were transferred from the head office to the branch at 10% below the normal selling price. First of all, you should understand that a branch of a company is not an independent taxpayer. Now, that reminds you about the rules in taxation of groups of companies. Number 1, in case of a group of companies, that is a parent company having subsidiaries and all that, each member of the group is treated by law as a separate and independent taxpayer. So if, for example, A Limited is a subsidiary of B Limited, then A and B are separate taxpayers. But on the other hand, a branch of a company is not an independent taxpayer. It is part and parcel of the head office. So when determining taxable income of such a firm, we do not separate the branch from the head office. So in this case, in fact, the question requires complete the combined adjusted taxable profit or loss of the year for the year ended that. So we have to combine the income statement of the head office together with that of the branch so that we determine the taxable income or loss of the entire firm. So let's go back to additional information 1. Goods worth 600,000 shillings were transferred from the head office to the branch at 10% below the normal selling price. Now, if you look at the income statement, we have a gross profit of the branch at 7 million shillings. Now, what is the effect of this? It means, in short, the head office transferred goods to the branch at a price below the normal price. So in short, the purchases of the branch were underestimated or were undervalued because the branch got these supplies at a price below their normal price. So what is the effect of that? If purchases are undervalued, it means the cost of sales will be undervalued, and so the reported profit will be overvalued. So to correct that, what we shall do is to work out the undervaluation of the purchases of the branch, and then we shall deduct it from the reported profit so that we correct that profit to get the exact performance of the branch. So we shall do that in the course of our computation. 2. 70% of insurance recovery was in respect of stocks destroyed by fire. The balance was on compensation on capital items. Now, if you look at the income statement keenly, under other items, there's what we call insurance recovery under the head office. The branch has none, but the head office has insurance recovery of 30,000 shillings. And we are told in note 2, 70% of that figure was in respect of stocks destroyed by fire. Then the balance was a compensation for capital items. The rule is here. Insurance compensation for loss of revenue items like inventory is a taxable income. But insurance compensation for loss or rather for capital items is not a taxable income. So in this case, what we shall do is short. 70% will be a taxable income, but the remaining 30% being a compensation on capital items will not be a taxable item. So that means this income has been overstated by 30%. So what we shall do is to deduct the 30% of 30,000 so that we arrive at the correct taxable income of the firm. 3. Staff salaries include provision for leave accruals equal to a third of the total salaries for the head office and the branch. Staff salaries include provision for leave accruals equal to a third of the total salaries for the head office and the branch. Now, for tax purposes, expenses are classified into two. We have allowable expenses and disallowable expenses. So in this case, there is this expense in the income statement called staff salaries. The first expense in that income statement for the head office is 240,000, for the branch is 90,000. Now the statement is a third of this is staff, is provision for staff leave accruals. Now for tax purposes, staff salaries are allowable expenses, but provisions are not allowable expenses. So what we shall do is, in short, is to separate the staff expenses and the provision for leave accruals so that we disallow the leave accruals, but we allow for the staff salaries. 4. The interest income recorded in the books of Bay Limited was gross, although Bay Limited received net of withholding tax, the interest income recorded in the books of Bay Limited was gross, although Bay Limited received net of withholding tax. Now, interest income is an investment income. Remember, investment income can be the form of interest income or dividend income. Now, for a company, withholding tax on interest income of 15% is not final tax. So in this case, we are told that the interest income recorded in the income statement were gross, although the company received the net amount, that is net of withholding tax. So what we shall do is simple. The gross amounts are taxable, yes, but when working out the tax liability of the company, we shall deduct the withholding tax on interest already paid by the company to arrive at the correct net tax payable or tax liability of the firm. 5. Bonus shares were from a company where Bay Limited has 30% control. Bonus shares were from a company where Bay Limited has 30% control. So if you look at the income statement keenly again, under other incomes, there is what they are calling bonus shares of 120,000 shillings received by the head office, that is Bay Limited. Now, bonus shares are a form of dividends. You know, there are many forms of dividends that a company can pay. A company can pay cash dividends. A company can do bonus issue of shares. A company can do scrip dividends and all that. Share split and reverse split and all that. Now, in this case, we are told these bonus shares were received by this company from another company where it controls 30%. Now, the rule is for dividend income received by a company from another company in which the receiving company controls 12.5% or more of the voting power of the paying company, then such dividends will not be taxable in the hands of the receiving company. So in this case, Bay Limited is controlling 30% of the paying company. What does that mean? This will be exempt dividends in the books of Bay Limited. So in short, I'm saying the bonus shares received by Bay Limited of 120,000 shillings will not be a taxable income. So we shall treat it so because it should not be taxed, because it is a form of exempt dividends. 6. Rent, rates and insurance paid for the branch. At the beginning of the year, rent accrued amounting to 24,000, and as at 31st December 2021, rent prepaid was 42,000. These had not been adjusted for in the accounts. Rent, rates and insurance paid for the branch. At the beginning of the year, rent accrued amounted to 24,000. And as at 31st December 2021, that is at the end of the year, rent prepaid was 42,000. These had not been adjusted for in the accounts. Now, if you look at the income statement, there is an expense they are calling rent, rates and insurance paid. Rent, rates and insurance paid. So the amount paid by the head office was 410,000 and for the branch was 110,000. But we are told this did not include the rent accrued at the beginning of the year and the prepaid rent at the end of the year. So what we shall do is simple. We shall adjust the rent rates and insurance account so that we work out the correct amount to be shown in the income statement. We compare that with what is actually recorded in the income statement, and then we shall treat the difference as required. Number 7. The lorry purchased was imported and duty paid was 130,000. This was omitted from the cost of the lorry. The lorry purchased was imported and the duty paid was 130,000. This was omitted from the cost of the lorries. Again, if you look at the income statement, under expenses, there is an item called purchase of a lorry at 3.2 million shillings. Now, purchase of a lorry is a capital expenditure which is disallowable for tax purposes. So we disallow the purchase of the lorry, but we should allow for capital allowance, that is wear and tear allowance. Now, in this case, the purchase price of the lorry, we are told, was 3.2 million shillings, and that excludes import duty of 130,000 shillings. So what we shall do is simple. We shall get the total cost of the lorry, that is the purchase price plus the import duty. Now for purposes of computing investment allowances, import duty paid on imported machinery is capitalized. That is, it is added to the purchase price so that we get the qualifying cost for purposes of the investment allowance. So what we shall do is simple. Add the 130,000 shillings to the 3.2 million. Use the sum to work out the investment allowance, which should be allowable instead of the purchase price of the lorry. 8. Retrenchment costs analysis. Retrenchment costs. Now, if you look at the income statement again, there is what they are calling retrenchment costs. For the head office, 2.5 million. For the branch, 1.3 million. But we have a breakdown here. Number one, we have provision for staff gratuity. Now, for tax purposes, provisions are not allowable expenses. So here we are told provision for staff gratuity for the head office 800,000, then pension payments 1.7 million. Now, what we shall do is to disallow the provision for the staff gratuity, then we allow the difference. So for the head office, we shall only allow 1.7 million out of the 2.5. For the branch, we shall allow 800,000 out of the 1.3 million shillings. 9 is about loss of stock. Fire raised down a warehouse where goods are stored before they are transported to the head office and branch. VAT at 16% was included in the stocks destroyed by fire. So if you look at the income statement again, there is what they are calling loss of stock. For the head office at 200,000 and for the branch at 500,000. So we are told this included VAT at 16%. Now we know VAT is not an expense for a farm. VAT is a tax, and taxes are not allowable expenses for a farm. So what we shall do is simple. Work out the VAT part of these figures, then we shall disallow the VAT parts because they are not expenses to the farm. And lastly, 20% of loan interest relates to a loan obtained to finance purchase of shares. 20% of loan interest relates to a loan obtained to finance purchase of shares. Now, interest on loan to purchase shares are not, or rather is not an allowable item for tax purposes. So what we shall do to disallow the 20% of the interest expense. Interest expense from the income statement is, so loan interest is 360,000. So we shall disallow 20% of that. Good, and allow 80%. Required 1. Compute the combined adjusted taxable profit or loss for the year ended 31st December 2021. And 2. Compute the tax payable or refundable for the year ended 31st December 2021 based on your results in A1 above. Now, in this case, we have an income statement already prepared for both the branch and the head office. So it means we are able to use the net profit approach to work out the adjusted taxable income. So we present it like this. The company is called Bell Limited. So we say we are answering question 2A. So we say Bell Limited, taxable income computation. For the year ended 31st December 2021. So we have the head office, we have the branch, then we have total. show currency, and we can carry 3 zeros to ease in our work. Good. So because we are using the net profit approach, we start with the reported net profit. So we say reported net profit for the head office is 2,310,000. We are carrying 3 zeros, so we write 2310. This is 4027. We can get the sum of that. So that is 2310 plus 4027. I'm getting 6337. Then we adjust this reported profits by 1, adding back. So we say add back. Now here we should add back 3 sets of items. Number 1, we should add back disallowable expenses which have been deducted according to the statement provided. So we go through the additional information and identify them from there. 1, we have note 2. Sorry, no. We have provision for loan for leave accruals. That is note 3. Provision for leave accruals. Provision for leave accruals. So note 3 says staff salaries include provision for leave accruals equal to 1/3. So we get 1/3 of each of the figures. So staff salaries is the first expense in the income statement. Head office is 240, so we get 1/3 of 240. 240 divided by 3, I'm getting 80. For the branch is 90, 1/3 of 90 is 30, that is 110 in total. Number 2, we have the rent rates and insurance. Rent rates and insurance. Rent rates and insurance. We need to run a working for this because of note 6. So we need to run a small working one. I'm doing it here. We are running rent rates and insurance account. Rates and insurance account. So I'm starting with the head office. So we go to note 6 of the question. It says rent rates and insurance paid for the branch. So this is for the branch. It is particularly for the branch. Sorry, not the head. The head office is not affected. It is for the branch. So we are told rent accrued amounted to 24,000 at the beginning of the year. Rent accrued is a liability, so we credit that. So we say balance brought down 24. Then as at the end of the year, rent prepaid was 42. Prepaid rent is an asset, and at the end of the year we should credit it. So we say here balance carried down 42. Then if you look at the income statement, rent paid, rent rates and insurance paid for the branch was 110, which we should debit. So we say bank 110. We balance off the account. This is 110. We work out the balancing figure. That is 110 minus 42 minus 24. 44. So the correct figure to be shown in the income statement is 24. This is what should go to the income statement. But what do we have in the income statement? In the income statement we have 110, to mean that the expense shown in the income statement for rent, rates and insurance is overstated. So to correct that, we should add it back. We should add back the difference. So we do 110 minus 44 is 66. We should show that here because it was an overpayment for rent, rates and insurance. 3, we have loan interest to finance purchase of shares. Loan interest to finance purchase of shares. I'm talking of note 10. So loan interest in the income statement is 360,000. So we get 20% of 360,000, and that is 72. So we disallow that, we add it back. Next we have note 8, we have note 9, which is about VAT on stock destroyed by fire. VAT on stock destroyed by fire. So if you look at the income statement, loss of stock was 200,000 for the head office and 500 for the branch. So this includes the VAT. So what we do is simple. We exclude the VAT component, that is 16 out of 116 of 200,000. I'm getting 27.59 for the head office. And then we are told fire rest down that where goods are stored before they are transported to the head office and branch. Then for the branch it will be 16 out of 116 times 500,000. I'm getting 68.97. We get the sum of the two, 27.59 plus 68.97. I get 96.56. Note 8 is about retrenchment cost analysis. That includes provision for staff gratuity, which is disallowable. So we write here provision for staff gratuity. For the head office is 800, for the branch 500, a total of 1.3 million. We have note 7. Note 7 is about purchase of the lorry that cost 3.2 million. Then the duty paid was 130, which is exceeded. But purchase of lorry we know is a capital expenditure. We should disallow that, but we shall allow for capital allowance. Purchase of lorry, it is 3.2 million for the head office, which is a disallowable expense. We have retrenchment costs. We go back to the income statement and identify any other disallowable expenses. So we move through the income statement, be very keen, and identify the items. So one, we have staff salaries, which we have dealt with in part 1. We have maintenance expenses, those should be allowable. Preliminary expenses are allowable. Retrenchment costs, we have the analysis which we have taken care of. Rent rates and insurance paid, we have dealt with. We have goodwill written off, that is not an allowable item. So we write here goodwill written off. Goodwill written off is 20,000 for the head office. We have legal and accountancy fee allowable. Depreciation is a disallowable item for tax purposes. We add it back. Depreciation is 180 for the head office, 70 for the branch, 250 in total. Interest on overdue tax is disallowable because it's relating to a tax offense. Interest on overdue tax. 80 for the head office, nil for the branch, 80 in total. We have subscriptions to golf club for directors. Subscriptions to clubs for business purposes are allowable, so we don't have to add it back. We have donations. Now donations can be allowable or disallowable depending on whether they meet the conditions, the required conditions or not. So here we just have donations. We are not told whether this met the conditions or not. So we can go either way. One, we can assume that the donations met the required conditions so that they are allowable, and if they are allowable, we do not add them back at this point. Two, we can also assume that they did not meet the required conditions so that they are disallowable. In that case, we shall have to add them back. So we can make a note and an assumption. So under notes and assumptions, we can write, if we assume, let's assume these donations met the conditions. So we can write under notes and assumptions, one, that donations are assumed to have met the conditions, the required conditions, hence allowable. I repeat, the donations are assumed to have met all the required conditions, hence are allowable. By the way, we should also know those conditions. The conditions are only four. Number one, the donations must strictly be in the form of cash. Number two, the recipient must acknowledge receipt of the donations. Number three, the recipient must be an institution exempted from tax. That means they should have a tax exempt certificate. And then number four is that the donations, the donor must not receive any consideration for the donation. In other words, there must be no consideration for the donation, to mean the donor must not receive anything in exchange for the donation. So if all those conditions are met, then donations are allowable for tax purposes. If not all of them are met, then such donations will not be allowable for tax purposes. So in our case, we are assuming that the donations met all the required conditions, and so they are allowable. So in that case, we don't add them back here. Okay, we continue. Next, we have general administrative expenses. Administrative expenses are allowable for tax purposes, so we don't add them back. We are using the gross net profit approach. Purchase of a lorry is already here as a disallowable expense, but we shall allow for investment allowance. Loss of stock is an allowable expense, but we have the VAT component, which we have added back as a disallowable item. Loan interest we have taken care of in note 10. Yes, note 10. Directors' remuneration is allowable. For a company, directors' remuneration is an allowable expense. Then lastly, we have pension contributions, which should be allowable expense for tax purposes. So up to there, we can now get total disallowable expenses. But in other questions, you could meet other items that need to be added back. So I said at this point, we add back three sets of items. Number one, disallowable expenses which have been deducted according to the statement provided. Number two, we should add back any taxable items or incomes which have not been taxed according to the statement provided. Then three, we should also add back any items understating the reported performance of the firm. In our case, we do not have the last two sets. So this is all we have to add back. So let's do it keenly and get the correct figure. So I'm on the head office, 2310, 80, 72, 27.59, 800, 3200, 20, 180, and 80. I'm getting 69.59. I move to the branch, 4027, 4027, 30, 66, 68.97, 500, and lastly 70. And that should give me 47, 61.97. We get the sum of the two, 6769.59. I get 11,531.56. That is the first step. The second step is to analyze the deductions. So I'm continuing from here. We have the head office. We have the branch, and then total. Continuation. So here we say less. What do we deduct? We deduct three sets of items again. Number one, we deduct any non-taxable incomes which have been taxed according to the statement provided. Two, we should also deduct any items overstating the reported profits. And then number three, we should deduct any items that, any allowable items or expenses which have not been deducted. So I want us to pick it from there. Number one, we should have investment allowance on capital expenses. Investment allowance. I want to run a small working too. Now, if you look at the income statement, there was purchase of a lorry. There was a lorry purchase at 3.2 million, which has been shown as an expense. So we disallowed that, remember, under disallowable expenses. And then we have note 7, which says that 3.2 million does not include 130,000 that was import duty paid on the lorry that was imported. So we disallow the cost, but we should allow for investment allowance. So I'm working it here. So investment allowance. So investment allowance on the lorry, that is. So a lorry is a vehicle. Vehicles qualify for investment allowance at the rate of 25% currently. So we shall have 25% of the purchase price, that is 3.2 million, plus the import duty, that is 25% of 3200 plus 130 should be 3330 times 25% gives me 832.5. So we should allow this. This is what we bring here, 832.5. The sum is still the same figure. Good. Other items to be deducted. In the income statement, they are showing bonus shares as an income, and we discussed and agreed that is an exempt dividend which should not be taxed on this company. So we write here bonus shares. Bonus shares. You pick it from the income statement at 120. 120. Next we have insurance recovery. Insurance recovery. On note 2. 70% of insurance recovery was in respect of stocks destroyed by fire. The balance was on compensation for capital items. So the balance is 30%. So we get 30% of 30,000. 30% of 30,000 should be 9,000. So we write here 9. Next we have understatement of purchases for the branch. Understatement of purchases for the branch. In note 1, we are told goods worth 600,000 were transferred from the head office to the branch at 10% below the normal price. So we argue like this. 600,000 in this case represents 90%. So then what is the 10%? We can run it as a small working 3. working 3. I'm doing it here under statement of purchases. So that will be 10 over 90 times 600,000. We work it out. 10 over 90 times 600. I'm getting 66.67. 66.67. And that. I move to I move to the income statement again. Under the list of incomes, we have what they are calling gain on sale of land and buildings. Now that is a capital gain which is taxed at a specified rate of 5%. Remember the withholding, the capital gains tax rate is 5%. So that cannot be taxed at the corporation tax rate. So we write here gain on sale of land and buildings at how much? 600 for the branch. Next we have gain on shares sold. Gain on shares sold. 30 for the head office, nil, that is 30. And interest income, we were told in note 4 that they have been stated at gross, though the company received them net of withholding tax. So those are taxable as they are, so we don't deduct them at this point. And up to there, we have analyzed all the incomes, so we can now get the adjusted taxable income. Adjusted taxable income. So we start with the head office. So the adjusted taxable income will be the reported net profit plus the additions less the deductions. So we start like this: 69.59 less 832.5 less 129 and 30. That gives me 5778.09. For the branch is 4761.97 less 66.67 and 600, giving me 4095.3. The sum of this must also be equal to the vertical sum. So we do plus 5778.09. It should be 9,873.39. We can confirm that this way. We do 11,531.56 less 832.5, 129, 66.67, and then 630. I get 9873.39. Good. So that answers part A, Roman 1, the determination of taxable income. Part 2 is asking for tax liability. We can do it like this: tax liability. Now this is a company. Companies pay taxes at the prevailing corporation tax rate. So we shall say gross tax liability is equal to 30% of the adjusted taxable income. That is 9873,390. I'm now bringing in the 3 zeros we had carried. So we have 30% of 98,73,390. I'm getting 2,962,017. But remember, we were told in note 4 that the company received the interest income from the finance companies, finance institutions, net or withholding tax. So withholding tax is already paid on the interest income. So we should bring here, say less withholding tax on interest income. So we go back to the income statement. There were two interest incomes. One was from Lex Bank. So we say Lex Bank. Withholding tax rate on interest income is 15%. So we do 15% of the gross amount. We are told the stated figures here were gross or withholding tax. So this is 180,000. We do it together. We shall have 15% of 180,000, which is 27,000. We deduct that. 2, we have the interest income from Beta Microfinance. So you write here Beta Microfinance. That is 15% of the amount there is 200,000. We do that. 15% of 200,000, I'm getting 30,000. Good. And that is the last one. So the difference between that should give us net tax liability. So we do it like this. We shall have the gross tax liability less the withholding taxes. So 29,62,017 minus 27,000 minus 30,000. I get, just a minute, 2,962,017 minus 27,000 minus 30,000. I get 2,905,017. And that becomes the firm's net tax liability for the year 2021. Okay, that is question 2A, computation on taxation of business income. We can now move to question 2B1, 2B Roman 1. It says, a tax agent is an important stakeholder in the alternative dispute resolution ADR process. A tax agent is an important stakeholder in the alternative dispute resolution ADR process. Analyze the roles of a tax agent in relation to the ADR process. So there are two key important terms we should understand here. One is tax agent. A tax agent is simply a person licensed and authorized to handle the tax matters of a taxpayer. And remember, a tax agent could be an individual person or a partnership. So in short, I'm saying a tax agent is simply a person licensed and authorized to handle tax matters of a taxpayer. The other key term here is ADR, alternative dispute resolution. And now ADR is simply a dispute resolution mechanism outside the normal court processes, outside the normal judicial system. Basically that. So we are asked to analyze the roles of a tax agent in relation to the ADR process. Now, they are numerous. I'll explain the required number. Now, we can say the following are the roles of a tax agent in relation to the ADR process. The following are the roles of a tax agent in relation to the ADR process. Number one is to apply for the ADR in consultation with the taxpayer. Now, if a taxpayer has an issue which they wish to have resolved through the ADR process, then they have to apply for that hearing. And so This can be done by the tax agent on behalf of the taxpayer. So in relation to the ADR process, number one, a tax agent can apply for the ADR process in consultation with the taxpayer that they are representing. Number two is to attend the ADR meetings on behalf of the taxpayer. Now, one of the requirements in the ADR process is that the taxpayer must be present either in person or through their agents. And so, where a taxpayer is an agent, then such an agent may attend the ADR processes on behalf of the taxpayer. Three is to prepare and submit all documents required during the ADR process in consultation with the taxpayer. In an ADR process, it may be a requirement that certain documents be presented before the ADR proceedings, normally by or rather chaired by a facilitator. So in that case, to argue for and on behalf of the taxpayer, the tax agent has to prepare and submit such documents to the ADR proceedings on behalf of the taxpayer. Number four is that is responsible for performing any duty or obligation imposed by the tax law on the taxpayer, including submission of returns and payment of taxes required or resolved to be paid by such a taxpayer during the ADR process. In short, I'm saying this tax agent has the responsibility of performing any duty that the tax law imposes on the taxpayer, such as payment of taxes and required penalties as resolved by the ADR proceedings. And we can add more, advise the taxpayer on the ADR processes to ensure adherence to to the guidelines and timelines set by the ADR agreements. So in ADR processes, there will be agreements on how to go through the ADR process. So there will be guidelines and timelines set to hear the case. So in that case, the agent will advise the taxpayer on the ADR rules and processes so that the taxpayer adheres to the guidelines and timelines as agreed through the ADR proceedings. So those are some of the roles of a tax agent in relation to the ADR process. Key things to pick from there. Number one, know everything about a tax agent. Know who a tax agent is, obligations of a tax agent, know about qualifications of a tax agent, know about the licensing of a tax agent, and the roles of a tax agent in various tax issues, such as and including ADR. Lastly, part B of question 2 says, explain the circumstances under which the commissioner may cancel the license of a tax agent. Still touching on a tax agent, explain the circumstances under which the commissioner may cancel the license of a tax agent. Now, a tax agent must be licensed by the commissioner before they can serve a taxpayer as their agent. For a tax agent to be licensed, number one, they must apply for that particular application. Number two, they must receive a recommendation from what we call tax agent committee, and so on and so forth. So a tax agent can never practice until they are licensed to do so by the commissioner. Now, this license issued to a tax agent may be cancelled in certain circumstances, and that is now what the question is. So we have to explain the circumstances under which the commissioner may cancel the license already issued to a tax agent. There are many reasons, the circumstances under which this may happen. Number one is where, sorry, we can introduce that just to be organized. We can say the commissioner may cancel the license of a tax agent under the following circumstances. The commissioner may cancel the license of a tax agent under the following circumstances. Then you can go ahead and explain those circumstances. One is where the tax agent assess the taxpayer to evade taxes. Now we know tax evasion is a criminal tax offense, and if you are found guilty of tax evasion, and if a tax agent assesses a taxpayer to evade taxes, then the tax authority may punish that tax agent through cancellation of their practicing certificate or license. 2 is where the tax agent fails to notify, where the tax agent fails to notify the commissioner as required under Section 22(1) of Income Tax Procedures Act. So Section 22(1) requires the tax agent to notify, rather to inform the commissioner of certain issues affecting the taxpayer in relation to taxes they should pay. So where the tax agent fails to do that notification, or to give that notification to the tax authority, then their punishment could include cancellation of their license. Another one is failure to pay all prescribed fees during application and renewal of practicing license. Now, this license issued to a tax agent must be renewed after a given period of time. So where a tax agent fails to renew or even to pay the relevant fees prescribed for this, then the commissioner may cancel their license. Another one could be cessation to carry on the business of a tax agent and fail to notify the commissioner within the required time. Now, if you are licensed to serve a taxpayer as their tax agent, then you cease to do that business, you cease to offer that service, and you do not notify the commissioner about that cessation, then that is an offense under tax law. And so one of the punishments you may receive from the commissioner is the withdrawal or the cancellation of that license. Another one is where the tax agent takes advantage of the taxpayer's lack of technical knowledge about tax law. Now, in taxation, we have what we call ethical guidelines for tax practitioners, where a tax agent is a member. Now, some tax practitioners may really take advantage of the ignorance of the taxpayers and, loot their resources or, get undue benefits from them for themselves from such a taxpayer. Now, where it is determined by the commissioner that a tax agent has taken advantage of the ignorance or lack of technical knowledge of the taxpayer, then the commissioner may withdraw or cancel the license of such a tax agent. And lastly, is recommendation, where there is a recommendation to cancel such a tax agent's license by the tax agent committee. We said that for tax agent to be licensed, they must receive a recommendation from the tax agent committee. So where there is a recommendation from the same committee to withdraw such a license already issued, then the commissioner will not have no otherwise but to withdraw or cancel such a tax agent's practicing license. So all those are possible circumstances under which the commissioner may cancel the license of a tax agent. Good. That is question 2B, and that is the end of question 2. So that is the end of the paper. It was quite a detailed paper with a lot of deep questions, both theory and computation. That reminds you to take your time, be sure you can go through each topic keenly so that you get every single detail of each concept. If you look at the paper keenly, number one, you realize that there were 2 questions touching on taxation, advanced aspects of taxation of business income. One, we have question 2, which is about taxation of companies, advanced aspects of taxation of companies. Then we had question 4, which is about taxation of insurance companies. So in a typical advanced taxation paper, you expect that. The only thing is you may not know which part will be tested when. So be keen to do that topic keenly and be able to answer such questions. It is a must you'll have 2 or more questions on the topic of advanced aspects of taxation of business income. Another very common computation today is VAT. So make sure you understand VAT, both the theory and mathematical part. You remember we had a good question on VAT computation. It was majorly testing the concept of tax point in VAT computation. So we had both a theory and a computation question. Take your time to do that. Question 5 was a question testing a bit of theory and a computation on preparation of capital statements. Almost a must in the exam. The topic of tax investigations will hardly miss in any paper. So again, take your time and go through that keenly. Then lastly, the topic had a lot of questions on taxation of cross-border activities. So almost a must in the exam again. Take your time, know the concepts in that topic, know how to compute what we call double taxation relief, that is under double taxation treaty, understand the concept of transfer pricing, tax havens, and all that. So that was the paper, and you can continue doing the questions and other relevant questions so that you get more insight into them. Have a good day.
Hi candidates, welcome to another session of Manifested Online Classes. My name is Joseph Kimani, your lecturer for Financial Reporting and Analysis. So in this session, I want us to look on the last topic in Financial Reporting and Analysis, and the topic is the analysis of financial statements. So as far as this topic is concerned, we are going to discuss a number of issues. One, we are going to look on what is analysis of financial statements, what are maybe some of the importances of the same, the limitations of financial statement analysis, and then later on we are going to look on various tools which can be applied, which can be used by a financial analyst in terms of analyzing the financial statement, majorly the income statement and the statement of financial position. But to start with, I want us to define what is the analysis of financial statement. And as the name suggests, this is the process of analyzing the financial statement prepared by the company for the financial analyst to extract extra information or basically additional information which then will be used in terms of making what decision. For example, if the management of the company want to make some decision, they may need a financial statement now to be analyzed further, so that now the information which will be given or provided to them then can be used in terms of what? Analyzing the financial statement. So therefore, analysis of financial statement, we have said that this is a process, the process of analyzing financial statements, of a company, for the purpose of decision making, making, of which in this case the person who analyzes the financial statement prepared by the company, that person is known as financial analyst. So what the financial analyst will do, for him to be able to analyze the financial statement of the company, he must be provided with copies of financial statement prepared maybe for the last 2 or 3 years, combined with other information of the company like the auditor's report, the director's report, and then we will be able to extract more information, which we are saying then will be used in terms of making what? A decision. Now, in this case, what I've said is that we have various tools, or basically various techniques, which are used in terms of analyzing the financial statement. But before we look on or we discuss in details those particular tools or analysis or techniques used in analyzing the financial statement, maybe first of all we can look on the qualities of a good financial statement analysis, qualities of a good financial statement analysis. Financial statement analysis, this is abbreviated as FSA. We have basically a number of qualities here. Number one, we can talk of reliability. We can talk of reliability. So basically what this means is that the information which will be provided by a financial analyst, or basically the person who is charged with the responsibility of analyzing financial statement, that particular information must be relied upon by the users, or the users should be able to rely on that particular information for them to be in a position to make a number of what? Decisions, of which in this case we say that that information is actually reliable. One, if that information which is provided by the financial analyst is free from any error, and number two, that particular information is complete. All what now the users need to be provided to them is provided by the financial analyst, and also on the other hand we say that that particular information is what? Neutral. So therefore in this case information which is provided by financial analyst is said to be reliable. One, if that information is free from any error, free from any error. Number two, that particular information is complete, and also on the other hand that particular information is what? Neutral. So if that is the case, then we say that the information provided by financial analyst is what? Is reliable. Number two, or the other quality of a good financial statement analysis is what we refer to as relevance. Relevance, or basically we can talk of relevancy. So when talk about the information being relevant, it means that once a financial analyst has analyzed the financial statements of the company, then that information must be relevant. Relevant means that the users should be in a position to use that particular information in terms of making their intended decision. Otherwise, if the users cannot be able to use that particular information in terms of making the intended decision, then we say that that particular information is not what? Is not relevant. So therefore, information here will be said to be relevant if that particular information can influence information provided by financial analyst, analyst must influence users' decision, must influence the users' decision, must influence the decision now which will be made by the users. Otherwise, if that particular information cannot influence the decision which will be made by the users, then by the end of the day we are saying that information is not relevant, relevant. So the other quality of a good financial statement analysis is timeliness. Timeliness. What do you mean by timeliness? It means that for a good or for any information which is provided by financial analysts to help the users in terms of making decision, then that particular information must be provided on time. Otherwise, if the financial analyst has analyzed the financial statement and he does not provide that information on time to the various users, the users cannot therefore be able to do what? To use that particular information in terms of making what? Decision. So therefore, the information must be provided on what? Must be provided on time. Then we also have the other quality of a good financial statement analysis, and that is what we refer as understandability. stability. Basically, what this means is that the information which is provided by financial analyst, equally that information must be readily understandable. The various users should be in a position to understand that particular information such that they can be able now to rely on it in terms of making their what intended decisions. So therefore, these are some of the main, or basically these are some of the qualities of a good financial statement analysis. Now, equally what you have said is that a financial analyst, when analyzing the financial statement prepared by the company, applies or basically uses various tools or techniques. And I've said as per your syllabus, we should only cover two, something called the ratio analysis, and number two, what we refer as the common size, or also known as the vertical analysis. So therefore, we can look on the tools stroke techniques of FSA. FSA, we have said this is financial statement analysis, and actually this is the same with the analysis of financial statement. So the tools or the techniques which are applied by a financial analyst include, we have two main of them. So we can say that these tools include number one, ratio analysis, and number two, we have the common size. This one is also known as the vertical analysis, though we also have another one, number three, which is called the horizontal, also known as the trade analysis, but as per your syllabus, as per the syllabus of FRA, we need only to cover the first two. So we are not going to cover the third one. This is something which is covered in financial management intermediate level. So let's start with the common size. We start with the common size, which is also known as the vertical analysis. So what do you mean by the common size or the vertical analysis? So this is a tool or a technique of analyzing the financial statement, majorly the income statement and the statement of financial position, and it entails expressing all the items in the financial statement as a percentage of a certain base item. So mean that the items in the income statement, the items in the statement of financial position will be expressed as a percentage of a certain base item. So therefore, you can say that this entails expressing all items in financial statement as a percentage of a certain base item, So therefore, we are saying all the items which are included in the income statement, in the financial statement, will be expressed as a percentage of a certain base item. Now, here we have the common size, or the vertical analysis of the income statement, and that one entails converting or expressing all the items in the income statement as a percentage of the company's revenue, or as a percentage of the company's sales. The objective here is that the financial analyst want to establish the relationship between the items of the income statement and the company's revenue. This particular information is very, very important to the management of the company, especially when it comes to decision making. So therefore, we have the common size, which is also known as the vertical analysis, vertical analysis of income statement, statement. And in this case, we have said that this entails expressing items in the income statement as a percentage of revenue, That is very, very important. All the items in the income statement will be expressed as what? As a percentage of the company's what? Revenue. And we have said that the objective of this particular analysis here is to know the relationship between the items of the income statement and the company's what? Revenue. Basically, what we have said is that that particular information mostly is will be used by the management of the company in terms of making what? Decisions. Like maybe let's assume that a financial analyst has been able to do this analysis. He has expressed all the items in the income statement as a percentage of the company's what? Revenue. And for example, we assume that we are given this particular results. So we have the revenue. So revenue, always this one, whenever it is expressed as a percentage of itself, is always 100%. Also, let's assume that we are given the cost of sales here as a percentage of revenue to be something like 60%. Maybe other expenses like administrative expenses to be something like 20%, and so on. So how is this particular information important to the management of the company? This information is important because as a manager of the company, you can see that the relationship between administrative expense and revenue is 20%. What that means is that for every 100 shillings of the revenue which is made by the company, 20 shillings basically is used by the company in terms of catering for administrative expenses. 60% of such amount, for every 100 shillings of the revenue, 60 shillings is used by the company to cater for what? The cost of sales. So you can see this information is important to the management of the company, particularly when it comes to making now the internal what? Decisions of the company, and maybe decisions regarding the management of the company's operating what? Cost. So therefore, that's what we mean by the common size or the vertical analysis of the income statement. Number two, we have the common size stroke vertical analysis of statement of financial position. So what do you mean by this? So this, on the other hand, entails expressing all the items in the company statement of financial position as a percentage of the company's total assets. So everything in the statement of financial position will be converted as a percentage of the total assets. So we can say that this entails expressing items in statement of financial position as a percentage of total assets, total asset. And equally in this case, the objective here will be to establish the relationship between items in the statement of financial position and the company's total what? Asset, and the company's total asset. So therefore, that's what we mean by that first tool of analysis, which is known as the common size. But equally in this case, we are saying it can also be known as what? The vertical analysis. So there was a question which was examined on this in the sitting of August 2022, but you're going to look on that particular question as one of our illustration question. But before we do that, I want us to discuss on the other tool of analysis, and that is what we refer to as the ratio analysis. Ratio analysis.
Hello everyone and welcome to the lesson. The topic is forensic accounting. Today we are going to study the regulations and standards on forensic accounting. Welcome to the lesson. Now, candidates, here in Kenya, forensic accounting is regulated by various laws, regulations and professional standards. In our today's lesson, we are going to highlight the key regulations and standards that apply to forensic accounting in Kenya. The first is the Companies Act. 1. Companies Act. The Companies Act. Now, the Companies Act provides regulations and guidelines for the formation, operation, and management of companies in Kenya. And this act includes provisions related to financial reporting, auditing, and corporate governance, which are essential areas of forensic accounting. So if you are to do forensic accounting, then the Companies Act is a document that you may be referring to from time to time, because it is the Companies Act that provides regulations and guidelines for formation, operation, and management of companies in Kenya. And there are provisions on auditing, there are provisions on financial reporting, and there are also provisions on corporate governance, which are essential areas of forensic accountants. For forensic accountants. Number 2 is the Public Financial Management Act. The PFM Act. The Public Financial Management Act. Now, candidates, the Public Financial Management Act governs the management and control of public finances in Kenya. This act establishes the rules, this act establishes the regulations and procedures for financial reporting, procedures for auditing, procedures for accountability in the public sector. So forensic accountants may be involved in investigating financial irregularities and fraud within public institutions. And therefore, the Public Financial Management Act may also be relevant in forensic accounting. Public Financial Management Act. The third one is the Accountants Act. The Accountants Act. The Accountants Act. The Accountants Act establishes the Institute of Certified Public Accountants of Kenya as the professional body responsible for regulating the accountancy profession in Kenya. This act sets out the requirements for professional accountants, including forensic accountants, regarding qualifications, registration, and ethical conduct. So a forensic accountant may also find the Accountants Act very useful in carrying out his or her duties. Accountants Act. Number 4, International Standards on Auditing. the ISAS, International Standards on Auditing. Now, forensic accountants in Kenya are expected to follow the International Standards on Auditing issued by the International Auditing and Assurance Standards Board. And these standards provide guidelines on the responsibilities, the procedures, and reporting of auditors, including forensic auditors. It's very important, and Kenya adopts international standards on auditing. This is international standards on auditing, which are applicable here in Kenya. 5, Code of Ethics for Professional Accountants. Code of Ethics for Professional Accountants. Code of Ethics for Professional Accountants. Candidates, the Institute of Certified Public Accountants of Kenya has a Code of Ethics for Professional Accountants that sets out ethical principles and standards for accountants in Kenya, including the forensic accountants. And forensic accountants are required to adhere to these ethical guidelines, which include integrity, objectivity, confidentiality, professional competence, and due care, and so on. Professional behavior as well. Code of Ethics for Professional Accountants as issued by ISPAC. Code of Ethics for Professional Accountants. Forensic accountants are professional accountants. Okay? The 6th point is what we call POCAMLA. 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 POCAMLA stands for Proceeds of Crime. Proceeds of Crime and Anti-Money Laundering. Proceeds of Crime and Anti-Money Laundering. Laundering means cleaning. Laundry, like this court took it from the laundry the other day. So laundering, money can also be laundered. Money can be cleaned. So proceeds of crime and anti-money laundering. POCAMLA. POCAMLA. Po, P, then this O, C, A, M, La, Act. Okay? POCAMLA. Proceeds of crime and money laundering. This S stands for Act. Now, candidates, POCAMLA provides measures to prevent and combat money laundering and the financing of terrorism in Kenya. And therefore, forensic accountants may be involved in investigating financial transactions and assisting in the reporting of suspicious activities required by the Act. So when carrying out forensic accounting, the forensic accountants may, from time to time, make reference to the Proceeds of Crime and Anti-Money Laundering Act. We are studying regulations and standards on forensic accounting. The Evidence Act is another record, important one. Evidence Act. The Evidence Act. The Evidence Act governs the admissibility and the presentation of evidence in legal proceedings in Kenya. And forensic accountants may need to comply with the Act when presenting their findings, when presenting their evidence in court or other dispute resolution processes. The Evidence Act. Then we have the Data Protection Act. Data Protection Act. Data Protection Act. This with the data privacy and confidentiality. Forensic accountants handle sensitive financial information during investigations. So they must comply with the data privacy and confidentiality laws, such as the Data Protection Act. So candidates, these are some of the key regulations and standards that are relevant to forensic accounting here in Kenya. And therefore, it is important for forensic accountants practicing in Kenya to stay updated on any changes or updates to the regulations, as well as standards, and ensure compliance with specific requirements or provisions as stipulated within these documents. So as a forensic accountant, you must be well versed with the provisions of the Companies Act, the Public Financial Management Act, because forensic accountant may be called upon to carry out investigations in public institutions. There's the Accountants Act, International Standards on Auditing, Code of Ethics for Professional Accountants, Proceeds of Crime and Anti-Money Laundering Act, the Evidence Act, and Data Protection Act. So thank you for attending the lesson. We will meet in our next session as we wind up our studies on forensic accounting. Bye-bye.
Hello there, I'm Patrick Kamau Kamure, and I'm the one who is taking you through the advanced taxation, where I continue teaching you about the taxation of the businesses. And so far, we have been able to look at the partnership, which we said it consists of two areas: the admission and retirement of a partner during the year, and also the conversion of a partnership into a limited company. Once we are done with that, then we go to the taxation of the limited company. Now, we have been able to look at the questions about the admission and retirement of a partner during the year, and also the conversion. But in the conversion, we were able to only look at one side of determining the taxable income. That is when you are required to use the net profit method. So how about in case where you are required to use the gross profit method? How do you go about it? So I want us to look at a question concerning that. This question comes from November 2015, question number 3. And I want us to go through it. This is what the question says. James and Katana established a partnership business, sharing profits and losses in the ratio of 3:2 respectively. The following is the income statement of the partnership for the year ending 31st December 2014. We have the sales consisting of unrealized foreign exchange gain, capital gain on sale of shares, recovery from insurance on stock stolen, goods transferred to a branch at cost, dividend from Kali Cooperative Society, and total incomes. Then rest expenses which you have: purchases, purchase of computers, partner salary, legal fee, repair and maintenance, rent and rates, interest on loan, general expenses, motor vehicle expenses, insurance, preliminary expenses, director's fee, audit fees, debenture interest, traveling expenses, and net loss. Additional information number 1, the partnership was converted into a limited liability company by the name Kaka Limited on 1st October 2014. Incomes and expenses accrued evenly through the year unless otherwise stated. Number 2, purchases and sales were inclusive of VAT at the rate of 16%. Closing stock was valued at 1840,000, while opening stock was at 10,000 of the sales, net of value added tax. Number 4, legal fee comprised petition to Association of Manufacturers, notice for change of business name, conveyance fee for business premise, stamp duty, negotiating a business loan, recovery of bad debts, signing a 100-year lease agreement, purchase of partners' private residence by James, appeal against tax arrears. Number 5, repair and maintenance comprised purchase of furniture, installation of neon sign, designing of an office block, cost of partitioning office block, repainting of the business premises. Number 6, general expenses included registering of patent rights 64,000, flotation costs of 48,000, and negotiating costs for an additional piece of land for business expansion at 56,000. Number 7, interest on loan include interest on partners' capital of shillings 100,000, which was shared according to the profit and loss sharing ratio. Required: 1, a statement of adjusted taxable profit or loss for the business for the year ending that 1st December 2014. Hint: start with gross profit. B, comment on the tax position of James, Katana, and the company. C, citing examples, advise James Katana on 2 areas of tax avoidance that they could explore for the business. So we can see in this question, we are required, number 1, to get the statement of adjusted taxable profit loss of the business. Now, in this case, you take note that there is a conversion. A partnership business that was existing was converted into a limited company as per additional information number 1. And from the additional information number 1, we can see the partnership business lasted for a period of 9 months, and then the limited company 3 months, because the conversion happened on 1st October 2014, and the year of income is ending on 31st of December 2014. So how do we go about getting the taxable income? Remember, we say that conversion, we always use the gross profit method unless it is stated otherwise. Now here it is hinted that we start with the gross profit. Although they have hinted, they don't have to hint. Even if they haven't hinted, we are supposed to use the gross profit method. When they say you start with gross profit, they mean that gross profit become one of your first income, and that does not mean that you look for gross profit somewhere and then you transfer here. No. What you do, you have to post the sales, the cost of sales, you get the gross profit, and then you continue from there. Another thing that we said about the conversion is we must be able to separate the two business, the period of the partnership and the period of the limited company, because these are two different businesses. So when we are taxing them, we tax them separately and differently. So here we start. So as we have noted, the partnership lasted for a period of 9 months in that year, and the limited company 3 months in that year. So here we are using the gross profit method. So we start with the sales. We'll start with the sales. So we take 9 over 12, 3 over 12 of the sales figure given is 67,28,000. But there's something that we are told about this sales. If you look at additional information number 2, we are told that the purchases and sales were inclusive of VAT at the rate of 16% where applicable. So that means this sales has VAT. So this sales is at 116%. Remember, when you're getting the taxable income, VAT should not be factored in anywhere. So if they have the VAT, we need to remove the VAT. So we want to get the sales without VAT. So if this is 116%, we must be willing to get the 100. So take note that we are not interested in the VAT, the 16%. No, we want the cost without VAT, the 100. So if this is 116, 100 will be what? Cross multiply. It will mean that you multiply by 100 over 116. So 67,28,000 times 100 divided by 116, and then this we get is 5,800,000, and then we take times 9 over 12. That gives us 4350, and this other one is going to be 5,800,000 times 3 over 12, which we get 1450. Now, gross profit method, after getting the sales, we normally less the cost of sales. For the cost of sales, we normally start with the opening stock, of which case in this question, the opening stock we are told in additional information number 3. Closing stock was valued at 1840, while opening stock was 10% of sales net of VAT. So the opening stock is 10% of the sales net of VAT. The sales that is net of VAT does not have the VAT is 5,800,000. So you take times 5,800. That translates to 580,000. And then we add the purchases. The purchases is in the income statement. The first expense actually 2842. So plus 2842,000. But we are told this one as well, in additional information number 2, it had the VAT. So we must exclude the VAT. We do the same we did with the sales. So times 100 over 116. Let us get how much that is. So 2842,000 times 100 divided by 116 give us 2450,000. And then we less the closing stock. The closing stock is given in point 3, additional information number 3. Closing stock was valued at 1840. So minus 1840,000. And then also remember, we say that we also deduct any item that reduced the stock during the year. Do we have it? Yes. If you go to the incomes, among the incomes in the income statement, there is sales and realized foreign exchange gain, capital gain, recovery from insurance on stock stolen. It is telling you that there were stocks that were stolen. So if they were stolen, this must be deducted from here. The stolen stock was 480 minus 480. We also have the goods transferred to the branch at cost. That, remember, you are just transferring goods from one place of the business to another, from the head office to the branch. There is no impact in addition to that because the stocks are still within the company. The branch and the head office are one and the same thing. And there is no other item that affected the cost of goods. So we cross. And then we apportion. Don't forget to apportion. We want the 9 months, so 9 over 12. The other one, 3 over 12. So we are going to have the 580,000 plus 2450,000 and then minus 1840,000 and then we minus 480,000. That gives us 710, and then we multiply by 9, divide by 12. $532,500, and then the other one is going to be 710 times 3 over 12. That gives us 177,500. So after that, we can now get the gross profit. Gross profit will be sales minus the cost of sales, in which case we have 43,50,000 minus 532,500, which give us 3817. 500. This other one is 1450,000 minus 177,500 give us 1272, 500. Now that is the gross profit, and then we said once you get the gross profit, you normally add other taxable so we need to go through the question, determine if they are taxable operating from operation. Now the incomes are in the income statement after the sales, where we have unrealized foreign exchange gain. Unrealized foreign exchange gain, we said we don't usually tax. We only tax realized, or if it is silent, just realized foreign exchange gain. The other one is capital gain on sale of shares. Shares are investment, so not operating. Recovery from insurance on stock stolen. We say that income from compensation from the insurance company for stock stolen, that is supposed to be a taxable income. So we come here, insurance compensation. We have 9 over 12, 3 over 12 of 480. So we have 9 divided by 12 times 480,000. That gives us 360. The other one is 3 over 12 of the same, 120. We continue. After the recovery from insurance on stock stolen in the income statement, there is goods transfer to a branch. That is not a sale. You're just moving your goods from one place of the business to another, from the head office to the branch. Nothing. Dividend from Cali Cooperative. That's an investment income. Here we want only the operating. After that, we have the expenses. Maybe in the additional information, you need to confirm with the additional information to confirm whether you have an income. But if you look at all of them from number 1, 2, 3, 4, 5, 6, 7, there is no income whatsoever. So meaning we can now less. So we need to go through the whole question again, and especially in the income statement where expenses start. Any allowable expense we deduct here. And the first expense is purchases. Now purchases we use to get the cost of sales. So it's already considered there. The other one is purchase of computer. Computer is not an allowable expense. It's a fixed asset. What we allow for computer is the wear and tear. And because here we are looking at allowable expense now, wear and tear should be deducted. So wear and tear on computers, we take 9 over 12, 3 over 12 of 25% of 130, 180. So 25% of 180, that gives us 45 times 9 divided by 12, give us 33, 750. The other one is 3 divided by 12 times 45,000, That gives us 11 to 50. There. So we continue. So the next expense in line is the partner's salaries. But we said partner salary is not allowable. It's for the partnership and it's not allowed. The other one is legal fee. Legal fee we said is usually allowable unless it has additional information. It is explained further, which is the case in here. If you look at the point number 4, it is saying legal fee comprised petition to association of manufacturer and the rest. So what you need to do, you need to post one figure here because we are using the gross profit method now. You post another allowable expense is the legal fee. So you take 9 over 12, 3 over 12 off. The legal expense is 680 minus, because you want to remain with the expense that is allowable of the legal, just minus the non-allowables, the one that are not supposed to be allowable. In additional information number 4, we are told legal fee comprised of petition to association of manufacturers. We had said anything paid to the trade association is allowable. Association of manufacturers, that is supposed to be an allowable expense. Then notice for change of business name. Now we said that for an expense to be allowable, it must be income generating. This one, change of business name, has nothing to do with the income generation. We don't allow that. So minus 64,800. Then we have the conveyance fee for business premises. We say the conveyance fee is the legal cost to transfer a fixed asset, and we don't usually allow it. So we minus 72,400. Again, stamp duty. Stamp duty is a form of tax. Taxes are usually not allowable. We said that. So we minus 36,600. The other one is negotiating a business loan. We had said legal cost relating to loan, bonds and debentures are not allowed. So this one is not. So 2,800. The other one is recovery of bad debts. Recovery of bad debt, we said, is usually allowable. We said any legal cost relating to debtors and customer allowed. Then signing a 100-year lease agreement. We say that the lease up to 99 years is the one that we allow legal cost. Any above that we don't. So this is not allowable. 128,400. After that, we have the purchase of the partner's private residence. We had said that any expense relating to the partners we don't allow. This for private, for the partners, we don't allow. 150. The other one is appeal against tax arrears. We had said any expense relating to tax we don't allow. So this one is not. So minus 82. Then we close. So whatever remains there become the allowable legal costs, which now we apportion. So it is going to be 680,000. The overall legal cost minus the non-allowable 64,800 minus 72,400 minus 36,600 minus 2,800 minus 128,400. And then we minus 150,000, and then we minus 82,000. That gives us 125,000. Then we take times 9 divided by 12. And 3,750. The other one we say 3 divided by 12 of 125,000. That gives us 31,250. Then we continue. We go back to the income statement and continue looking for allowable expenses. After that, there is repair and maintenance. Repair and maintenance is allowable expense. However, there is a point number 5 about it. If there is something mentioning that item, go check so that you determine if there are some parts which are not allowed, you remove them. Like it include purchase of furniture. That's a fixed asset. Fixed asset we claim wear and tear. Capital allowance for furniture. Installation of neon sign. That's supposed to be wear and tear. Designing of an office block. That's a fixed asset. That require IBD, office block. Cost of partitioning office block, wear and tear to 10%. Repainting of the business premise. That is now the allowable. So we have repair. So we take 9 over 12, 3 over 12 of the overall 568,400. Remove the non-allowables like furniture 96,000. The other one is neon sign 60. You have the office block 140. You have the partitioning 250. That. So we have 568, 400 minus 96,000 minus 60,000 minus 140,000, and then we minus 250,000. So that gives us 22,400. And you can take note that the only expense that is allowable in number 5 is repair of business premise. So if you remove all the others which are not allowable, you still remain with that, the 22,400. So you can as well pick that and call it repair and maintenance, and then you post it there. So we times by 9, divide by 12, which you have 16,800. And then we take the other one, which we saw is 22,400 times 3, divide by 12, 5,600. Yeah. And then we go back to the income statement. We continue looking for allowable expense. After repair and maintenance, there is rent and rates. Rent and rates. And this one does not have additional information. So it's all about apportioning 9 over 12, 3 over 12 of 244,600. So 9 divided by 12 times 244,600, which we have 183,450. The other one would be 3 over 12, 61,150. And then we continue after rent and rates. Interest on loan. Interest on money borrowed, we said is allowable expense. So interest on loan, which we take again 9 over 12, 3 over 12, of the interest on loan overall is 166,200. We minus, if you look at additional information number 7, we are told interest on loan include interest on partners' capital of 100,000, which was shared according to the profit sharing ratio. So in here, there is interest on capital to the partners, which is not allowable. We said so. So we remain with the remaining 166 minus 200 minus 100,000. That will be 66,200. Then we apportion 9 divided by 12 times 66,200. Give us 49,650. The other one is the same. 3 over 12 of the same. 16,550. There. Then we continue. We go back to the income statement. After the interest on loan, we have general expenses. General expenses are allowable expenses. (9 over 12, 3 over 12 of the overall general expense is 964,000. But we must minus, there is an additional information number 6 about the general expense, which we are told that it included registering of a patent right of 64,000. Patent right cost we said is not allowable. So that need to be minused, 64,000. Also, flotation cost of 48,000. We said flotation cost is for the shares and it is usually for the company. So this one we have to remove it from here. Although we said it's allowable on the company, but the figure that we want to remain with is the one we apportion, the one relating to the company and the partnership. This one needs to be taken to the partnership to the company directory. So we need to first of all remove it from here, 48,000. Also, there was an additional piece of cost of negotiating an additional piece of land for expansion, 56,000. That is also not allowable, a fixed asset. Then the remaining one is the one that is going to be allowable. So we are going to take 964,000 and then we minus 64,000 and then we minus 48,000 and then we minus 56,000. You have 796,000. Then we take the figure times 9 over 12. 796,000 times 3 over 12, 199,000. Deduct from there. Then we continue. After that, there is the motor vehicle expenses. Motor vehicle expenses are allowable. Remember, we said that is not the motor vehicle costs. That's not a fixed. It's the cost of running the motor vehicle, like repair, fuel, and all that. So that is allowable expense. So motor vehicle expenses, which we have 9 over 12, 3 over 12. This one does not have additional information about it, so it's all about using it the way it is, 840. So we will have 9 over 12 times 840. That gives us 630. We also take the 3 over 12. That gives us 210. After that, we go back. Insurance. Insurance, we said, is also a allowable expense. It's a business expense. So insurance expense, which we have again 9 over 12, 3 over 12. There is no additional information on insurance, which we have 156,000. So we take 9 over 12 times 156. That gives us 117,000. And also the 3 over 12 of the same, 39,000. After that, we have preliminary expenses. We said preliminary expenses are expenses incurred before you start the business. All these expenses are not supposed to be allowable before you start. Preliminary, before. We don't allow them, we said. The other one is director's fee. Director's fee is allowable, but it only relates to the limited company. That's what we said. Only company has directors. So director's fee, which we have 600,000. So the whole of it come here. The other one is audit fee. Audit fee is a allowable expense and it cut across the board. It is for the partnership and the company. So audit fee, we have 9 over 12, 3 over 12 of 148,200. So we have 9 over 12 of 148,200. That gives us 111,150. The other one is for the 3 months, 37,050. After that, we have the debenture interest. We said debenture interest is allowable and only a company can issue debentures. So for the company, allowable for the company, debenture interest. We have 360,000. The next one is traveling expenses. So traveling expenses is usually an allowable expense. So we'll have it here. And it is cut across the board. So 9/12 and 3/12 of the traveling 96,000. So we'll have 3/12 times 96,000. That will give us 24,000 here. Now this is supposed to be for this. 24,000 is for the company. And for the partnership, it is going to be 9/12, 72,000. When we get to the end of that, it's kind of, we are done with the expenses, but we need to go through the additional information for an expense that is not in the P&L and it's allowable, the one not in the P&L. So we go to the additional information. Number one, the partnership was converted into a limited liability company by the name Kaka Limited on 1st October 2014. Incomes and expenses accrued evenly throughout the year unless otherwise stated. There is no expense there. So we go to number two. Purchases and sales were inclusive of VAT at the rate of 16%. There is no expense there. Then number three, closing stock was valued at 1840, while opening stock was at 10% of sales net of VAT. There is no expense. Number four, legal expense. Now, legal expense is already in the P&L, and we consider the part that is allowable by removing the non-allowable parts. And in the same place, we have not seen any fixed asset that we can claim capital allowance among all those ones. There is none that is a fixed asset. So we go to number five, repair and maintenance complies. So we had seen that the repair and maintenance is allowable. However, we remove the ones that are not allowable. However, we noted that most of those items, actually all the items in repair, were fixed assets. So we don't allow fixed assets, that's why we remove them, but now we claim the wear and tear. So we claim wear and tear for furniture and fitting, which is supposed to be 9/12, 3/12 of 10% of the furniture cost 96,000. So we take 10% of 96,000. That gives us 9,600. Then we multiply by 9, divide by 12, 72. And then we do the same. 3 divided by 12 times 9, 600. Give us 2,400. So another fixed asset in point number 5 is installation of neon sign. That require wear and tear as well. So wear and tear allowance on neon sign, which we are supposed to have again 9/12, 3/12 of 10% of 60,000. So that we take 10% of 60. That is 6,000 times 9/12. That gives us 4,500. The other one is the same. 3/12 times 6,000, 1,500. Yeah. And we continue. Another fixed asset that we have in point 5 is the designing of an office block. For the office block, we don't claim wear and tear, we claim industrial building deduction, IBD. So we have IBD, office block. So we have 9/12, 3/12 of the IBD, we said, is at the rate of 10%. So 10% of 140,000. So 10% of 140 give us 14,000. Then times 9 divided by 12. That give us 10,500. The other one would be 3 over 12 of the 14,000. Give us 3,500. We continue. Another item we have is the cost of partitioning office block. Partition, we said, is supposed to be wear and tear. So here we don't look at the office, we look at the partition. Wear and tear, 10%. So wear and tear on partition of office block. So 9 over 12, 3 over 12, 10% of 250. So we take 10% of 250. That will be 25,000 times 9 divided by 12, give you 18,750. The other one will be 25,000 times 3 divided by 12, 6,250. There. And there is no other fixed asset in point 5. So we go to point number 6, general expense. For the general expense we had seen is in the P&L. We even deducted it here. And we were told it comprises of the patent rights. Registering of patent rights is not allowable, we had deducted. Flotation cost. Now flotation cost, we said, is usually for the shares of the limited company. That one is specifically for the limited company and is allowable on the company. So we deducted from here because it's specifically for the company. Now we deduct it on the side of the company. So flotation costs of shares, which we have the flotation cost of shares to be 48,000 and only on the side of the company. Land, a piece of land for business expansion? No, that is not allowable completely. Point number 7, interest on loan included interest on partner's capital. Interest on partner's capital is not allowable, and we deducted it when we were getting the interest expense. And that is the end of it. For now, we can get now the net taxable operating incomes. So what we do, we start from here, the gross profit plus other income minus now the allowable expenses. We start with the first one, 3817, 500, and then we add 360,000, and then we minus 33,750, and then we minus 93,750, then we minus 16,800, and then we minus 183,450, we minus 49,650, and then we minus 597,000, and then we minus 630,000, and then we minus 117,000, and then we minus 150. So, and then we minus 72,000, and then we minus 7,200, and then we minus 4,500, and then we minus 10,500, and then we minus 18,750, give us 22,000. 32,000. That's 2,032,232,000. Then we go to the company, 1272, 500, and then we add 120,000, and then we minus 11,250, and then we minus 31,250, then we minus 5,600, we minus 61,150, and then we minus 16,550, and then we minus 199,000, and then we minus 210,000, and then we minus 39,000, we minus 600,000, and then we minus 37,050, and then we minus 60,000, we minus 24,000, and then we minus 2,400, and then we minus 1,500, we minus 3,500, and then we minus 6,250, we minus 48,000. That gives us a loss of 264,000. Now, this is what we said for the partnership. Once you get the net taxable operating income here, it normally ends here, unless you are told to distribute to the partner and maybe determine the tax for each partner, but you don't go beyond there. But for a company, it does not usually end here. We normally add taxable investment income. We normally add taxable investment income if if the operating income is positive. That's the time we add the taxable investment income so that we can tax them together. But how about in case the operating income is negative? We don't add, take that loss and deduct it against income from other sources. That's what we said. So for this one, we will normally cross here. It will wait until next year where it can be deducted against the taxable profit of next year. But for now, it ends there. So we should not say we add then here because we have a loss from operation. We just now determine the taxable investment income separately and tax the company on that investment income only. For this question, we only had one investment income. In our income statement, the last income is dividend from Kali Cooperative Society, where we said if a company or a person gets dividend from a cooperative society, the withholding tax is not final. We said it's a non-qualifying dividend, that we should tax it further. So we come and now post it here. We have dividends from Kali Society, Cooperative Society, where we want only for the company, so we only want 3/12 or 51. And take note, the 51,000 is not net, because if it was net, we could have grossed it up to get the gross, yeah? Because net means that they had already deducted 15%, and we say that we don't tax the net. But this one is not, it's silent, so it's always assumed to be gross. So we take 3/12 or 51,000. Give us 12,750. And since there is no other investment income, then that becomes the only taxable income for the company. So, if you look at the required number 1, it means we have answered the question. Statement of adjusted taxable profit or loss for the business for the year ending 31st December 2014. Done. Hint, start with gross profit. That's what we did. B, comment on the tax position of James, Katana, and the company. Now, this is where you are told. If you're told to comment about the tax position of James and Katana, that is in the partnership. We said, once you get the taxable income of the partnership, you distribute and now tax it on the partners themselves. Since they have asked us about the tax position, we have now to distribute and even determine the tax they are supposed to pay individually. So what do? Distribute first. So we have to prepare the income distribution schedule. So we have the James. Maybe we need an extra one here so that we have the James, Katana, and the Tutors. We said we want to distribute the operating income, so we start by distributing the taxable operating income of 32,000. That is what we want to distribute. Positive, remember? So how do you distribute? We said in the income distribution schedule, we normally look for 5 items: the salary, the commission to the partner, interest on capital, drawings, and we raise the interest on drawings. So we need to start from the top all the way down. We look for any one of those 5 items. Among the incomes, you'd expect to get like interest on drawings. That is the one that we are supposed to raise. But in this case, we don't have that in there among the incomes. You go to the expenses, purchases, purchase of computer, partner salary. Yes, we have the partner salary. But then, how are they sharing the salary? Now, there is nowhere, if you go to the additional information, there is nowhere we are told about how they were sharing the salary. This is what we said. If you're not told how they are sharing the 5 items, and actually you just look at the 3 actually, the salary, the commission, and interest on capital. If you're not told how they are sharing, share equally. Not according to the profit sharing ratio, share equally. That's the rule. So in this case, since we are not told about the partner salary, we share equally. So we'll come here and say partner salary. So the amount is 720, and then we share equally half of 720. That is going to give us the 720 divided by 2, that is 360. 360, 720. We continue down. After this partner salary, legal fee, rent, repair, interest on loan, general expense, insurance, preliminary, director's fee, audit fee, debenture interest, traveling. There is none that goes to the partners among the one we are looking for. Additional information number 1, there is nothing. Number 2 is about VAT in the sales and purchases. Number 3, there's nothing of what we are looking for. Number 4, there's nothing of what we are looking for. 5, the same. 6, the same. But number 7, interest on loan include interest on partners' capital of 100, which is shared according to the profit sharing ratio. There we have it. Interest on capital. Where we are told we share according to the profit sharing ratio. The profit sharing ratio was in the first paragraph up there. James and Katana established partnership business sharing profit and losses in the ratio of 3:2. So the first one will get 3/5, 2/5 for the second one, over 100. So 3/5 times 100. That gives us 60. And this means this one got 40, total 100,000. That was it. And there's nothing else after that. So what remains is for us to share the profit share. That's the last one under here. Profit share, which is now this one, we take according to the profit sharing ratio 3/5, 2/5 of the 32,000 minus what you have distributed, interest and salary, minus 100,000 minus 720,000. So we'll have 32,000 and then minus 100,000 and then minus 720. That gives us 12,000. And then the first one get 3/5, give us 847,200. The other one get 2/5 times the 12,000, 564,800. And now we can get total taxable operating incomes. So we add the operating from the top, the 360, and also 60, and also 847,200. This got 1267,200. The other one is 360 and 40 and 564,800. 964,800. Then we add the other one, 720,000 plus 100 plus 14,000. That is 2232, and it's starting with what we are distributing here. So after that, we said we normally add the taxable investment income. So here we only had one investment income, that is the dividend from the cooperative society. We had the dividend from the cooperative society, and which we said that is an unqualifying dividend. Withholding tax is not final, should be taxed further. So we come here and say dividend from the Kali Cooperative Society or Kali Cooperative Society. So we take, remember that dividend is for the whole year, and that's why we took the 3/12 for the company. So the other remaining 9/12 is the one that belongs to the partnership, and now we share according to the profit sharing ratio. So the first one get 2/5, the other one 3/5 of the first one is the one that is supposed to get 3/5, this other one 2, of 9/12 of 51,000. So we'll have first 9/12 of 51. So that gives us 38,250. 38,250. Then we share 3/12. That is 3/5 times 38,250. That gives us 22,950 for this one. The other one, 2/5 times that, 15,300. And since there is no other investment income, we now can get the total taxable incomes. So that means that we take the operating plus investment. So 1267,200. And then we add 22,950. That gives us 1291.50. The other one is 964,800. And then we add 15,300. That gives us 980,100. And then we can also get the total 22,32,000. And then we add 38,250. That gives us 22,70,250. Yeah. However, we have not really answered the question because the question required number 2 was that we comment on the tax position of James Katana and the company. So we have to get the tax payable. That's the point. So now we go beyond just the distribution. So we have to determine, we said, we normally tax these partners individually. Now, for example, we'll say tax payable by James. Now, we said we normally tax partners using the graduated scale rates, and this graduated scale rates is usually provided in the tax table to compute the tax payable by James, an individual. We are supposed to use the tax table provided in the question paper to compute the tax payable. This is usually provided in an exam, the first page of your question paper. So I'll use the tax table of the year 2021. For the year 2021, there's a table that normally show, assume that the following rates of tax applied throughout the year of 2021, and we have the monthly taxable pay, annual taxable pay, and the rates of tax in each shilling. So because we are looking for the tax for the whole year, not 1 month, we are going to use the annual taxable pay. In the annual taxable pay, it says between 1 shilling to 288,000, you tax at the rate of 10%. And then between 288,001 to 388,000, the rate is 25%. And then excess over 388,000, you tax at the rate of 30%. Now, for the James, we can see the income is above 388,000. So we'll go up to the rate of 30%. So we start taxing. At the rate of 10%, you normally take the last figure appearing at the rate of 10%. You see, it is 1 shilling to 288. So the last figure is 288. So we take 288,000 times 10%. That gives us 28,800. Then we add, you can see between 288,001 to 388,000, 25%. So for this one, you normally get the difference between the last figure in the rate of 25%, which is 388,000, and you minus the last figure in the previous rate of 10%, 288. The difference is 100,000. So you add 100,000 times 25%. That gives you 25,000. And then you add, you see, excess over 388,000, 30%. What does it mean by excess of 388,000? It means we have already taxed the 388. The 288,000 plus 100, that is 388. So whatever is above 388, you take 30%. So we are going to say the above is which one? It is going to be the taxable amount, 1290, 150 minus 388,000, and then you multiply by 30%. So, and then we need to compute that, which is going to be the 1290, 150, and then we minus 388,000. That gives you 902,150. So we tax at the rate of 30. That gives you 270. So this is going to be 270, 645. 645. Now this one, if you look at that tax table down there, there is a personal relief of 2,400 per month, and which is equivalent to 28,800 per annum. If you are taxing for the whole year, you take per annum, regardless of how many months the person earned the income. Like this one was 9, but we take the whole year. So the personal relief reduces the tax a person is supposed to pay. So 28,800 personal relief. So now we need to add the tax and we minus the personal relief. So it's going to be 28,800 plus 25,000, and then plus 12, that is 7, this is 7, 270, 645. That is going to be 324, 445. And then we minus the personal relief, 28, 800. That gives us 295, 645. That is the tax payable by James. And then we have the tax payable by Katana. Now for the Katana income, we find that it is 980, 100. If you go to the tax table, we find that we are going to go all the way to the rate of 30% because it is in excess of 388,000. So we start off just like this one. So the first 288,000, we take 10%. We add the next 100,000 times 25%. And then the excess, which is going to be 980, 100 minus what you have taxed already, the 388. The 288 plus 100, the 388. Where we are told excess over 388, we take 30%. Then we minus the personal relief, 28, 800 as provided. So 28, 800. So we do the computation, 288,000 times 10%, that is 28, 800. This is going to be 25,000. And now this one, 980, 100. And then we minus 388. Give us 592, 100. And then we multiply by 30%. Give us 177, 630. Now we add those taxes. So that one plus 177, 630 plus 28, 800 plus the 25,000. That gives us 231, 430 minus the personal relief, 28, 800. That gives us 202, 630. That is now the tax payable by Katana. But the question was not about James and Katana only in the required. In the required number 2, it was the tax position of James, Katana, and the company. Now for the company, we said we normally tax at the rate of 30%. So we are going to take 30% of the taxable income, which is 12,750. However, we said if you have if the investment income is subject to withholding tax at the source, you must minus the withholding tax. So withholding tax for this dividend, which is non-qualifying, is 15%. So we take 15% of the 12,750. So we'll take 30% times 12,750. That is 38.25. This 38.25. And then 15% of 12,750. Which is going to be 63.75. Let me do it again. 15% times 12,750. That is 1912.5. So this is going to be 38.25, and then we minus 1912.5, give you 19 12.5, and that becomes the tax payable by the company. Now that answers Roman 2, that is required number B, about commenting on the tax position of James, Katana, and the company. There is C now, that citing examples, advise James and Katana on 2 areas of tax avoidance that could explore for the business. Now, although this is a topic to be done later, there is a topic called tax planning. This way you are supposed to look at all these, but to fully answer the question, I'll just mention them. And then when you do the tax planning, you learn more about it. Now, tax avoidance, those are measures that they can put in place to legally reduce the tax they are supposed to pay. Now, what are those measures? Now, one of them, we saw in additional information number 6 that there was a flotation cost. Flotation cost is usually the cost of issuing shares. So they issued the shares to the public. So instead of issuing shares, the best option they could have taken, usually the company, is to take a loan or issue more debentures. So, one, we have issue debentures or take a loan instead of issuing shares, because costs of loan and debentures, the cost of loans and debentures is called interest, is allowable expense. While cost of shares, that is dividends, are non-allowable expenses. You learn more about this in tax planning. 2, we saw in additional information number 4, there is signing of a 100-year lease agreement. And we said the cost of signing a 100-year lease agreement, when you are looking at the legal costs, 128,400, we treated that as non-allowable, because we say that lease up to 99 years is the one that is allowable. Above 99, we don't allow. So the best option they could have taken is to sign a lease of 99 years instead of 100 years, so that the legal costs of signing can become the legal cost of signing become allowable expense. So that is what we had said. And now the last one. We had seen that they had joined a cooperative society whose withholding, the dividend they get, the withholding tax is not final. Instead, they should join a SACCO, where we say that SACCO dividend is our qualifying dividend, withholding tax is final. So, join a SACCO, that is Saving and Credit Cooperative Society, or SACCOs, instead of cooperative society, that was the Cali Cooperative Society, where withholding tax on dividend is final tax. Yeah. So those are the opportunities available for tax avoidance. So that one brings us to the end of this lesson about the conversion of a partnership into a limited company during the year, where we have looked at how you can use the net profit method and the gross profit method to get the taxable income, and how to go ahead and tax the businesses, the partnership, the partners, and also that of the limited company. So that mark actually the end of the taxation of the partnership. Now, when we meet in the next lesson, we'll be looking at the taxation of the next business after partnership, the limited company. For today, we are going to reach there. Until next lesson, thank you very much. See you in the next lesson.
Dear learner, welcome in our continuing series of lectures on the manifested e-learning platform. We are continuing with our subject of human resource management. And today, in our lesson, we are looking at human resource administration. And within that human resource administration subtopic of the lesson, we are now looking at health and safety policies and procedures. We are looking at health and safety policies and procedures. And dear learner, what needs to be emphasized is that the health of a worker and the health of those associated with an organization is very critical. And that's why a lot of emphasis must be put on the administrative aspects that help in preserving the safety and the health of workers and those who are associated with what the organization does. And that's why we are going to take a bit of time on the lesson for today to be able to emphasize so that you can come out very strongly with the competencies and skills of ensuring that you are able to maintain a health and safe working environment through the safety procedures that an organization is expected to put in place. Now, when we look at health and safety policy and procedures, health and safety policy and procedures are concerned with protecting employees and other people who may be affected by what the organization produces, does, against hazards arising from their employment or their links with the organization. So you have hazards, you have what is being produced or what is being done in an organization. So dear learner, as we have emphasized, the health and safety of employees and those associated with the workplace is very critical. And that's why we are going to take a bit of time and be very sequential in terms of how we are going to look at health and safety policies and procedures. So just to emphasize again, health, safety policies and procedures are concerned with protecting employees and other people affected by what the organization produces and does against hazards arising from their employment or their links with the organization. And any lapses in the area of health and safety can actually lead to death. And that's why it is important to avoid the deaths accruing in the work environment or injuries or damage. This has to be taken very seriously. So in our lesson today, for us to realize the objectives of this lesson, we are going to look at activities in managing health and safety at work. We will look at hazards at work. We will look at action following risk assessment. We will also look at control of occupational health and hygiene problems, and also look at accident prevention. How can accidents be prevented within a working environment? So we are going to start with activities in managing health and safety at work. Activities in managing health and safety at work. So, Lana, you might be asking yourself, as a human resource person, or maybe as a company secretary or somebody associated with a work environment, what are some of the activities that you may be involved in when it comes to managing health and safety at work. So there are several activities that you may be involved in, because when it comes to the law that regulates health and safety policies and procedures, the Occupational Safety and Health Act of 2007, it is a requirement that teams are created within a work environment. So you may find yourself as a team member participating in these particular processes. So what are some of the areas in which employees may have to participate? So one of them is formulation of health and safety policies. Health and safety policies. So in a work environment nowadays, employees are increasingly being involved in management, and that's why for these policies to be highly acceptable or highly say transcended down the organization, then an organization may have to involve employees. So as an employee, you may be involved. As a manager, you may also be involved in the formulation of health and safety policies. You may also find that another activity is conducting risk assessments. There may also be implementation. Number 3, implementation of health and safety policies. There might also be review of health and safety procedures. So activities in managing health and safety. There is also the issue of number 5, participation in health and safety committee work. There might also be the issue of sensitization of employees on health and safety. There is also the issue of investigation of work-related accidents. So basically, the activities in managing health and safety are wide, and they vary from organization to organization. But what we are saying, some of them may include formulation of health and safety policies, conducting risk assessments, implementation of health and safety policies, reviewing of health and safety procedures, participation in health and safety committee work, sensitization of employees on health and safety investigation, and investigation of worker-related accidents. Accidents may take place within a work environment, and there could also be other areas, like, for example, managing stress in the workplace. Now, this stress may be brought about by employees who have been given, for example, certain targets. Employees have certain targets to meet, and they will be stressed if the time is reaching and these employees have not met those targets. So that again becomes an issue that has to do with employees' health, employee work well-being, and so on, among other places and so on. Is it? Then there might also be other issues like health and safety, health and safety equipment, So the list is long, but these are just some of the things that you are saying that within a working environment, some of the activities may include but are not limited to what we have listed here. So that is the first part of our lesson, which is now dealing with activities in managing health and safety at work. Now, how about hazards, dear learner? How about hazards at work? What are some of the hazards at work? Hazards at work. And what you might have noticed, dear learner, in any work environment, whether it is in the office, whether it is operating machines, whether it is at the farm, there could be some hazards that we need to be aware of, so that when we are aware of those hazards, then it is possible for us to be able to bring in corrective measures. So what are some of the activities that may be associated with hazards within a work environment? So one, receiving of raw materials. Receiving of raw materials. Now, when raw materials are being received, there could be elements where now you need to carry this, for example, need to be carried, need to be moved from one place to the other, and so on. So that again could create a hazard. Then there is the issue of movement in the workplace. Movement in the workplace. So when there are movements in the workplace, there could be collisions, for example. Then operating machines, that could also create a hazard. Then you could, for example, be having issues like working at heights. You have seen, for example, say Kenya Power, you have power lines and employees are supposed to climb up there on masts, for example, for Safaricom, maybe other mobile phone companies and so on. So that working at a height could also create a hazard for employees. There is also working with hand tools. And then number 6, operating electric equipment. So when employees are working with hand tools, that hand tool could, for example, snap. And if it snaps, then that could also create a hazard. Then there is the element of operating electric machines or equipment where electricity is being used. Workers need to be very keen. Then there is also the element of sitting for long durations. So employees who sit for long durations may, for example, suffer what you call lower back pain. So that again becomes a hazard within a working environment, is it? Then you also have processing of materials. Now, these materials could lead to what you call toxic substances. When materials are being mixed, those materials could create some toxic substances. Then there is also cleaning of gutters. So employees in cleaning of gutters in confined spaces. So that again could be a hazard. Then there is also the issue of workload. Work overload. So when employees have too much work, sometimes you have seen in some workplaces an employee has to carry work home. So that carrying that work home sometimes could also create challenges. So when these employees at the workplace for 8 hours, they are working, they go home, instead of resting, they continue working and so on. And if this workload continues, this one could lead to maybe high stress levels, as we have observed, and that one can be a hazard at maybe the work environment and so on. So these could just be some of the hazards that workers may be exposed to within a given working environment. And when this happens, or within a work environment, then employers are supposed to do what is called a risk assessment. So what are some of the action following risk assessment? So we want now to have a look at action following risk assessment. action following risk assessment. Risk assessment. So as we have indicated, dear learner, employers are expected to carry out a risk assessment in accordance to various legal provisions. So there is a procedure for carrying out a risk assessment, and once that risk assessment is carried out, action is envisaged. That particular action must be taken as informed by the risk that has been assessed, and this risk assessment is supposed to be done internally and also externally. So what are some of the things that an organization may institute in relation to the risk assessment process? So one, hazard elimination. So one of the things that may be done, hazard elimination. And now we will give an example here, learner. So supposing you are working in an environment and you have gone to a section, and that particular section you have noted there is some hazard. So maybe if it is a hazard in terms of the process, there could maybe what you call a process alteration. Process alteration. So if this process is altered, can it be able to eliminate the risk maybe workers are exposed to or other people? Then there's the element of substitution. Substitution. Now, supposing you are using a particular detergent, or maybe a raw material, and you notice that this detergent is corrosive, right? This detergent is corrosive, for example. Then you can substitute that particular detergent with another one, but still achieve what you are expected to achieve. So this detergent or that raw material can be, for example, be substituted. So substitution of maybe a detergent or a raw material that is hazardous can be able to minimize that particular risk in that particular setting. Then there is also what you call the use of barriers. Use of barriers. So what happens here, dear learner, you may go to a machine room and you realize that the machine must, for example, have a particular belt that is rotating. So that belt could be the risk that you have observed could injure an employee. So the use of barriers may involve, for example, using fabrication, or maybe using some wire mesh that is, for example, put between the belt and maybe where the workers are, and that way you have actually put a barrier such that no employee can go to that particular side of the machine, and that one helps in reducing the risk. Then there is also the issue of use of procedures. Use of standard operating procedures. Standard operating procedures, or what you call SOPs, standard operating procedures. So, dear learner, what this means is that in areas where a risk has been assessed and it has been realized that if workers are left just to operate, for example, machines, there could be some danger. Then an organization may come up with a manual that says before this machine is started, you must ensure that the barrier, for example, is in place. You must ensure that the loading of the machine is in place. You must ensure that other features have been taken into consideration to minimize that particular danger and so on. So then the use of standard operating procedures can also be instituted in that particular arrangement. Then number 5, use of working systems. Use of working systems. Now, what do we mean by this now? Use of working systems, supposing you have a line operation line operation. Then you must ensure that, for example, you have a shift supervisor, and this shift supervisor is well versed with safety in relation to the work that is being done. So in terms of a working system, in terms of that line, it means before you start any process, then the whole system has to be checked from the beginning to the end, and this supervisor may give what you call a work permit, or maybe what you're calling a permit to work, permit to work. So this permit to work is signed and everything is in order before workers can start working and so on. And this working system can also have what you call the warning systems also, so that in some of the Japanese organizations there could be a siren. In case there is a problem on the line, then what happens? There is a siren that goes on, and that whole system now, for example, stops. So that working system or warning system can be able to assist in terms of that process. Then the last aspect in relation to action is the use of, the last aspect here is the use of personal protective equipment. Personal protective equipment, or what you call PPEs. So dear learner, you should note that personal protective equipment or PPEs like gloves and other issues should be used as the last resort. When all these other processes cannot work, then you now use personal protective equipment which are appropriate to that particular work operation or work activity. So those are some of the things, those are the 6 things that may follow, action that may follow risk assessment. So it means if you look at the first one, hazard elimination, a hazard has been detected, maybe in the process, it is altered. Maybe an item that is being used is risky, it is substituted. Maybe an operation that is open can also have a barrier. So based on the risk assessment that has been done, an organization can come up with intervention measures in that order. And as we have indicated, use of personal protective equipment is normally the last consideration in relation to safety at the work environment. So that is our third aspect in our lesson today. And the fourth one is control of occupational health. Control of occupational health. The fourth one is control of occupational health and hygiene problems. Control of occupational health and hygiene problems. Control of occupational health and hygiene problems. Now, when it comes to housekeeping issues within an operational environment, you have what you call housekeeping issues. Now, when it comes to housekeeping issues, what are some of the things that should be done to control the hazards or occupational health problems that workers may be exposed to? So one of the things that is supposed to be done is to eliminate the hazard at source. So one, elimination of hazard at source. So what this means is that you don't have to wait. If you are, for example, constructing a warehouse and you need, for example, a floor that is rough for that warehouse, then at the construction and design stage, then you must ensure that you eliminate the risk or you eliminate the hazard at that particular point when you are constructing the building. So that elimination of the hazard at source becomes one of the things that you need to do. Then two, you have what you call process engineering. Process engineering. So basically, the kind of processes that you are now supposed to use, you ensure that you build safety into that particular process. So through process engineering, you can be able to eliminate or control occupational health and safety and hygiene problems that may arise within the working context. Then you have what you call isolation of hazardous processes, isolation of hazardous processes. You might, for example, dear learner, gone to maybe to a hospital, and what they do, if let's say the X-ray and imaging areas are risky areas, so it means you must isolate those wards that deal with issues to do with imaging and X-ray in environments where employees or patients cannot come into contact. So isolation of hazardous processes, they are put in an area where it is difficult to access or is only left out of bounds for people who are not supposed to work in those areas or are not authorized to be there. So that isolation of hazardous processes can also be one of the ways through which you can be able to control health and hygiene problems within a working environment. Then there is also the element of training workers. Training workers on safe practices, safe work practices. So workers can be trained in relation to how they can make their work maybe environment safe. So when workers are trained, then those workers can now be able to assist in ensuring that there is a safety within that particular environment. Then you also have what you call good housekeeping practices. Good housekeeping practices. So what do we mean by this? What we mean by this, dear learner, is that in terms of spillages within the work environment, those ones should be cleaned as the work continues to ensure that the work environment is clean at all times. There are no spillages to be able to create problems. Then you also have proper maintenance, of plant and equipment. So if you have a routine, for example, to maintain machines maybe after every, say, 5 days, so that proper maintenance schedule is very important to be able to control occupational health and hygiene problems, so that now within a week or within 2 weeks, proper arrangements are made to ensure that that work environment is proper and so on. Then you also have what you call regular risk assessments. So these regular risk assessments can be impromptu. So you just decide you are going to check a particular section, and that section you are going to check, you don't inform the people who are there, you just go there, check whether now they are conforming to what has been put in place in terms of the operating standards and so on, then take intervention measures. So that regular process of risk assessments within a work environment can also be able to assist an organization solve the hygiene problems that may be associated with a working environment. And then you have what you call proper ergonomic considerations. Proper ergonomic considerations. So when you talk about ergonomic considerations, you are talking about the interface between the worker and the machine. So if you have proper work machine interface, proper ergonomic considerations. So if you have a proper proper interface between a machine and the person, or a workstation and the worker. Take an example. If you have, let's say, a computer operator. So you ensure that the computer has got the shield that is supposed to shield that worker from the rays, and then the seat which the computer operator is using is also appropriate and well, for example, adjusted. Then that particular person can work with minimum strain. so you can be able to reduce the strain of that particular worker and ensure that that worker works very well and so on. So that again becomes one of the things that needs to be done. Then you have also what you call continuous medical checks. Continuous medical checks among the employees within the work environment. So continuous medical checks can ensure that anything that is detected within the work environment or within the work environment and so on can be addressed appropriately to ensure that occupational problems are basically minimized and so on. Then you also have what you call preventive medicine. So, dear learner, as we have indicated, there is the element of continuous medical checks where employees are subjected to continuing medical checks in the work environment, and where maybe challenges are found, intervention measures are taken. And number 10, preventive medicine. For example, in the era of COVID-19, workers can be sensitized in terms of washing hands, social distance, issues of, say, avoiding crowds and so on. So these ones are preventive medicine intervention measures that can be able to help workers avoid chances of getting COVID-19 through washing hands, maintaining social distance, also putting on masks properly. So that helps in ensuring that workers within the work environment can have an exposure, or maybe can control occupational health and hygiene problems to minimize exposure to risks that may arise within the work environment. Then the other aspect we need to look at, dear learner, is accidents. We have said are prevalent within the work environment. So how can we prevent accidents? Accident prevention. Accident prevention. So when it comes to accident prevention, there are various measures that could be considered. For example, identification of causes of accidents. Identification of causes of accidents. So if accidents, because accidents are inherent in our work environment, so measures must be put in place to try and identify what are some of the probable causes of accidents. And then once that is put into consideration, intervention measures can be constituted. Then there's the element of consideration of safety. Consideration of safety at the design stage. Design stage. So let us take an example. An organization is constructing maybe a building where they are going to have offices. So this building is a staircase. So the staircase that is being constructed to go to first floor or second floor or third floor, you can ensure that those particular staircases are constructed to particular standards which can be able to avoid workers, for example, being injured. So that consideration at the design stage for maybe building and equipment can also be one way of anticipating accidents and preventing them from occurring. Then there's the element of provision. Provision of personal protective equipment. We have mentioned PPEs. There is also the issue of number 4, using standard operating procedures. These ones are SOPs. There are also processes of having what you call warning systems. For example, fire warnings. So basically this is a system that can be triggered off If there is a fire in a section or a room, then this warning systems comes on, then it can be able to alert other employees. Then there is also the issue of training workers on safe operations, so that workers have the knowledge and skills to ensure that they can be able to operate the machines and equipment safely and so on. And then you also have the continuing maintenance, maintenance. So an organization does not have to wait for machines to break down or injure people for them to maintain them. So continuing maintenance routines are also important to ensure that an organization is able to meet its obligations. Then you also have fire extinguishing systems, systems. Now, for example, you may have what you call sprinklers. Now, these sprinklers in most cases are put in environments where, like if you have a basement parking, then the sprinkling, the fire extinguishing system is automatic. If there is that fire siren, then the sprinklers automatically bring out water. You don't have to wait for people to come. And by the time people are coming, that extinguishing process could have now, for example, prevented that accident within that work environment. So dear learner, you can see the issue of the health of workers, as we've said, is very central. And as an employee or as a worker in a work environment or as a stakeholder in ensuring health and safety, you have to take this topic very, very seriously, because you can be able to assist an organization to save lives, save workers from being injured, save damage to property, save stoppage of processes, and ensure a work environment is safe. So we can very quickly again run through what we have done today. So in our lesson today, which was health and safety policies and procedures, we have looked at what is meant by health and safety policies and procedures. And we have said, dear learner, that health and safety policies and procedures are concerned with protecting employees and other people affected by what the organization produces and does against the hazards arising from their employment or their links with the organization. And we said we were going to look at these 1, 2, 3, 4, 5 things, which are activities in managing health and safety at work. We said we will look at hazards at work. We also indicated we will be looking at action following risk assessment. And we also indicated that we will be looking at control of occupational health and hygiene problems. And also we said we would look at accident prevention. So what did we look at when we looked at the activities in managing health and safety at work? So number 1, formulation of health and safety policies. Number 2, conducting risk assessments. Number 3, implementation of health and safety policies. Number 4, review of health and safety procedures. And then we looked at number 5, participation in health and safety committee work. Number 6, sensitization of employees on health and safety. Number 7, investigation of work-related accidents. Number 8, managing stress in the workplace. Number 9, health and safety equipment. So those are the activities we have looked at and discussed them and indicated that these are some of the activities in managing health and safety at work. Then, dear learner, we moved on and looked at some of the hazards or activities that may be associated with the hazards at work. And we have indicated that some of the hazards at work may occur at the point of receiving, number 1, point of receiving of raw materials. And then number 2, movement in the workplace, when there are movements from one section, from one department, from one activity to another one, workers could collide or they could occur a challenge there. Then when machines are being operated, number 3, machines are inherently hazardous. A machine could snap. So operating of machines can also pose a hazard. Number 4, working at heights. When individuals are working at a height, that could also pose a hazard if they are working on a ladder or working on a scaffold. Number 5, working with hand tools. Hand tools, sometimes they could, for example, be shaking, or maybe you need to position them. So that again can create a hazard and maybe injure an employee or cause an accident. Number 6, operating electric equipment. And if you're operating electric equipment and it's being supplied by a power source, that could also be a hazard, maybe a source of a hazard. Then number 7, sitting for long durations. That we have said can cause maybe lower back pain or other complications. Then processing of materials. Some materials could be toxic. So that again is a source of a hazard. Then cleaning of gutters. Gutters could be maybe below. And if an employee is working in that confined space, there could also be hazards, a hazard in that kind of work. Then work overload. When workers are given too much work, then that could trigger some stress levels among the workers. So those, dear learner, are some of the hazards or activities that may be associated with hazards at the work environment. Then we went ahead and looked at now what action can be taken when a risk assessment has been conducted. And we have indicated that number 1, elimination of the hazard. If it is a process, it could be altered. Number 2, substitution. If you have, say, a detergent and it is corrosive, it could be substituted with maybe another less corrosive detergent. Number 3, use of barriers. For example, fabrications can be made to maybe block employees from coming into contact with a moving machine. Number 4, use of standard operating procedures or having procedure manuals. That can also be useful. Number 5, use of working systems or warning systems, where there could be a warning if there is a danger, the machine stops or process stops. Then use of personal protective equipment, which we have said is the last line of protection when all the others have now not succeeded. Then we have also looked at the control of occupational health and hygiene problems. So how can organizations maybe sort out that issue of health and hygiene problems? So 1, elimination of hazard at source. At the design stage, ensure you design the machine or the process well. Then process engineering. The way the processes are carried out, that can also be maybe corrected. Isolation of hazardous processes. And we say, like in a hospital setting, the dangerous, like let's say X-ray related activities are isolated where patients cannot easily access. Then number 4, training workers on safe work practices. That can also help in controlling occupational health and hygiene problems. Good housekeeping practices to ensure the work environment is safe. Proper maintenance of plant and equipment. Number 7, regular risk assessments. Number 8, proper ergonomic considerations. The machine worker interface should be scientifically studied to ensure that they minimize on strain. Number 9, continuous medical checks and surveillance. Number 10, preventive medical medicine. For example, in the COVID-19 situation, workers should be exposed to preventive measures like washing of hands, social distance, proper use of masks, among other preventive approaches. Then ultimately we looked at accident preventions. So what are some of the intervention measures that may be put in place to help prevent accidents? So 1, identification of causes of accidents and then mitigating on that. 2, consideration of safety at the design stage. When a design is being done, safety must be central. Then 3, provision of personal protective equipment, PPEs. 4, using standard operating procedures, SOPs. And then number 5, using warning systems. For example, fire warning systems can be able to be triggered on automatically through remote sensing. Number 6, training workers on safe work operations. Number 7, continuing maintenance, so that it's routine and continuous. And number 8, using fire extinguishing services, for example, facilities or systems like now automatic fire extinguishers that come into effect in case of a fire. So these are the things we have looked at in our lesson today. And before we finish our lesson, dear learner, you have an assignment. Discuss hazards. Your assignment, discuss hazards that might be inherent in a workplace. Discuss hazards that might be inherent in a workplace. So dear learner, as we have noted, health and safety is very key. So take this particular content very seriously, because your own health, the health of other workers, the health of other people, the property of the employer, and anybody who comes into contact with what you do as an organization could suffer. So to minimize and mitigate in those areas, your administrative approach will be very crucial and will be very central to ensure we have a safe work environment for everybody. So thank you very much for being attentive in our lesson. We hope to see you in our subsequent lessons. Thank you.
Welcome to Manifested Publishers. My name is Mr. Dongo. I am an economics lecturer. Today we'll be covering that is Economics August 2024 paper, question 4, and we start with Roman A. We read the question, then we put it on the board. It says this: state 5 factors that limit the success of economic integration in developing countries. I repeat, state 5 factors that limit the success of economic integration in developing countries. State 5 factors that limit the success of economic integration in developing countries. So state 5 factors that limit the success of economic integration basically in developing countries. Developing countries, first of all, are countries that are not yet developed. They're in the process of developing. And when you talk about economic integration, we talk about these countries coming together basically to facilitate trade amongst member states. And you said one of the examples of this economic integration, a given example is like the COMESA, where you find developing countries coming together in order to facilitate trade. A given example of economic integration is COMESA, where countries come together to facilitate trade amongst member states. In the quest to facilitate trade and facilitation of cooperation amongst member states, there are a number of factors that basically hamper such integration. And some of the factors that we know basically does that is lack of trust amongst member states. We also have a number of things that deals with political instability, probably in the continent where those developing countries are. We can also talk about the difference in currency, may also hamper such integration. But you also know that there is violation, where you find some other members may violate the agreements that are basically enforced in such integration. We can also talk about some of the reasons that why these integrations may not work is difference in the level of technology. The countries that are probably more developed in terms of technology than other countries, and so with such, they may not be able to engage in such integration. But lastly, we can talk about a number of things like external influence. You can find countries that are not within the integration actually coming in and causes mayhem in such agreements. And therefore, at the end of the day, you find that such integrations are not facilitated. We can put them on the board. Say one, lack of trust amongst the member states, lack of trust amongst the member states. Number two, we have what we call violation of agreements. We have number three, very important, we call it external influence. External influence. So we can also have political instability, what we call political instability, within the region. Political instability within the region. And lastly, we can talk about what we call difference in currencies. What we call difference in currencies. Difference in currency. We can add one. We have that is difference. What we call difference in the levels of technology. Difference in the level of technology. That when we have difference in the level of technology, that may also hamper agreements within the integration. And that is basically how one should approach this very question. And in looking at that question, the examiner is very clear that it needs 5 points. So the 5 points meaning that each point is equivalent to 1 mark. So as you do that, you must make sure that you're within those points and you can provide extra so that you stand a chance that even if you're not in a position to get the second or you're not able to get the third, but you have an extra mark on that, then you'll be able to get the whole question. That is how we basically approach that very question. We'll pick it on the next question, still on question 4, Roman B. So this is what the question says. Distinguish between debt distress and debt conversion. So we put it down on the board. That is B. Distinguish debt distress and debt conversion. Distinguish debt distress and debt conversion. Distinguish the debt distress and debt conversion. One of the things that comes to our mind is when you talk about debt, we need to understand that being in a developing country, and Kenya one of the developing countries in Africa, we need to understand that one of the major policy issues is management of debt. Because you realize that these countries are not able to fund their budget, that most of their budgets are funded through debt. And so therefore, then there's need for proper debt management in such countries. And some of the terminologies when you talk about a numbers of issues pertaining to debt, we'll have what we call debt distress, and we have what we call debt conversion. To be precise, when you talk about debt distress, is inability of a country when a country is unable to fulfill its financial obligation. That is the debt distress. When a country gets to a point that is not able to fulfill its financial obligation as a result of the debt, that is what we call debt distress. And debt distress basically will lead to what we call debt restructuring, that you need to restructure the debt as a result of the distress that comes as a result of not being able to fulfill financial obligation. On the other hand, when you talk about debt conversion, we are basically saying that conversion of a short-term loan to long-term loan and vice versa. where we typically, we say that we typically exchange debt at sustainable discount. Exchange the debt at a sustainable discount. We can put it down and say debt distress. We say that debt distress is inability, is a country inability to fulfill the financial obligation. That is what you call a debt distress. And debt restructuring, and therefore debt restructuring is required, and therefore debt restructuring is required. You get to a scenario where you are so much faced with the debts that you are not able to fulfill your financial obligation, and therefore what you call the restructuring of debt basically will be necessary in such circumstances. Then we proceed to what you call debt conversion. Debt conversion. What you call the debt conversion. So when you talk about debt conversion, we basically say refers to the conversion of short-term debt to long-term debt, conversion of short-term debt to long-term debt, and vice versa. Conversion of the short-term debt to the long-term debt, and vice versa. Or we can basically say that exchange of debt, what we call exchange or stroke exchange of the debt. We say stroke exchange of the debt, typically to a sustainable discount. Typically to a sustainable discount. That is what we call a debt conversion. That is what basically we call a debt conversion. And very important to understand again on these very questions that we have, very important to understand is that if the marks is allocated 4, it therefore implies that once you define the debt distress, that should account for 2 marks, and debt conversion 2 should also account for the 2 marks. That should also account for the 2 marks. And that's a question that is doable and manageable. And if you look at this, this is one of the areas that actually affect, is one of the emerging issues, especially to the developing countries, and is one of the areas that learners need to pay attention. Because if you look at these countries that are developing, Africa and having a majority of the countries that are developing, they're faced with a number of debt issues. And so we need to give much attention to that. That is how we approach that very question. We'll pick on our next question. That is August 2024. That is question 4, Roman C. We'll read the question, that we put it on the board. Outline 6 method that may be adopted to clear external debt in developing countries. Outline 6 methods that may be adopted to clear external debt in developing countries. We raised and said that debt is a major policy issue, meaning that debt is a factor that needs to be considered. We said majorities of these countries that are in developing world rely mostly on debt. Why that? The reason is that because they're not able to fund their budgets using their own sources of revenue. And so they have to rely on debt that is basically from developed countries in order to fund their budget. So the examiner clear is asking us, how do we get to reduce? How do we get to reduce? What are some of the methods that we get to clear external debt? Because these obligations actually affect the growth of a country. So we can put that on the board. Outline, that is C, for C, outline 6 methods. Outline 6 methods that may be adopted, that may be adopted to clear external, debts in developing, countries, something very important to understand about when you talk about debt management, those are basically touches on macroeconomics. And this is one of the areas, again, also, you're not so much limited into approaching these questions. It's not limited to what you find lecturers will give, but this is a very open way. If we look at our country, for example, Kenya as a case study, what are some of the ways that are very common in a country dealing with clearing external debt? One of the very common that we know as the citizens of a country is that, that the country uses, Kenya being a case study, is widening of the tax bracket. One is what we call it widening of the tax bracket, tax bracket. That essentially means that, i.e. increasing the taxes, i.e. increasing the taxes. That one of the ways that they deal with the external debt when it's too much and how they manage it is increasing the taxes. We know that number 2 is what you call austerity measures, where government reduces. Also a measure, Kenya being a case study, we know that a country is dealing with a lot of austerity measures where a country is reducing expenditures. Number 2, reducing a country's expenditure, so that much of the money that is available can be used in order to pay the debt, And very important, number 3, we talk about debt conversion. And debt conversions, we basically say that you can convert short-term debts to long-term as a way of reducing. So we talk about number 3, what you call the data conversion, i.e. converting short-term loans to long-term loans, and vice versa, to long-term loan and vice versa. Converting short-term loans to long-term loan and vice versa. We know that when you talk about long-term loans basically take a longer time for them to be repaid or for them to be cleared. A country may decide to dealing with this long-term loan and making them short-term so that they can clear them within the period. So we can also talk about what you call increasing government borrowing. Increasing the government borrowing. You can also increase the government borrowing in terms of internal. You can increase the government borrowing in terms of internal so that you can repay the external debt, increasing the government borrowing, increasing, the government borrowing from central bank to clear, we say to clear external debt, debt. But very important, one amazing thing that a country can do, a country can also decide to seek, we say seeking what you call debt forgiveness, seeking debt forgiveness. The number of points that you can be asked where we say a country can refuse to pay debt as a way of doing away with the external debt. But the most precise and most clear way is seeking of what you call debt forgiveness. But you can also touch on what you call promoting investment so that they can have money to pay the debt. Say promoting investment so as to generate profits to pay up the debt, to pay up the external debt, so as to pay up the external debt, so as basically to pay up the external debt, that they can promote investment within the country so that they can pay up the external debt. So they can also decide to avoid rescheduling of the loan. But that basically touches, because you can have it, touches on conversion, avoiding rescheduling of the loans. We can have that as the last, avoiding rescheduling of the loans, so as to pay up in time. So as basically to pay up in time, that a country can decide to avoid rescheduling of these loans so that they are able to pay them up within the required time. That is how we basically approach that question on how do we reduce, what are some of the methods that basically we use to reduce the external debts. We pick it on our next question. That is August 2024, question 4, Roman D. This is what the question says. Highlight 5 limitations of quantitative theory of money. Highlight, we put it down. Highlight, question 4D, highlight 5 limitations. 5 limitations of quantitative theory of money. Highlight 5 limitations of quantitative theory of money. So we need to understand what basically quantitative theory of money talks about. So when you look at quantitative theory of money, it basically talks about MV, which is money supply times velocity, is equals to price levels times the number of transactions. A number of limitations that are basically envisioned in this theory are that the theory does not address the theory. One of the limitation, we say number 1 limitation, the theory does not address the issue, what you call the issue of interest rate. Does not address the issue of interest rate. And we basically know that interest rate is one of major policy on monetary policy. Monetary policy that we know we use to address a number of issues, in economics. We can also have number 2 limitation on this theory, The theory does not address the future. We basically say the theory does not address, the theory does not address the future. This theory does not basically touches on the future. The theory does not address the future. Then we can also talk about is too much concerned. Too much concerned. Number 3, we can say too much. We say too much concerned. Concerned with money supply. Too much concerned with money supply. That is circulation of money supply, and ignores the demand for money. The demand for money. So when you look at the formula, one of the things that we have on that theory, it's concerned money supply times velocity is equals to the general price levels times the number of transactions. So this theory basically focuses on issues to do with the supply of money, but ignores what you call the demand of money. Then the theory does not explain changes in the value of money. We see that the theory does not explain the changes, what you call the changes in the value of money, does not explain the changes in the value of money, and not how money, does not explain, the theory does not basically, that attempts to explain, this is basically a term, attempts to explain changes in the value of money, but not how, we say not how money attempts to explain changes in the value of money, but not how money is in the first place determined. How money in the first place determined. Not in the first place determined. We can look at the last, when we have the last on that. This theory argues that there's no general price level. Argue that 5 argues that there is no general. Argues that there's no general price levels, but rather, we say but rather series, there's no general price level, but rather series of price levels, series of change in price levels, series of change in price levels, series in change in the price levels, in the consumer price index, in the consumer price index. So those are basically some of the limitations that are basically attached to the theory, that is the theory of quantitative money, or theory of quantitative theory of money. One we've talked about does not address the issues to deal with interest rate. We also know that it does not address the future. We also understand that is too much concerned on money supply and ignores the aspect of demand of money. We know that the theory attempts to basically explain the changes in the value of money, but does not address how money in the first place is determined, how in the first place it's determined. That is how we approach that very questions. That is how we approach that very question. That marks the end of question 4.
Hello learners, welcome to Manifested Publishers e-learning portal. In our today's session, we are continuing with the revision of Management Accounting April 2022 sitting, and today we will look at question number 5. So ensure you have the paper with you, have your calculator, and follow me closely. Question number 5, part A. Smart Products Limited operates standard costing and budgetary control system. The following information, the following is the company's standard cost card. So in that standard cost card, we have direct materials, direct labor, we have variable overheads, fixed overheads, standard cost per unit, standard profit per unit, standard sale price per unit, which is given in that table. Additional information, note number 1. Each unit requires 3 kilograms of material, which cost 40 shillings per kilogram and 45 minutes of direct labor at a rate of 80 shillings per hour. Note number 2. Variable overheads are covered on direct labor hour basis. Roman number 3. Fixed overheads are absorbed on annual production budget of 180,000 units. Roman number 3, fixed overheads are absorbed, number 4, for the year to 31st March 2022, 120,000 units have been manufactured and sold. Contrary to the management's expectation, the company's profit and loss statement reflected a loss of 1,380,000 instead of an expected profit of 3,600,000 as provided below. So we have a statement which is showing a loss of 1,380,000. Then required Roman number 1, budgeted profit and loss account for the year ended 31st March 2022. Roman number 2, flexible budget for the production achieved. We want to begin with the Roman number 1. This is question number 5. We begin with the Roman 1. So we are required to prepare a budgeted profit and loss account. So the question is from marginal and absorption costing topic. So we need to know application of marginal and absorption costing. So the question is strictly on marginal costing, and therefore we need to know how the profit statement is prepared under marginal costing. So following the formats, we are preparing the budgeted profit. Budgeted profit, we need to begin, we have 2 columns. We begin with the sales. How do we calculate sales? In note number 3, we are told that fixed overhead are absorbed on annual production budget of 180,000 units. So the budgeted units were 180,000 and the selling price is 250. So to get the sales, we can reduce this in thousands. We have 120 shillings, not 120, 250 shillings multiplied by 180 units. So this will give us 45, it will give us 45,000. 45,000. Then from there we less cost of sales. So the cost of sales constitutes, in this case, we do not have either opening or closing, so we will simply have production costs. We show the production costs, and we say that in marginal or absorption, in the marginal costing, only variable costs will comprise or will be related to the cost of sales. But if we have to use absorption costing, then we include both fixed and variable. So we have not been directed which method we are to use. So based on the side cost we've been provided, the side cost card, we have both the fixed production and the variable. So we can use the absorption costing method. So in this case, we have direct materials. And the direct materials, in note number 1, we are told that each unit requires 3 kilograms of material which cost 40 shillings per kilogram. And then 180 units were produced. So how do you calculate the amount for materials? We are taking the number of units produced, we multiply by, and have separate markings, please. Markings. Direct materials. We have 180,000 units. You multiply that. We are told that it requires 3 kilograms. So to produce 1 unit of this product, we require 3 kilograms, and the cost per kilogram is 40. So when we multiply this, it will give us the cost for that. So we have 180,000, sorry, 80 times 3 times 40, which will give us 29,600. This was 45,000. Then we move to direct labor. This is working 1, working 2, direct labor. We are told in the same note number 1 that and 45 minutes direct labor at a rate of 80. So again, 180,000 units were produced. Multiplied by 45 minutes are used to produce 1 minute. So what about 180? We are taking 45 minutes over 16. Convert the minute to hours. Multiply by the rate per hour. We are told that of direct labor at a rate of 80 shillings per hour. So we multiply by 80. This will give us 10,800. We have direct, we have variable overheads. Variable overheads, note number 2, we are told that variable overheads are recovered on direct labor hour basis. So again, we need to calculate the variable overheads. And variable overheads are covered on the basis of direct labor. So we have to take 180 units multiplied by In fact, we already calculated that, so we simply need to calculate it on labor. In that table, the variable costs had 20 shillings, so express it on labor, which had 60 shillings. Then we multiply by 10,800. That will give you the variable cost, which is absorbed on labor. This is 3,600. We also have fixed overheads. This will be working number 4, fixed overheads. We are told that fixed overheads of 30, so the amount of the standard cost was 30, so take 180 units multiplied by 30 shillings, and this will be 180 times 30, which is 5,400. We now get the total of that. This will give us 41,400. So this gives gross profit of 3,600. So since there were, is it 4,000, 41,000? 45,000 minus 41,400. Yes, it gives us 3,600. So since there are no expenses, the gross or the budgeted profit for this company will be 3,600. That's for number 1. We have that question. Then number 2, we are told that flexible budget for the production achieved. So how do we prepare a flexible budget? In note number 4, we are told that for the year to 31st March 2022, 120,000 units have been manufactured and sold. And let's say the budget is prepared when we have a variance, like we had a budget for production of 180,000 units. But now, we are told that for the year to 31st March 2022, 120,000 units have been manufactured, which is bringing about a variance of around 60,000. So what will be the variation in profit? So what we are preparing is simply to show the variation in. So the flexible budget will be as sales, show the sales, and how are we calculating sales? These are working number 5. How do we calculate the sales? Production in this case is 120,000. So we have 120,000 units. We multiply by the standard sale price of 250. This will give us 30,000. So our sales, which is working number 5, is 30,000. Then we less the cost of sales. So under the cost of sales, we have production costs, which are including direct materials. So how will you calculate direct materials? Note number 6 of that same question. We are told in note number 1 that each unit requires 3 kilograms of the material at a cost of 40. So for us to calculate direct materials, we now take 120 units times 3 kilograms times 40. And this will give us 14,400 euros. We also have direct labor. This is working on 6. Working number 6. This will be working number 7. Direct labor. We are told that 45 minutes of direct labor at a rate of 80 shillings per hour. And so we have 120 units that were produced, and 45 minutes are used to produce 1 unit. What about 120? So convert this to to hours by dividing by 60 multiplied by the cost per hour, which is 80. This will give us 7,200. Then we calculate variable overheads, which are absorbed on the basis of direct labor hours. So for this we are given 20, so we have 20 divided by 60 times the amount for direct labor, which is 7,200. This will give, this is variable overheads, working number 8. The amount is 2,400. Then we again show the fixed costs, fixed overheads, which will be working number 9. Fixed overheads. This will simply be 20,000 units. We multiply by the cost per unit, which is 30. And this will give us 3,600. Again, we get the total. And the total is 27,600. We subtract, we get the gross profit. The gross profit of 2,400, which is the variance. So that is Roman 2 of that question. Is a Roman 2 of that. And sorry, I have a correction. Fixed cost remains constant. So fixed cost will be calculated on 180 units, not 120. It will be calculated on 120 because it is assumed to remain constant. So it should be 180 times 30, which will give us 5,400, not 3,000. 5,400. We get the totals. This should be 29,400. 29,400. So the variance will be 600, not 2,400. That's the variance. So that was part A of question number 5. We proceed on to question number 5, part B. Part B of question number 5. We are told that Wassim Limited produces 10,000 units per annum by employing 50% of the total factory capacity. The selling price per unit is 500, and the total costs are as follows. So we're given the total cost for materials, wages, fixed overheads, fixed overheads, and then we have additional information. Note number 1, variable overheads maintains a constant ratio to the number of units produced. Note number 2, the production manager is evaluating acceptance of a special offer of additional 10,000 units at a selling price of 380, 5.5 each. Note number 3, the increased volume of purchases will reduce the material price by 2.5%. Note number 4, the wage rates will remain constant, but due to employment of new workers, there will be a drop in labor efficiency by 5% on oil production. Required, Roman number 1, prepare a statement showing the variation of net profits resulting from the acceptance of the order. Then Roman 2, advise the management of Yasiri Limited on whether to accept the offer. Can use this please? So the question is from marginal application of marginal costing, where we have straight-line decisions. And this decision is acceptance or rejection of offer. So how do we apply acceptance or rejection of an offer? It normally arises where a firm has a capacity or a facility which is being underutilized. And when this facility is being underutilized, it means you have a portion which can be utilized by an outside either supplier or can be an outside customer. So when such happens, the firm is faced with either accepting the offer which comes in to use that spare capacity or to reject it. And so to make a decision on this decision, we need to understand what is the current position of the firm and what are the fixed costs and the implication when this new customer comes. So we normally assume that fixed costs will remain constant from 0 capacity to 100%. But when this customer comes, will it change the profitability of the firm or not? And so to make this decision, we will be as follows. We need to prepare the profit statement. And when we are preparing the profit statement, we will exclude the fixed costs. Why? We say that they remain constant. Whether that customer comes in or not, the firm will still incur those costs, so we will exclude them. And our intention will simply be to get the contribution. So according to the question, we are told that the firm is producing at 10,000 units, which is representing 50% capacity. So we need to calculate the profitability of the firm at 50% capacity, which is representing 10,000 units. And we are also told that the firm, the production manager is evaluating acceptance of a special offer of additional. So when we have additional 10,000, it means that we have an additional capacity to 20, and that will represent 100% capacity. And the units will be 20,000. We already have 10. Increasing by 10 units, the units will be 20, and that will be 100% capacity. And we will also need to show the variance according to the question we need to show the variance. We are told to prepare a statement showing the variation of net profit resulting from the acceptance of the order. So we are beginning with the sales. Remember, we are showing the profit. So we begin with the sales. The sales under 10,000 units, we are told that the selling price per unit is 500. So this is working number one, sales. We have 50% capacity and 100%. So we are told that the selling price is 500 shillings and at 50 capacity the units are 10,000. So take 10,000 multiplied by 500. What will we get? We can reduce this by thousands. So we have 10,000 multiplied by 500. This will give us 5 million. 5 million. You think 5 million is what? You can still have it. The word is 5 million. So at 50%, the sales will be 5 million, and at 100%, 100% is where we have additional 10,000. So we already have 5 million represented by 10,000, then plus the other 10,000 will be 10,000 multiplied by the selling price. We are told that the selling price will be 387.5, which will give us 3,875,000. So when we add this, we will have 8 million sales. We simply write 8,875,000. And then what is the variance? We get the variance. The variance will be 8,875,000 minus 5,000. This is 3,875,000. That's the variance. Then we proceed on to variable costs. According to the table given, for the variable cost under that we have direct materials. So this will be number 2, direct materials. Okay, number 2. So we are told that direct materials are at 1 million. So for at 50% it is already given at 1 million, just write 1 million, and then at 100%, we need to calculate under note number 3. We are told that the increased volume of purchases will reduce the material price by 2.5%. We will reduce the price by 2.5. So we will reduce the price by 2.5 from 100. We remain with 97.5. So if 1 million, we are at 100%. 1 million is representing 10,000 plus another 1 million representing the other 10,000, meaning we will have a total of 2 million. But now this 2 million will be affected where the price will now reduce. So this will equal to 2 million, and we multiply this by 0.975. That's 100 minus 2.5%. So the price will reduce by that. We will calculate that. The amount will be 1,950,000. So this will be the amount. Then we get the variance, which is 950,000. We move on to direct labor. Direct labor, that is working on the number 3. At 50%, we will already be given the direct labor represented by wages of 2 million. So we already have 2 million. But we need to calculate for 100 or at 100 capacity. So at 100 capacity, we have double that. If 2 million is representing 10,000, then 2 million plus 2 million, or 2 million times 2 will represent the 100 capacity, which will be 4 million. But note number 4. We are told that the wage rates will remain constant, but due to employment of new workers, there will be a drop in labor efficiency by 5% on oil production. So this 4 million will represent 5%, will represent 95%. Then what about 100? So if 4 million is representing 95%, then we are to calculate it at, it is just the same as if 4 million, can we see 100 is, so if 95% equals this, what about 1? What about 1? What about 100? If 95% is representing that, then what about 100? Should 100 over 90, not should 100 over 95. This will be 100 multiplied by 95, then we find not 97 divided by 95. And so when we calculate this, we have 4 million I get 4,210,000. 4,210,526. From there, get the variance. The balance will be 2,210,526. So we normally have things less variable costs. So we now subtract this to get, or to show what we refer to as contribution, to show the contribution. So we have 5 million minus 1 million minus 2 million, which will give us will be 2 million. Then at 100% capacity, subtract the marginal and variable costs. And this will give us 27 or 2,715,474. Then last year we will show the variance. And the variance will be 7,600,000. 14,474. So the question was, prepare a statement showing the variation of net profits resulting from the acceptance of the order. So what is the variation? The variation of the profit is 714,474. Why have we left out the fixed costs? The fixed costs have been ignored. Why? Because they have already been taken care of at 50% capacity. So when we are looking at, when we want to advise the farm, our intention is what is the effect of the 100% capacity on 50%. So if we have a contribution of already 2 million and then a contribution of this, it means that when a new order is accepted, it will contribute 2,715,470, which is increasing the existing contribution by 474. So in the Rwanda number 2, we are now to advise the farm, advise the management of a Siri Limited on whether to accept the offer or not. So what do we say? We say that the company should accept the offer. Why? Because accepting the offer will increase the current contribution by 14,474. So that is the evidence we can give. And we can say, in this case, the fixed costs are irrelevant since they have been taken care of at 50% capacity. So just to make a summary, whenever we are given a question on acceptance or rejection of an offer, we are looking at what is the current capacity of the farm. So always show the position of the farm at the current position for a case of 50%, and what is the new position. It will move this farm to 100%. So when that happens, then what will be the contribution? So to calculate the contribution, we exclude all the fixed costs. Why? We assume they are already taken care of under the current position. And that was how we are to go about question number 5. We've come to the end of our session. Bye-bye until the next session.
Welcome to Manifested Publishers. My name is Mr. Dongo, an economics lecturer. We proceed from the previous session, that is economics, August 2024 paper. We pick from question 7 and we read it. Using a well-labeled diagram, distinguish between inflationary gap and deflationary gap as used in national statistics, national income statistics. So we put it down. We say that one is using a well-labeled diagram. Distinguish between inflationary, distinguish between inflationary gap and deflationary, what you call the deflationary gap as used in national income statistics, as used in national income statistics, as used in the national income statistics. So the first thing we can pick from the first one, that is inflationary gap, and we understand what inflationary gap before we put it down. We need to understand that whenever we talk about inflationary gap is basically the amount in which aggregate demand must be decreased in order to reduce the national income. The amount at which the aggregate demand must be reduced to in order to reduce the national income, what you call equilibrium national income to the full employment of national income. So we can put it down. Amount at which we start with the inflationary gap. Inflationary gap. We say amount by which the aggregate demand must be reduced stroke decreased in order to reduce the equilibrium, what you call equilibrium, in order to reduce the equilibrium level of national income, in order to reduce the equilibrium level of national income to the full national income, to the full what you call full employment, level of the national to the full employment of national income. Just to emphasize on what I have said, when you talk about inflationary gap, we're basically saying the amount by which aggregate demand must be reduced or increased in order to reduce what you call equilibrium national level of income to the full employment level of national income. So we go straight forward to the diagram. So we have the diagram. We have the diagram. We have the diagram. We have the diagram. So then we have 45 degree. This should be 45 degree. That is for the aggregate demand. This is 45 degrees. So this we call it D. That is what we call AD, we call aggregate demand. And this aggregate demand is basically equals to national income stroke the G, stroke the GNP, stroke the GNP. Then we have that. We join this. That is YE, YF. That should be YF. Then we have YF at that point. That is equilibrium national income. YF should be here at this point. This is what you have as YF. YF, and we have down here, this is what we call inflationary. We call it the inflationary gap. The amount at which the aggregate demand must be reduced, that must be decreased or reduced in order to reduce the equilibrium level to a full employment of the national income, This we have as aggregate. We have this as aggregate. We call it the aggregate demand. So this is what we call the inflationary gap. We need to know what YF and YE means. YE is what you call, YE is basically, YF is represents, we call it represents full employment, represents full employment of national income. Then YE, Y basically in economics will represent national income. YE is what you call equilibrium national income. We call it equilibrium national, what you call the equilibrium national income. We call it the equilibrium national income. What is the purpose of the inflationary gap? Very important. So we need to understand that inflationary gap, what you call the inflationary gap, causes inflation. This will causes inflation in the economy. What you call inflationary gap basically will cause inflation in the economy. This will basically cause inflation. So the inflationary gap is this: how much the aggregate demand should be reduced in order to reduce the equilibrium level of national income to full employment of national income. The second is what you call deflationary gap. The second diagram is on the deflationary gap. We will illustrate on how we distribute those particular amounts. So when you talk about deflationary gap, is now the opposite. How much amount by which aggregate demand should be increased in order to raise the national income to full employment of national income. So how much? We say amount by which aggregate demand, that is AD, aggregate demand should be increased in order to raise what we call equilibrium, in order to raise the equilibrium national income to full employment of the national income, That is what we basically mean by the deflationary gap. How do we depict that diagram? So in that diagram we have, this is on, we call aggregate demand, and that is AD, aggregate demand, 45 degree, this should be 45 degree. So this is the AD, where we say that AD is equals to GNP. AD is equals to GNP. AD is equals to GNP. And then we have that. We have that AD is equals to GNP. So we have that point. That should be YE. That should be YF. YF. That should be YF. Then we have this. We have that. That should be YE. That should be YE. Where do we have the deflationary gap? It is this point that we call the deflationary. We call it the deflationary. We call it the deflationary gap. We basically call it the deflationary gap at that point. So deflationary gap, we need to understand that YF, we basically say Y represents full employment, what you call the full employment of national income, full employment of national income. And then we know that YE equilibrium, what you call equilibrium national income. That is basically equilibrium national income. What does deflationary, a very good point on an explanation. What does the deflationary gap cause? It causes deflation. We say causes deflation, which is the opposite of inflation in an economy. Causes deflation in an economy. We know that inflation is the persistent rise in the prices of commodity in an economy. When you talk about deflation, the prices are not rising. So deflationary gap causes deflation in an economy. But it's basically how much the aggregate demand should be reduced in order to raise what we call the equilibrium national income to full employment of the national income. So on the distribution, if you look at that question keenly, that question particularly has constituted about 10 marks, to imply that when you're explaining on the diagram, on the deflationary gap, you can have 4 and maybe the explanation of what inflationary gap means. The diagram to take 4, then the explanation to take the diagram, explanation 1 and the diagram 4. Or you can have the diagram 4 and the explanation what we mean by deflationary 1 mark, and therefore you have your 10 mark. Still on that area, there are a number of things, how do we control those such deflationary and inflationary gap measures that are taken is a particular area that learners can actually look at, and that is how we approach the very question that is 7A. We pick from the next question, that is 7B. We read the question, then we put it down. I light 4 principles of a good tax system. 7B. 7B. I light 4 principles of a good tax system. I light 4 principles of a good tax system. When you talk about principles of good tax system, these are basically factors that are basically being used to describe a good taxation system. We know that the very first principles were developed by a scholar who was an economist called Adam Smith. And he said that a good tax system, one of the principles, we have number one principle, we call it the principle of equity. Equity, that is fairness. Fairness, that is to say, a good tax system. People should pay, people should pay based on their ability, based on their ability to pay. That is to imply the more income, the more tax you pay. The more income, the more the income, the more the taxes the more the taxes to be paid. The more the income, we say the more the taxes basically to be paid. The more the income, basically the more the taxes to be paid. We can talk about the second principle, which is economy. Economy. Economy simply say that a good tax system should be cost effective. A good tax system should be cost effective. Should be cost effective. Cost effective. What do we mean by cost effective? The cost of tax should not be more. It should not burden. The cost of tax should not be more than the tax collected. The cost of tax should not be more than, we say should not be more than the taxes collected. The taxes collected. The cost of collecting taxes should not be more than the tax collected. We can have the next, we call it the principle of convenience. We call it convenience. Convenience. The principles of convenience. We are basically saying that a good tax system should not inconvenience the taxpayer. A good tax system should not. A good tax system should not inconvenience the taxpayer and the tax collector in terms of the mode of payment, in terms of the mode of payment, time, etc. It should be clear in terms of how should those taxes be paid and at what time should it be paid, and many other aspects of the tax. Then we can have the last one. Simplicity. When you talk about simplicity, it basically says that a good tax system should be understood by a common person. A good tax system should be understood by a common person. That a good tax system should be basically understood by a common person. But we can illustrate, just put them down, some of the principles of a good tax system. We can have certainty, that is basically surety. Certainty as also a factor, where you're sure as a taxpayer, you're sure of the amount that you need to remit in terms of taxes, and the tax collectors are also sure of what they expect in form of tax. We can also have the last, we call it diversity. That a good tax system should have variety, so that all the population in the economy should be paying taxes when you have a variety of the taxes, And that is how we approach that very question on the principles of a good tax system. We pick it on our next question. That is question 7C. We read the question. A firm operating under a perfectly competitive market has the demand and total cost function represented as follows. So we have P being equals to 40 minus 60Q. We have TC, which is the total cost, being equals to 100 plus 50Q minus 80Q squared. And you're being told that where P is price, Q is quantity, C is total cost. And then we are told to determine the average fixed cost function, and we are told to find the average variable cost function. And lastly, 3, we are told to determine marginal cost function. We put it down on the board. That is 7C. Determine a firm operating under a perfectly competitive market, has the demand and total, what we call the total cost functions, represented by the following. Has the total cost function, the demand and the total cost function represented by the following. So the demand function, we say P is equals to 40 minus 60Q, and then we have total cost, which is the TC, equals to 100 plus 50Q minus what you call 80Q squared. That is the total cost function. Then we're told where P is equals to price. So we have P is equals to price. We have Q is equals to quantity, and then TC is what you call total cost. Then say required or determine. The first one is what we call average fixed cost function. Average fixed cost function. Then we have B. We have what we call average variable cost function. Average variable cost function. And lastly, that is C. We can talk about marginal, what you call the marginal cost function. So we proceed. We start with the first one. Average fixed cost function. How do you determine average fixed cost function? We say fixed cost over Q. That is fixed cost over Q. Fixed, that is say fixed cost over quantity. The first thing is to determine what we call the fixed cost. The first thing is to determine the fixed cost. Where do we get the fixed cost? We get the fixed cost from the total cost function. So we write down the total cost function, we have it there. So TC, which is the total cost, is 100 plus 50Q minus 80Q squared. So what is a fixed cost? We say that fixed cost is independent, is not affected by quantity. So from the total cost function, we know that the fixed cost, we look for a factor that is independent, not affected by quantity. So the fixed cost in that question should be 100. Is not dependent on the quantity. Whenever we talk about fixed costs, like when you talk about the rents are not, whether you've done business and made money, it is independent. So if you're looking for the total cost function, we pick the cost, the part of the cost that is independent of Q. So total fixed cost is 100. So how do I get average fixed cost? That should be, as I said, fixed cost over Q. So that would be 100 over Q. So average fixed cost should be 100 over Q. That is what you call average fixed cost. We move to the second one, which is Roman 2, not B. This is Roman 1. This is Roman 2. This is Roman 3. So this is Roman 1. So then Roman 2, is the average variable cost. So variable cost in this particular question we know is dependent on the quantity. Average variable cost is dependent on the quantity. So on that we have this part. So average variable cost, we get the variable cost first of all. So variable cost we know is dependent. So that should be 50 Q, that should be 50Q minus 80 Q squared. That is the variable cost. How do I get now average variable cost? That should be the variable cost over Q. That should be the variable cost over Q. That should be the variable cost over Q. So the part of the variable cost, that should be 50Q minus 80Q squared. You divide by Q. You divide by Q. What do? I'll come and have 50Q over Q, then minus that should be 80Q. We have noted it here. 80Q squared minus 80Q squared over Q. So this Q goes with this. So we have 50. Q squared, that would mean 80 times Q times Q. So this will go with this. So we have minus 80Q. So average variable cost should be 50 minus 80 Q. That is the average variable cost function. That is the average variable cost function. Then we have the next, that is a marginal cost. We have what we call marginal cost function. Marginal, that is Roman 3. Marginal, what we call the marginal cost, marginal cost function. Marginal cost function. What we call the marginal cost function. If I have total cost, total cost, and I want marginal cost, what do? We say we differentiate. If I have total cost and I want marginal cost function, I differentiate the total. We differentiate the total cost function. You differentiate the total cost function. We come and give the total cost function. Total cost function is basically 100. We say 100 plus 50 Q minus 80 Q squared. 80 Q squared. That is the total. We differentiate in relation to Q. 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 We differentiate in relation to Q. The first part, which is a fixed bar, we can't differentiate because in relation to Q, there's no coefficient of Q. But the first one is 50. We have the 50 Q. How do I differentiate? This is raised to 1. So we say 1 times 50, then Q was 1 minus 1. So we're going to have 50 Q raised to 0. Any number raised to 0 is 1. Any number, law of indices, any number raised to 0 equals to 1. So when you have 50Q raised to 0, so Q raised to 0 is 1. So once we differentiate, we have 50. Then we differentiate the second coefficient, that is negative 80 Q squared. So what are we going to do? We're going to say 2 times negative 80, 2 times negative 80 raised to Q, that was 2, you minus 1. So this will be negative 160, 2 times 80, negative 160, over Q raised to 1. So the marginal cost function in this case is going to be 50 minus 160Q. 50 minus 160Q. Minus 160Q. And that is the marginal cost. On this particular question, there's still a number of things that can be exhausted as a learner. The examiner can, maybe on the next sitting or in the sittings to come, the examiner can also exhaust on the part of marginal revenue, and how do we get total revenue? How do we get total revenue? Just as an additional, we need to understand that the total revenue, if we have a demand function which is P, it should be P times Q to get the total revenue. And once you have the total revenue, what is the approach? How can I get the marginal revenue? I differentiate the total revenue. Again, when you have these marginal revenues and you want total revenue, now you need to go backward, and that will mean that we integrate instead of differentiation. And I just want to say this on this particular question that involves calculation. If the student is very keen, this particular question should be perfectly done. This particular question should be perfectly done. And that marks the end of the paper and marks the end of that question 7. We wish you well and God bless you.
Greetings, candidates, and welcome to the Manifested E-Learning Forum. We continue with the topic decision making. The subject is leadership and management. In our today's session, we are going to study decision making under various environments. Decision making under various environments, like the environment of certainty, uncertainty, and environment of risk. 3 things. Decision making under certainty, decision making under uncertainty, and decision making under environment of risk. Under environment of risk. Now, candidates' decisions are usually taken in different types of environment. And the type of environment also influences the way the decision is made. And there are 3 types of environments in which decisions are made. The first one being the environment of uncertainty. Now, candidates, in this type of decision-making environment, there is only one type of event that can take place. And it is very difficult to find complete certainty in most of the business decisions. So under certainty, I'm saying that there is only one type of event that can take place. There is type of event that can take place. There is only one type of event that can take place. But we all know, candidates, it's very difficult to find complete certainty in most of the business decisions. However, in many routine type of decisions, almost complete certainty can be noticed. And such decisions generally are of very little significance to the success of the business. So as much as we can say that it is not easy to get certainty, a certain environment, there are certain decisions, especially the decisions that are made routinely. Under such environment, then we can say there can be, may say, high level of certainty when making such decisions. So under uncertainty, there are decisions that are made on routine, okay, the day-to-day decisions that are made periodically, routinely. In such an environment, we can say that there can be some very high level of certainty, okay, certainty. Then there is environment of uncertainty. Now, candidates, in the environment of uncertainty, more than one event is likely to take place. More than one event is likely to take place, and the decision maker is, under this environment, completely in dark regarding the event that is likely to take place. So the decision maker may not be in a position even to assign probabilities of happening of the events. And such situations generally arises in cases where happening of one event is determined by external factors. For example, the demand of a product, all right, the demand of a product, or because the demand of a product, that is an external factor. We may also think of the moves that competitors may make. You may not know with certainty what move or position that the competitor can take at the marketplace. And such situations, candidates, generally arise in cases where happening of the event is determined by external factors. So such decisions involve an element of uncertainty. One may not know what the competitor will do. One may not know what customers will do, or whether customers will buy goods or not. So the decisions that are made in such a case are made in an environment of uncertainty. Then lastly, there is the environment of risk. Environment of risk. Now, candidates, under this condition of risk, there is more than one possible event that can take place. There is more than one possible event that can take place. There is more than one possible event that can take place. However, the decision maker in this case has adequate information to assign probability to the happening or non-happening of each possible event. And such information is generally based on the past experience that the decision maker may have had. And virtually, candidates, every decision in a modern enterprise is based on an interplay of a number of factors. And we know, candidates, that there are tools of analysis of such decision-making situations that have been developed, and they can be used in making decisions under risk. Such tools include decision-making trees, we have risk analysis models, we have preference theory, and so on. We can also say that the modern information systems can also help in using such techniques to make decisions under either environment of uncertainty or environment of risk. So candidates, these are three conditions under which decisions can be made. That is the condition of certainty, or the environment of certainty, environment of uncertainty, and environment of risk. And I've said when we began the lesson that decisions are taken, can be taken in different types of environment. And the type of environment also influences the way the decisions are made. And there are three main types of environments in which decisions are made: environment of certainty, environment of uncertainty, and environment of risk. So that will mark the end of our today's learning session. I'll give you one assignment. explain the following environments under which corporate decisions can be made or may be made. One is uncertainty, certainty. Number two, uncertainty, and lastly, risk. This is certain environment, and that is an environment of uncertainty and environment of risk. Thank you for tuning in today. I hope to meet you in our next session where we continue to learn more in regard to the topic on decision making. Bye-bye. How are you, everyone, and welcome back to the lesson. The subject is auditing and assurance. We are still covering the topic forensic accounting. During our last lesson, we defined forensic accounting. Then we outlined the primary objectives of forensic accounting. Then we distinguished between forensic accounting and statutory audit. All right, forensic audit and statutory audit, we made 5 distinctions between the two. Today we are going to study some key points regarding rules of evidence. Rules of evidence in court proceedings. Rules of evidence in court proceedings. We say that the one purpose of carrying out forensic accounting is to gather evidence that can be used in court proceedings as far as financial crimes are concerned. Now, the rules of evidence in court proceedings vary depending on the jurisdiction and the legal system in which the court operates. But there are some general principles and common rules that are followed in many legal systems. So we're going to discuss a few points. One is on relevance. Relevance. Now, here, evidence must be relevant to the case at hand. It should have a logical connection to the facts in dispute and must be useful in proving or disapproving a fact. That's the first point we can say about rules of evidence in court proceedings as far as forensic accounting is concerned. Relevance. Evidence must be relevant to the case at hand. The second point is admissibility. Admissibility. Now, candidates, not all evidence is automatically admissible in court. There are various rules that determine whether evidence can be presented to the court. And common grounds for excluding evidence include heresy, which means an out-of-court statement offered to prove the truth. So heresy is not admissible. Do you understand? Admissibility. Not all facts can be admitted in court proceedings. Okay? There could also be burden of proof. Burden of proof. Number 3. Burden of proof. Burden of proof. The burden of proof rests with the party asserting a claim or seeking to prove a fact. So the standard of proof varies depending on the type of case, ranging from beyond reasonable doubt, which applies in criminal cases to preponderance of evidence, which applies in case of civil cases. 4, competence and credibility. Now here, candidates, witnesses must be competent to testify, meaning that they must have the ability to understand and answer questions. And their credibility may also be challenged through a cross-examination or by presenting contradictory evidence. 5, heresy. 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 Okay? Heresy. Is it the right spelling? Should be heresy. 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 Now here, heresy, candidates, refers to an out of court statement offered for the truth of the matter asserted. And in general, heresy is not admissible as evidence unless it falls within recognized exception, such as statement made by a party opponent or a dying declaration or a statement against interest. Heresy. Then number 6, authentication. Authentication. Evidence must be properly authenticated to establish its relevance, to establish its reliability. And this involves providing sufficient evidence to show that the item or testimony is what it purports to be. Authentication, from the word authenticity. Authenticity. 7, expert testimony. Expert testimony. Now, expert witnesses may be called to provide specialized knowledge or opinions or interpretations in areas beyond the understanding of the average person. So the admissibility of expert testimony is subject to specific criteria, including the expert's qualifications and the reliability of their methods. You understand? So these are some of the points in relation to rules of evidence in court proceedings as far as forensic accounting is concerned. And candidates, it's important to know that these points provide a general overview of the rules of evidence and may vary in different jurisdictions. It's also advisable to consult the specific laws and regulations of different or relevant jurisdictions for a comprehensive understanding of the rules of evidence in court proceedings. So when submitting evidence in court proceedings from forensic audits, these are some of the matters that should be considered: relevance, admissibility, burden of proof, competence and credibility, heresy, authentication, and expert opinion. Expert opinion. So, for example, expert opinion, if the auditor is highly qualified, then the evidence that is adduced in court by such an auditor will be highly credible. Thank you for attending our today's lesson. We continue to learn more about forensic auditing in our subsequent lessons. Bye-bye.
And from there now, I want us to look at a question. So I read the question, then I'll show you how it is solved or computed. This is what the question says. Kamara, Susan, and Kubasu are a partnership, trading as Kasuku traders, sharing profits or losses equally. They have provided the following statement of profit or loss for the year ending that 1st December 2021. We have the gross profit, VAT refund, foreign exchange gain, dividend income net, a profit or disposal of furniture, rent income, then total income, then less expenses, insurance premiums, legal fee, depreciation, repair and maintenance, VAT paid, sundry expenses, interest on capital for Kamara, Susan, and Kubasu, motor vehicle expenses, custom duty, accountancy fee, bad and doubtful debts, rates and rent, salaries and wages, net loss. Additional information number 1. Insurance premiums include 282,500 paid to insure Susan's private car. Legal fee include parking fine, settling a dispute with a customer, appeal against tax assessment, court expense for breach of contract, preparation of tender documents. Number 3. Sundry expenses include interest charged on hire purchase, cash embezzled by cashier, registration of trademark. Number 4. Repair and maintenance comprised of the following: repair of furniture, installation of surveillance camera, cost of office furniture. Number 5. The partners took goods for personal use which had cost price of 225,000. The gross profit margin was 20% as recorded in the partnership books of account. The investment allowance were agreed with the Revenue Authority at 1475,000 during the year ending that 1st December 2021. Salaries and wages included salaries to the partners as follows: Kamara, Susan, Kubasu. So we are required to have the adjusted partnership profit or loss for that year and distribution schedule of the profit or loss computed in C1 above. So we prepare the income distribution schedule after getting the taxable income. So the first question is to get the taxable income of the partnership. Question is, which method are we supposed to use? Here we said if you are given net accounting profit, then you use the net profit method. Here we are given the net loss, which is a negative profit. That automatically means that you're supposed to use the net profit method. So we solve the question. We start with the name of the business, Kasuku Traders. Which is a partnership. We get the taxable income for the year ended that 1st December 2021. As we had said, when you are given the net accounting profit or loss or income, we start with it and then we adjust it. So we'll start with net loss provided, which we are given in shillings, and we have 2956. 2956,000 negative or a loss. Then we add, we had said when you're using the net profit method, you add non-allowable expenses in P&L and taxable operating income not in P&L. Non-allowable expenses in P&L and taxable operating income not in P&L. What does that mean? We usually start with the first item, non-allowable expense in P&L. Meaning, in P&L is the profit and loss account, which is the income statement. That in this income statement, as you can see, incomes were added and expenses deducted to get the net profit, which is a negative profit anyway. So we are saying, of those expenses that were deducted, is there an expense that is not allowable? So that now it had been deducted to get the net profit. It's not allowable. It's not supposed to be deducted. We add it back. Before we go to the last one, the last one I'll show you where we find it, because that one, as you can see, not in P&L. So we finish with this first one, as we had illustrated earlier on. Let us start with the expenses. We just follow the ones that are in the P&L. Insurance premium. Insurance is for the business, and it is usually allowable expenses. The other one is legal fee. Legal fee is also allowable, as long as they have not extended to what they entail. Depreciation, no. Depreciation is not allowable, as we have been saying, so we add it. It had been deducted, remember, and it is not allowable. 75,000. The other one is repair and maintenance. Repair and maintenance, that is allowable. It's for the business and it's allowable. VAT paid, we said any form of tax we don't allow. Any form of tax, VAT is a tax, value added tax, is not allowable. Had been deducted to get the net profit, and it's not supposed to be deducted, it's not allowable. We add it back. Next, sundry expenses. Those sundry expenses are small expenses put together for the business, and they are allowable. Interest on capital. We had even said it here that anything paid to the partners is not allowable. Partner salary, commission, interest, drawings, in private expense we don't allow. So that one had been deducted and it's not allowable. So interests on capital, which we have Kamara, we have Susan, Kubasu. So Kamara for 7,500. The other one is 185,000. The other one is 146,000. Then we continue motor vehicle expenses. Motor vehicle expense, those are expenses to run the motor vehicle. Don't say it's the cost of motor vehicle. When you hear motor vehicle, they are the expense to run motor vehicle, like fuel, repair. Those are allowable. But if they say the motor vehicle costs, that's now the cost of a motor vehicle. Fixed asset we don't allow. So this is allowable. Next is custom duty. Custom duty is a form of tax. We don't allow taxes. So we'll add it. Which we have 227,500. Next one is accountancy fee. Those are professional fee you pay. They are allowable because they are for the business. Bad and doubtful debt. Now when you hear doubtful debt, is a provision, a general provision, because you are doubting that they might not pay, they might pay. So it's just a provision. We don't allow provision unless it's specific provision for bad debt. The next one is rates and rent. Rates and rent, those are allowable expense because they are for the business. Salaries and wages, we also said those are allowable. They are for the business. They are revenue and commercial expenses. Now look, we are done with non-allowable expenses in P&L. Now we can look for taxable operating income, not in P&L. What does that mean? It means that an income that is taxable, but it has not been included in the P&L, in the income statement up here. So meaning it didn't increase the net profit that we have down there, although it's a loss, it's a negative profit. It didn't. So if it is not in the P&L, it didn't increase this net profit. Where do we find it? We can only find it in the additional information. So we go to the additional information to check for an income not in P&L. If they happen to be taxable operating, then we are going to add. However, when we go to the additional information, there's something else we normally check. You see, we say we are done with the expenses in the P&L, but you may go to the additional information and you are given analysis of those expenses that are in the P&L. Like the last expense we had salaries and wages in the P&L. You may go in the additional information and you're told that was to the partner. Remember, salary to the partner we don't allow. So we still come back and disallow it. So in the additional information, we not only look for taxable operating income not in P&L, but we also look for analysis of the expense in P&L. If they happen to be non-allowable, we still add them. Like, if you go to the additional information number 1, we are told insurance premium include. Now, insurance premium is an expense. When you go to the income statement, you'll find it is the first expense. So now we are told that one, it includes 282,500 paid to insure Susan private car. Those we don't allow. Why? Because they are private expenses of Susan, who is a partner. We don't allow. So we disallow the 282,500. Insurance, Susan car, 282,500. Then number 2, legal fee include. Legal fee is an expense. Now, is it in the P&L? Yes. When you go to the P&L, the second expense, legal fee. Now, we need to determine if there's a component that is not allowable of that legal fee, so that we add it because it is in the P&L. It included parking fine. Parking fine, we don't allow them. Let me analyze them, then I post the one that are not allowable. Parking fine are non-allowable, so that will add setting a dispute with the customer. That is allowable. So if you remember what we said, legal expense related to customer is allowable expense. Then the other one is appeal against tax assessment. We said any expense relating to tax is not allowable. Relating any expense, any form of tax, we don't allow. Expense relating to tax, we don't allow. So this is not allowable. It's relating to tax. Court expenses for breach of contract. We said that. Legal expense relating to breach of contract, we don't allow. The other one is preparation of tender document. Now, that is allowable expense. So now let us disallow the ones that we have said. Parking fine. $150,000. Tax assessment. Expense, which we have 62,500. We have breach of contract, costs or expense, 400,000. Preparation of tender that we said is allowed. After that, we go to number 3. Sundry expense include. Now, sundry expense is in the P&L. When you go to the P&L, you will find it there. So we need to determine the part that is not allowable. It included interest charged on hire purchase. We had said interest on money borrowed is allowable. Interest on money borrowed. So hire purchase, is like you had taken an item through hire purchase, you had borrowed it, so you are paying the interest. That's allowable. Cash embezzled by cashier. We had said any expense that is not income generating, we don't allow. So it doesn't matter who embezzled. As long as it's an embezzlement, it is not income generating. We disallow. We will add it here. The other one is registration of trademark. We had said expenses relating to trademark, patent, copyright, we don't allow them. So these two, we disallow. Cash embezzled, by cashier, 565,000. The other one is registration of trademark, which we have 281,250. After that, we go to the point number 4. Repair and maintenance comprised of the following. So, repair and maintenance, if you go to the P&L, you will find it. It is there, one of the expenses. So, we check the part that is not allowable. We are told it included repair of furniture. Repair of furniture, those are normal business expense and it's allowable. Don't say it's relating to a fixed asset because it was incurred after the fixed asset had been purchased. It's already allowable. Installation of surveillance camera, that is the one that is not allowable because we had said when we were looking at the capital allowance, expense incurred before you start using a fixed asset. We normally claim capital allowance on them when we are claiming the capital allowance of that particular asset. So this one is not allowable because it's part of the cost of the fixed asset, the CCTV. cost of office furniture, those are also not allowable because they are fixed asset. So we disallow the two. Installation of surveillance camera, where we have an amount of 812,500. The other one is the cost of office furniture. Costs of office furniture. Cost of office furniture, 525,000. Then we now go to number 5. The partners took goods for personal use which had a cost price of 225,000. The gross profit margin was 20% as recorded in the partnership books of account. So partners took goods, they were charged profit. It's like the goods were sold to them. Now, they were at the rate of 20%. Now, if you go to the income statement to check whether that profit is there, it is in the gross profit that you can see in the income statement. And what did we say about the income in the income statement? At the moment, we are interested with the income not in the P&L, not in the income statement. So if an income is in the income statement, we ignore for now. So we move on to the next one. Investment allowance were agreed with the Revenue Authority at 1475,000 during the year. Remember, investment allowance is equivalent to capital allowance. Capital allowance or investment allowance are allowable. Right now, we want the non-allowable expense in P&L. So that being allowable, we ignore. Number 7, salaries and wages include. If you go to the P&L, you'll find salaries and wages there. In that salaries and wages, we are told it included the one that were paid to the partner. We said anything paid to the partner, we usually don't allow it. So, salaries to the partner. Where we have Kamara, Susan, Kubasu, which we have 600,000. We have 450, and we have 225. And that is the end of the additional information, meaning we don't have any other item we are supposed to add because we are done with the expenses in P&L. Unfortunately, we didn't find taxable operating income not in P&L. Otherwise, it could have been in additional information. Now that we are done with the addition, remember we said now you come to the deduction. Deduction, we deduct 3 items. Less, non-taxable operating income in P&L, that is one. The second one is all investment income, or investment incomes in P&L, and allowable expenses not in P&L. So we are saying we first look for non-taxable operating incomes in P&L and all investment incomes in P&L before we look at the allowable not, because this one is not in P&L. We start with the first two. Now we go to the P&L and look for them, but I like to delete this part here so that I can continue, and then once we are done, I can come and we distribute here. So the continuation is here. So let us go to the P&L, look for non-taxable income, meaning that in this income statement up here, there could be an income that is not taxable that was included. We remove because it increased the net profit there. We remove because it's not taxable. 2, if there is any investment income here, investment income increased the net profit, we remove it so that we remain with operating income only, as we had said. So we start with the first income, gross profit. Gross profit is a taxable income and does not have an issue because we are in the business of buying and selling the goods. So the profit we make is a taxable. But there was additional information number 5, that the partners took goods for personal use which had cost price of 225. The gross profit margin was 20% as recorded in the partnership books. We said any income to the partner is not from the partner is not taxable. So it's like the partners purchase the goods from the partnership because they are being charged the profit. We remove that profit. So profit on goods taken by partners. So here we are told the goods, the cost of the goods was 225,000. This is the cost. I want to remind you that whenever you are given margin and markup, I know you have done financial accounting or financial reporting. You are told whenever you are given the markup or margin and you want to get the profit, you must be very careful. That, remember, I want to illustrate here. Remember, markup, let me start with the margin. Margin is usually equivalent to profit over sales, which in this case we are told is 20%. So 20% stand for 20 over 100. Now we use the margin the way it is to get the profit if you are given the sale. Now in our question we are given the cost. The cost, we use the markup which is the profit over cost. So in this case then we have to ask yourselves, how much was the markup? You don't have to worry, you just need to use the margin to get the markup. How? See here we have profit over sales. Margin is profit over sales, which is 20 over 100. Profit, it is 20 then. Sales is 100 then. And here in the markup we have the profit. So bring this 20 here because it is the same. It's a common factor in the markup and margin. Profit, 20. And then now get the cost. Remember, even when we are doing the gross profit method, we were saying a sale minus the cost of sales, we get the profit. Now, if you want to get the cost, remember here we want to get the cost. If you want to get the cost of sales, then take this cost of sales together with the negative to the other side, and the profit will bring here. Remember, profit is positive here. When it come here, it will be negative. Cost is a negative here. When it go beyond the is equal sign, it will become positive. So it's like saying the cost will be the sale minus the profit. So in this question, do we have the sale? Yes, the sales is here, which is 100. So we take 100 to get the cost minus the profit. Do we have the profit? Yes, the profit is 20. The one that we have even used here, minus 20, meaning it is 20 over 80. So now that we have the markup, and the markup is the one that you use the cost, now we can apply it directly. This is the fraction 20 over 80 times 225 because that is the cost. So we'll come here and talk of times 100 over 80. And not 100 over 80, 20 over 80. 20 over 80. We do the computation so that we can get the profit that was charged on the partners. 225,000 times this 225, let me confirm, is 225. 225 times 20 divided by 80, which give us 56 to 50. So 56 to 50 we minus. Remember, we are minusing because it's an untaxable operating income in P&L. So I'll now continue here. Now we go back to the P&L, look for other non-taxable income and investment. After the gross profit, we have VAT refund. VAT refund is not even an income because you just overpaid your VAT and it's being refunded to you. So we remove VAT refund. VAT refund 102,500. It is a non-taxable income. It's not supposed to be taxed. The other one is foreign exchange gain. We only said the non-taxable foreign exchange gain is the unrealized one. Unrealized we should not tax. Actually, if we were told unrealized, we should have removed because it had been included to increase the net profit and it's not taxable. But when it is cited, what does that mean? It means it is realized. So if we say that it is realized, so that is taxable. We won't remove. Dividend income net. Dividend is an investment income. And we said all investment income in P&L or investment income in P&L, we remove them. So we remove dividend income. And somebody may ask, do we remove the net of the gross? My answer is, you remove the figure that increased the net profit. The figure there, whether net or gross, right now they are saying net 562.5. The 562.500 is the one that increased the net profit that we are adjusting. So remove it, whether gross or net. The figure is the key, 562,500. Then, profit on disposal of furniture. If you remember, we said income from selling fixed assets we don't tax. So had been included in the in the income statement, they increased the net profit, it is not taxable. So profit on furniture. So profit on furniture, which we have 591,000. The other one is rental income. We said all investment income in P&L we remove. Rent is an investment, we remove rent income, which we have for 15,000. And that is the last income in the P&L. So we are done with non-taxable operating income in P&L and all the investment income in P&L. Now we look at the last part, allowable expense not in P&L. An expense that was supposed to be deducted in the P&L in the income statement to get this net profit, it had not been deducted. Meaning this net profit, it is overstated. So we need to remove it. If it is not in the P&L, where do you find it? You find it in the additional information. Let us go to the additional information for an expense allowable not in P&L. Now we start with number 1.